So alright, I guess we are live. Everyone in the class, very welcome to this amazing session. Come on. So all the live people, very good morning. Come on. Who all do we have in the class right now today? Please tell me. Good morning. Mark your presence here. Recorded people, very welcome to this amazing session where we gonna cover the entire chapter of foreign exchange, where we gonna understand the concepts really well, solve one question for each concepts, and that's how make this revision really comprehensive, that too in full English language. Yes, so that's great. You will have to, people in the class, please confirm it once. Can you all see me, hear me very clearly? Everyone, is my audio, is my video, everything super set, super clear? Please tell me. Come on. Someone is saying for IRRM. So guys, we will do a separate session for IRRM and International Financial Management, and that's mostly gonna happen tomorrow. Alright, so just give me a minute. Great, so shall we get started? Again, just to inform it to everyone, sir, the books that we're gonna use in this lecture is the same notes that we use in a regular batch. One is the OutNotes, which are really brilliant, amazing concepts notes that you see here on the screen. Another, people in the class, is OutScanner, which is the question bank that we have, which is compilation of all the RTPs, MTPs, exam papers, study material, everything, which means beyond it you don't need to refer to anything. Fine. These two books we gonna refer. Link to the soft copy has been given in the description below, right? However, right now I'm giving the link of the notes which are applicable for Jain 26 and onwards. If you are watching it after a year, you would need the latest OutNotes which is applicable, for example, Jain 27 and onwards. So for that, go to the Telegram channel, get in touch with me, look for the latest OutScanner. Okay, the notes which is available with the regular batch students in the hard copy, the same notes are freely downloadable to you in the soft copy on the Telegram channel. As of now, they are, unless there is a change of plan in future. Cool, one thing. Second, the OutNotes, the concepts notes, as of now are available only in the soft copy. We will try to make it also available in the hard copy. If they are, you will get a link in the description to buy them, right? OutScanner, which is the question bank, hard copy is available, that description has the link. And yeah, that's all, right? There are two more links in the description. One, the Telegram channel, the place where it has all the updates and everything, and second, the Telegram group where the discussion of doubts and everything happens. Fine. So that is all, people. In the class, we are starting our discussion with the chapter of Forex. Let me tell you, in our OutNotes, Forex and International Financial Management are in a single chapter, right? But here in this revision video, we will cover only the foreign exchange, which is as per the study material. International Financial Management, there will be a separate video, just like interest rate risk management. Yes? So everyone, finally, let's get super started. Fine. Now, if you are watching this video, if you want to really make use of it, then make sure you don't miss to subscribe the channel and obviously like the video. It is going to give you better results then. Well, so who all do we have? Now we have very good morning. Real me, this is who? This is who? Real me is who? Then Arpit, hi, how are you? Jai, hello, good morning. Guys, so come on, people. To be able to understand the Forex, let me tell you one very important thing. The way we gonna cover, or the way every faculty cover Forex may be slightly different here and there, right? If you want to really rely on this one, then there is a possibility that a particular question we do in a different way, you must have learnt in a different way. So you can't stick to the two things, else you gonna get confused. If you are here to trust me, then you will have to trust me. Unlearn your basics and relearn it in the class right now. We're gonna cover it with that clarity. Sir, why? because the way we learn the basics, right, is time saving. At today, you might find it different. I mean, when you find something new, you might find it different. But once you learn it in the exam hall, in the revision, it's gonna really save your time, right? So due to different approaches, later on you should not get confused. Today you will have to choose a particular approach, right? So we are starting with the approach. If you are able to unlearn the older thing to learn the new, I am sure I will apply every single concept learnt here to the OutScanner, to the question bank, and try to relate the concept with the question for your comfort. Yes, so Dhwani and Shweta, very good morning. Guys, we're gonna get started right now. When we talk about Forex, in the Forex, everyone, there is no hardcore technical thing. I mean, compared to derivative, Forex is relatively very easier in terms of technicality. Then why do students lose mark? Because of one main reason. Sir, Forex does not involve anything technical. It involves simple situations of inflow, outflow, profit. But to be able to calculate those inflows, outflows and profits, simple numbers, there are a lot of things from the basics that get supplied. For example, you get confused in whether to take bid or ask. You get confused with whether to divide or whether to multiply the two numbers. You get confused, sir, if it is exchange margin, ask require addition, bid require deduction. You may get confused regarding, sir, if it is forward margin, if it is low high you add it, if it is high low you deduct it. So there are, when you solve a practical question, there are a number of things in these basics that you need to look at to be able to solve that question correctly. If you miss on this basics, then that easy question also become incorrect. I said there is nothing very technical, but various easy things to be taken care. This is the approach that we all should realize in Forex. So let's make sure that all those basics are compiled at one place, so that when you solve a practical question, you should have this clarity that, okay, all these basics I need to apply. Second, let's understand the basics really well. So final, we are now starting. Yes, this lecture is going to be around for 6 hours is my estimate. Let's see how it goes, people. So with all your energies, with a smile on your face, let's get started. Right. So is the streaming clear? I mean, quality, buffering, everything clear, people? There's no issue with respect to streaming, right? All that is sorted, huh? That's true. Yes. So come on. Sir, in the chapter of Forex, first of all, you have to understand where is the need of Forex. Sir, you are an Indian, which means your home currency is rupee. Someone is Japanese, his home currency is yen. Someone resides in US, his home currency is dollar. Any currency other than your home currency is a foreign currency. I am Indian, my home currency rupee. Any currency other than rupee is a foreign currency, like yen, pound, euro, dollar, everything is a foreign currency to me. Someone lives in Japan, for his home currency is yen. Anything other than yen is a foreign currency to him, dollar, rupee, euro, pound, anything. In this question, in the Forex question, I mean to 80 to 90% of the question, you will have to identify that the question is given from the perspective of which person. Is it an Indian person? Is it a US company? It is a British UK company. So that you realize what is his home currency, and accordingly in the question also identify which is his foreign currency. Now, you are an Indian, you have rupee, you need dollars. Why do you need dollar? Imagine the foreign currency transactions now. Am I Indian? If I'm an Indian, I buy something from Reliance. I have rupee, the invoice is also on rupee, no problem. But if I buy something from Apple in US, sir, I have rupee, but Apple has invoiced to me in dollars. When I imported something from Apple, it invoiced to me in dollars. Sir, I am Indian, I have rupee. When I export something to the UK, I have invoiced them to pound. So when I enter into any transaction which is denominated in any foreign currency, then such transaction is foreign currency transaction. Yes, sir, basic. Why are you teaching that? Because now you would realize to be able to successfully do a foreign currency transaction, you will have to go to the foreign exchange market. Sir, what do you mean? Sir, when you import something from Apple, you need to pay dollar. To the other party, you need to pay dollar. Do you have dollar? No, sir, I have rupee. Do you realize you have to pay him dollar, you have rupee? Similarly, sir, when you sell something in pound, you will receive pound. You have in your hand the pounds, but what you ultimately need is rupee. So in India, there is a market where I can sell one currency and receive another currency, or buy one currency and pay another currency. Such market is a forex market where we're gonna now go. Right. So in the forex market, you go as an importer or exporter or borrower or an investor primarily in this question. Yes. For example, sir, when you are an importer, exporter, anything, but you have invoiced in rupee in your home currency, there's no problem. You are in US, you have exported to India, listen to me carefully. You are in US, you have exported in India, your home currency is dollar. To the Indian person, if you are invoiced in dollar, then for you it is a home currency transaction. You don't have to worry, because what you will ultimately receive from the Indian party is dollar. Right? I am Indian party, you are that US party. What you ultimately receive from me is dollar, and you anyways have dollar. However, if you are a US party, right? So this example was the transaction of home currency. You don't have to worry about home currency. But imagine this situation. Sir, you are in US. I'll give you multiple examples other than India for your comfort. Imagine that you are a US party, your home currency is dollar. You have imported from me. Which means I am that Indian party, rupee. Do you agree your home currency is dollar? But since you have imported from me in rupee, you have to pay to me rupee. From your perspective, think what will happen. You will have to first buy the rupee to pay me. So you need to pay me rupee, which is a foreign currency to you. So you will go to your forex market to buy that rupee. I mean, we will learn forex in this revision lecture, which is so basic that I will also even teach you when do you buy, when do you sell, when do you go to market, how you understand the exchange rates, when you buy something or you sell something, how do you buy that. Everything from the basics you will learn, right? Priyanka, first time learners, you may connect, but for your information, it is preferable for those who have done forex at some point at their own. For you, there is this batch called as power batch, which is a very short duration batch, which is more detailed than this. In around 70 to 80 hours, I guess, broadly 80 hours, entire AFM has been covered. So you should rather opt for power batch, frankly, a genuine guidance. Having said that, this is going to be one of the most detailed revision video on forex. Yes. So sir, people in the class, please be back there. Sir, imagine this time you belong to Japan. Your home currency is yen. You exported something to UK, which means the invoice is in pound. So please try to connect. Sir, you have exported, your home currency is yen, you have exported in pound. The other party will pay you pound. As a Japanese person, you have pound in hands. What will you go? Sir, when you receive those pound against your export, you will go to the forex market to sell the pound so that you can receive your home currency yen. Are you able to connect before going to the forex market? What exactly you gonna do in your forex market? Imagine this time you are a person in Europe. You went to US to borrow. You are someone in Europe. You went to US and borrow, and you borrowed dollar from there. Is it a foreign currency transaction? Yes, sir. Your home currency is euro. You have borrowed from someone dollars, which means you have in your hand dollars. Sir, since you have received that foreign currency dollar, you will go to the forex market to sell the dollars so that you can receive euro and you can use euro in your home country, Europe, home continent, Europe. Similarly, last one, let's make it simple. You are Indian. You want to make the investment in pound, which is pound, UK. Before making the investment, your home currency is rupee, you need to have the pound. So to be able to pay the pound, to be able to invest the pound, you will have to first buy the pounds. In this table, what you have learned, as an importer, exporter, borrower or investor of the foreign currency, You need to pay or receive the foreign currency, which is why you need to first buy or sell that foreign currency. Could you please connect it to what I said? I need a super fast validation. People, speak up. Which means if you realize it is so basic, sir, now going ahead. Then you went to the market because now you are clear with when do I need to buy, when do I need to sell. You went to the market, people in the class, the basics we will pay more attention so that the advanced concept you find easy. At every point, initially people in the class, I would need your validation. If you validate, if you respond, it will be of great help to me for me to understand if I can take it ahead or not. Done? So you are bound to participate in this live class. Yes. Suppose you went to the market, and in the market you see that these were the boards. You went to a shop, you see that on a shop this board was hanging. $1 is equal to rupee 5060. Rupee 50 per dollar, rupee per dollar 50. All three mean the same. All three are the different ways to write. These are the different ways to write down the same thing. What is that thing, sir? It is the rate for every dollar. It is the rate for every dollar. Which means every dollar is how much worth? Sir, it is worth 50 or 60, whatever. Let's now ignore 60. Every dollar is worth 50. But 50 which currency? 50 yen, 50 pound, 50 what? Every dollar is worth 50 rupee. Which means the most important thing, the rate of which currency has been given. Sir, per dollar is this much rupee, which means the rate of dollar is given. The currency whose rate is given is called as base currency, people. Dollar in this case will be called as base currency. And the rate, dollar's rate, the rate of dollar has been given in which currency? It's given in rupee terms. What do I call it? Sir, it is called as price currency. Are you understanding? Rate of dollar has been given in rupee terms. Rupee is called as price currency. And what is the rate of dollar in terms of rupee? Sir, it is 50. It is 50. Are you people clearly understand? Base currency, whose rate has been given. Price currency, the rate like in terms of whom the rate is given, which is rupee, and 50 is the rate. When you see this rate, when you see any given rate, you know what will be the first thing you're gonna do? You're gonna identify the rate has been given for which currency. In other words, you're gonna identify what is the base currency anytime the rate is given, because accordingly your next step gets decided. You're gonna identify what is the base currency, you're gonna identify what is the price currency, and accordingly the next step gets decided. Sir, when a single rate is given, it is called one-way quote. When two such rates are given, they are called as two-way quote. One is bid, another is ask. When I sell dollar, so this rate is given from the perspective of bank or a dealer. Bank is there to earn money. When I go to the bank, when I want to sell a dollar to the bank, this is the rate now. I can sell dollar at this rate. Yeah, the bank will buy dollar at 50 rupee. Meaning to say, when I give them dollar, they pay me 50 rupee. Done. I go to the bank tomorrow. This time I want to buy the dollar. I will buy dollar, they will sell me, but at a higher rate, 60 rupee, meaning to say to get the same dollar, I will have to now pay 60 rupee. When I sold the dollar to the bank, I am a customer. When I sold the dollar to the bank, I received 50, but when I buy the dollar, I'll have to pay 60. This is how the concept of bid-ask work. As a customer, when I buy at higher ask rate. As a customer, when I sell it to the bank, I sell to the bank at a lower rate. Simple, basic thing. Who's this ANR 1205? Hello? Very good morning. I can see you saying me good morning, but I don't know who you are. Realme Pad. What's your name? I can see you also. Come on. Done, sir. Sorted. Now let me directly share with you not the underlying but the rule to convert. Anuka, this is you. Oh my god. Okay. So Underlying logic we discussed in the batch. Directly I'm sharing with you rule, because even if I tell you the logic, we ultimately end up applying rule. What is the rule? Listen to me carefully. Right? Sir, in every question of Forex, you will have to do the first three things that you have learned. Identifying your home currency, figuring out what you want to do to the foreign currency, buy or sell or etc. etc. Next, you're going to compulsory identify in every question, sir, what is the home base currency, what is the price currency. In every question, you're going to compulsorily do this thing, which is converting one currency to another. Meaning to say, now we are actually going to the Forex market. Do you remember? You decided that as an importer, you will buy foreign currency. Go to the market, buy that foreign currency. If you are an Indian, your home currency is rupee, you want to buy dollars. Go to the Forex market. Identify the rate between rupee and dollar, buy dollar. But when you buy something, you will have to pay another thing. So when you buy dollar, obviously you will have to pay rupee. You are now learning, when you buy something, how much do you have to pay? Simple, right? That simple thing is called as conversion. You are basically converting from one currency to another. You are buying dollar but paying rupee. Your rupee gets converted to dollar. Simple, fine. Sir, you wanted to sell. Imagine you are someone in Japan. Right, you have in your pocket yen, but you need to sell pound. You were an exporter, you received the pound, you have pound in your hands. So when you pay pound, go to the Forex market, when you sell pound, you receive yen, which is the another currency. How exactly the amount of yen you will receive, that is what we will learn. Yes, what is the next topic? Are you understanding that when I give another currency, how much, first currency, how much another currency do I receive, is the next thing you are learning, called as conversion. First, listen to me what is happening. Sir, I have been given two-way quote, 50 and 60. Can you identify what is my price currency? Can you all, please, everyone in the class, identify what is my price currency and what is my base currency? Requesting your responses. Sir, rate of dollar has been given. Dollar is the base currency. Rate has been given in terms of rupee. Rupee is the price currency. 50 is the bid rate. 60 is the ask rate. The same rate can also be written as rupee 50 per dollar / rupee 60 per dollar. Bid and ask. Every dollar when I want to sell to the bank is 50. When I want to buy from the bank is 60 rupee. Fine, sir, basic, sorted. Suppose this is the quantity I want to convert. Sir, next question. If it is the rate of dollar that we agree to, the rate of dollar has been given. Using this rate, can we buy sell dollar? Obviously, yes. Using the rate of dollar, can we also buy sell rupee? The answer is yes. That's what we gonna learn. This is where maybe what you have already learned might turn out to be different from what we learn, but once you learn this, your question solving speed and accuracy will increase. Yes, boss? So come on. Sir, with the rate of dollar now, not only I can buy sell dollar, but also I can buy sell rupee. So let's create four possibility. If you buy dollar, what happens? If you sell dollar, what happens? Right? If you buy sell dollar, what happens? If you buy or sell rupee, what happens? Let's learn it. Yes, boss? So come on, let us proceed. When you buy dollar and when you sell dollar, there's a simple thing. Whenever there is a question of conversion, first write down the quantity to be converted. The quantity, the base, what has to happen to that, whatever quantity given, write it down. Now, simple logic is, if the rate of dollar has been given, and you want to buy sell dollar only. Rate, or you can think it otherwise, if you have been given the quantity of dollar and the rate is also dollar, then you need to multiply. However, if you want to buy sell rupee and the rate of dollar has been given, which means rupee is not the base currency, rupee is the price currency, in that case you divide. Yes, let me complete, then ultimately you will realize what is happening. Sir, then you divide. When do you multiply? Quantity dollar, rate dollar, multiply. Quantity dollar, rate dollar, multiply. Quantity rupee to be bought, sold, rupee. But the rate is dollar, you divide. Now, how do you divide? Figuring out the bid ask. Sir, I want to buy dollar. The rate is also of dollar, fine. When I buy, the bank will sell, it will sell me at ask rate. Logical? So 100 quantity, multiply logic, already explained, 60, give me 6,000. Now let's understand what's happening to this 6,000, right? I will in fact go ahead. First let me explain this. Similarly, I want to sell dollar. 100 multiplied by, this much is fine. When I sell dollar, the rate is also given for dollar only, which means the shop where I have gone is the shop of dollar. I want to sell dollar, right? The bank will buy dollar at a rate of 50, so multiplied by 50. Give me 5,000. Now sir, what is this? Observation number 1. When you buy one currency, after multiplying the exchange rate, you have converted that to the another currency, which means when you buy dollar, this quantity is dollar, the another amount will be in the another currency, rupee. First observation. Second, when you buy dollar, the other thing you have to pay. So 6,000 is the amount you pay, is your outflow. Similarly, when you sell dollar, one currency you give. So after conversion, the answer will be in another currency, rupee. And since you are selling dollar, you will receive rupee, that will be your inflow. People in the class, how much out of 10 on this particular thing that I have explained? Super ultra fast, please give me an answer. Please, please, please. Super ultra fast, please give me an answer. Everyone, come on. Literal, how much out of 10 to every single student sitting here? And till this point, if you have not really liked the video, then you know. So let me tell you a small story. In the previous session, there were two students, right? One student liked the video, another student didn't like it. The first student secured exemption, another student could not pass the exam. I don't want to tell anything about you, I'm just sharing what happened. Well, jokes apart. Point is, I'm not asking you to like or dislike, just wanted to share a small story with you. What happened with these two people? Well, are you all people set? So I would request, there are some people maybe who are live but lagging behind in this video. Kindly drag your, what is that thing called as, red dot on the YouTube screen to the latest point so that you can connect to me live. Yes, boss? So come, people. Sir, now, can I buy or sell rupee with the rate of dollar? Yes, even if the rupee is price currency, you can buy, sell. What is the point? Listen to me. Sir, first write down the quantity. Quantity is rupee, rate is dollar, you divide. Now let's learn to think about multiply, divide. Bid ask. I want to buy rupee. When I went to that shop that I want to buy rupee, he literally slapped me. I have his fingers printed on my face. He literally slapped me. Why? Because you want to buy rupee. Can you go to buy milk on a on a jewelry shop? When the shop is of dollar, can you go to that shop to buy rupee? Sir, I can go, but I cannot tell him that. I cannot tell him that I want to buy rupee. Since the rate is of dollar, you will have to think in terms of dollar. You want to buy rupee, but you know that it is the shop of dollar. So in your brain, you will be like, I want to buy rupee. It is equivalent to paying dollar or selling dollar. So to him, I will say, I want to sell dollar. What is the rate? Now he is okay. When you want to sell dollar, he will buy it, and at a price of 50, he will buy. At a price of 50, he will buy. Similarly, you want to sell rupee. When you went to him, you remember that red color is still there here. When you want to sell rupee, you went to him, but this time you didn't tell him that I want to sell rupee. You saw that it is dollar shop. I have to speak in terms of dollar. I can buy, sell rupee at a dollar shop, but don't tell him. You want to sell rupee, it is equivalent to buying a dollar. When you buy a dollar, the bank or the dealer will sell it at a price of 60. So that's how rupee can also be bought, sold using dollars rate. And you can find out when you buy rupee, how much dollar you have to pay. When you sell rupee, how much dollar will you receive. This is a perfect thing. I want to tell you. In every question you guess. So in conclusion, this is a still rupee dollar. Let's think about AB. If you understand AB, you will understand everything. People, the rate of A by B is given, which means B is my base currency, A is price currency. Right? Any two currency A and B are given. A price currency, B base currency. X is the bid rate, Y is the ask rate. Sir, I want to buy B. First of all, using this rate, I can buy and sell B. I can also buy and sell A. First logic. If I want to buy and sell B, rate of B is given, I multiply to the quantity. I want to buy and sell A, rate of B has been given. A is the price currency, not the base currency, you divide. First. Second, thinking about the bid ask. I want to buy B, rate is of B, I buy, other party sell, ask, rate Y. This one. Sir, I want to sell B. I sell B, the rate is of B, other party buy, they buy at bid. The bank buy at bid. I want to buy A, but shop is of dollar, which is why I will tell him that I don't want to buy A, I want to sell B. Think in terms of B. Whenever you decide bid ask, think in terms of base currency. That to the base currency, what do you want to do? Because it is the rate of base currency which is given. You are buying, selling price currency, currency A is fine, but think in terms of base currency is the final word. I want to buy A, but is it equivalent to selling B? When I sell B, the bank buy at bid, which is X rate. When I sell A, it is like equivalent to buying B. When I buy B, the other party sell B at an ask rate Y. Are you people 100% clear with the conversion? That how can I buy, sell one currency using a given rate and figure out the inflow outflow of another currency is the conclusion of this particular topic that you have learned. Come on. Super ultra fast everyone in the class, super ultra fast. Now I'm teaching you one particular thing. It may be of use in the entire forex or may not be even of use, rare possibility of being used. Still, I want you all to just know it on a lighter note once. People, when I have been given the rate of rupee per dollar, can I invert it to convert it to the rate of dollar per rupee? That's what we're going to now learn. Yes, before I proceed ahead, are you people, every single student watching of this video, are you people settled with what we've learned? Sir, of whatever we have learned so far, before taking ahead, I'll just make you solve one particular question, just one particular question. For you people to understand that, okay sir, whatever you have taught to us, how would you apply that particular thing in any given question? So let's say given is, there's an American importer who has payable euro 40 lakh. How much is the liability in dollar? Sir, common sense. I have imported something. Now let me try to teach you how do you crack a question. There is an American importer. When they say American, it should click to my mind that okay, someone lives in America, his home currency is dollar. Fine. When he imports, as an American person, if he import, he will have to pay the another currency. Sir, he has payable euro 40,000. Do you realize for an American person, if he has to pay euro become his foreign currency. And to be able to pay the euro, what will he do in the forex market? Sir, he will buy euro in the forex market. What do we need to primarily learn? That in the forex market, what you will do? I need to pay him euro, fine. But if I go to the forex market, I will buy euro. To be able to buy these 40,000 euro, I will have to pay from my pocket the another currency, which is my home currency, dollar. Agreed? This is how you crack any given question in forex. Right? Sir, so let's buy 40,000 euro and pay dollar, which means I need a rate between euro and dollar. I went to market. I want to buy euro 40,000. First, write down the quantity. Second, quantity euro, rate euro means multiply. Third, sir, and this is right now taking time. After you learn, it will be a matter of few seconds. Immediately, euro multiply. I want to buy euro, rate is of euro. The bank will sell, it will sell at ask 1.515. So 40,000 into this number will give me the quantity of dollar that I will have to pay to be able to buy those euro. This is how you apply it. There are certain other things as well. If you want to build a comfort over such things, I would suggest you to once solve one or two more illustration. If you are able to correctly solve two, any two that you attempt, fine. But if you are not able to solve the first two, then you must solve all four of them. Because if we don't understand this, then we can't understand the chapter of Forex ahead. Simple. I mean, you may find it rude, but this is so basic that you cannot miss it. If you are making any mistake here, you will have to go back to the basic, learn from the scratch the thought process that I need to first of all identify who I am, what do I need to do in the Forex market. Then when you go to the Forex market, what is base, what is price, what is bid, what is ask, and then ultimately convert and figure out the inflow of another currency, this part. Taking you all ahead. Sir, invert. Frankly, you won't be needed to do much of inversion, but on a lighter note, you need to learn. If I have rupee per $50, can I invert it? Simple. If you want to make it dollar per rupee, invert this and invert this. Invert the RHS, invert the RHS. So rupee per dollar is 50, so dollar per rupee is 1 by 50, which is 0.02. Similarly, it was one-way quote. If it is two-way quote, rupee per dollar is 50 and 55. So what is dollar per rupee? Please now pay attention. You might think it is 1 divided by 50 and 1 divided by 55, right? No. To be able to calculate the bid rate, which is inverted one, you do 1 divided by the ask rate, which is 1 divided by 55, and it is 1 divided by 50. The bid rate you will have to take of the original rate to convert the ask rate of the inverted rate. To be able to calculate the dollar per rupee, you will have to do 1 by 50 for ask and 1 divided by 55 for bid. Are you able to connect? You will have to do the inversion cross, is what I'm saying. Simply. Yes, boss. Taking you all ahead. Now, sir, we need to learn the simple concept of exchange margin. Really simple. There are two types of market. One where a bank does the transaction with the customer, called as merchant market. The rate, the exchange rates for the purpose of buying, selling, converting, that prevails in the merchant market is merchant rate. Then me as a bank, I have one more market where I can do the transaction of buying, selling with other banks in the market. It is like a wholesale market, kind of. I can do the buying, selling with other banks in the market. That market is interbank market, and then the rate that prevails in the interbank rate, in that market are interbank rates. Now, sir, first I have the interbank rates. That in the interbank rate, if I buy something, see, I am a bank, but in the interbank market, for that moment, I become a customer. Because when I go to the other bank to buy something, for that moment I become a customer, that other bank become the bank or the dealer. So bid ask is quoted from his perspective, not my perspective. When I go to the other bank to buy something, he will sell me, but he will sell me at ask rate. So interbank has a bid and ask. When I go to the bank, I want to sell something, he will buy, but he will buy at a bid rate. Logic? So bid and ask interbank has. If you come to me for any transaction, I don't quote you the same rate. That is a wholesale market, you are a retail or a merchant market to me, your rates will be different. So if I have the interbank rate, can I calculate the merchant rate applicable between you and me? Really simple. Sir, when I buy something at 55, when other party sell to me at 55 at an ask rate, I will sell it to you at further ask rate, but I would want to earn something, which is why I will add my profit margin called as exchange margin and sell it to you maybe at 58. So to the interbank ask, if you add margin, you get merchant ask. Similarly, I can sell to any other bank the dollar at 50. Apply your logic. What is the rate at which I will purchase that dollar from you? Is it 52? Does it make sense to buy dollar from you at 52 rupee and sell it for 50? No. I will buy it to you at a rate lower than 50, so that when I buy from you at 48, I will be able to sell it in the intermarket at 50. So if I know that interbank rate is 50, then the merchant rate at which I will buy from you, the bid rate, the rate at which dealer buy from the customer, the bid rate, will be lower than the merchant bid, which is why I will have to deduct the exchange margin and I get merchant bid. Boss, in conclusion, in conclusion, do you know what happens? I will do that. Thank you so much for your feedback. This is who? This is who? Might guy. So sir, did we all understand that if I have interbank bid ask, I'll have to add margin to the ask rate to find out merchant ask. I need to deduct margin from the ask rate, bid rate to find merchant bid. Yes, so whenever a transaction between customer and the bank, merchant rate. Transaction between bank and the bank, interbank rate. Right. So as I said, in Forex there won't be anything out of the box. But the small things that you need to apply, for example, deciding between deduct margin, exchange margin or add exchange margin. The difference between maybe figuring out the divide or multiply, the difference between figuring out the bid rate or the ask rate, the difference between maybe the mistake of figuring out whether I need to buy the foreign currency or sell the foreign currency. These are small things you need to remember and take care while doing a practical question. I'm now going to teach you one more thing. It is actually more than logic, the point of ambiguity which certain question will have. Sir, when I have to say rupee, when I have to say $1 is equal to rupee 90 at present, one simple way to present it is rupee per dollar. Yes sir, obviously, basic thing. One simple way to present is rupee per dollar. Agreed, fine. Another way to present is dollar, people in the class, is referred as USD, US dollar. Rupee is referred as INR. These three alphabetical presentation of any currency are called as Swift code. For example, yen is JPY, for example, euro is EUR, pound is GBP. This way, this is ISO code. So $1 is equal to 50 rupees, symbolically represented at rupee per dollar as 50, whereas the same thing when it is presented using ISO code, it is USD per INR is equal to 50, or maybe USD INR 50. That's how they present it. At a point you might find it shocking that, sir, USD per INR 50, how can 1 rupee is equal to $50? How can 1 rupee have $50 in it? Yes. So when you see a 3-digit alphabetical presentation like this, you should immediately convert it to the symbolic presentation so that you don't end up making the mistake of doing solution incorrect. Imagine you know the entire concept. You applied some high level technical concept and at the end you realize that something which was supposed to be assumed as rupee per dollar, you have assumed that dollar per rupee. You have changed the base currency itself will make the entire solution incorrect. So when you see 50, you should apply your common sense that it cannot be dollar per rupee. It has to be rupee per dollar and accordingly write symbolically and solve it. Sir, does it mean that every time institute give you USD INR, I have to understand it at rupee per dollar? No. Now the ambiguity start. Examiners say USD INR, right? They will say USD INR and they will say, for example, 50. When they say 50, so you can crack it at your own that these are ISO code, so they have to be converted to symbolic, which means I have to call it them rupee per dollar. Because you have to realize that in ISO code presentation, the base currency comes in the start. When I say rupee per dollar, dollar is the base currency that is being written first. When I say 1 pound is equal to 300 yen, rate of pound is given, pound is the base currency that is written down first. So when I see USD INR, so I have to realize the base currency is dollar. Fine, this is logic. But the ambiguity is that examiners say USD INR is equal to 0.013. So now you're like, they are looking like ISO, you convert it to symbolic, so you end up writing them rupee per dollar 0.013. Now please tell me, Can $1 have so less rupee in it? 0.013, or it has 90, 80, 90 rupee in it, 80, 90, which means even if it looks like ISO, don't consider it ISO, ignore the logic of ISO, do a normal assumption, take it dollar per rupee, even if that interpretation is logically incorrect. But sir, 0.013 is only dollar per rupee possible, rupee per dollar not possible. Can I teach you? When you see the Swift code, don't directly blindly convert it to the symbolic code by considering dollar as base currency and INR as price currency. Rather, look at the number and then figure out how should it be. Should it be rupee per dollar or dollar per rupee? That's what I wanted to teach to you, right? Everything that I spoke has been written here. But sir, how do we have to, like, how can we identify all such currencies? Very simple. Primarily, the famous currencies, at least you should know the sequence. GBP is the most valuable currency. I'm talking about the common currencies. 1 GBP has more number of euro or dollar. Between euro and dollar, it is not clear, right? Because practically it is something else, but in AFM it is something else. In $1 there will be more rupee, in 1 rupee there will be more number of yen. That's how you can always figure out what the given rate is. So all the live people, all the recorded people, it was all about interpreting the things. Are you people clear? Before I take you ahead to again one of the most important thing that we're gonna now do. Come on. I need this validation from every single student sitting here watching it up. Come on. Okay, just give me a minute. Yes, people. Back. There are we all. Yes. Set are we 100%. Now let me teach you something really interesting. It is generally it is not being taught as a particular concept, but I feel that since it's a part of every question, where a student can make a mistake in it, why don't we make it an official concept and teach it? Yes. So that's we gonna do in this discussion now. So learning to calculate gain loss. Sir, how would the gain loss happen? Imagine I am an Indian person. If I buy dollar and if I sell dollar, will I not have a gain loss? Sir, imagine you buy a share of TCS and sell it. Is there a gain loss on that transaction? Yes. Very similarly, when you buy dollar, please imagine when you buy dollar, there is an outflow of rupee. When you sell rupee, there is an inflow of rupee. And inflow minus outflow is simply the gain loss which I am talking about. There are more variations, but at least the most easy one. Sir, I am someone in US My home currency is dollar. Imagine I am buying yen. When I buy yen, my home currency dollar, I will have to pay. There is an outflow. I am applying the basic conversion rule. When I buy one currency, I have to pay another currency, dollar outflow. When I sell yen, I have dollar inflow, and dollar inflow minus dollar outflow is the gain loss that I am talking about. That's what I have taught to you even in the derivatives, right? So informing it to everyone, this is just one video you're watching. There are other videos as well for other chapters of similar type. In the description of this video, I'll give you the list of the playlist. Link of the playlist. Sorry. Done? Sir, so now you bought $10,000. Let me teach you two situations and make you people realize a very important thing in it. You bought $10,000 at rupee per $65 and sold it for rupee per $68. What is the gain loss? I told you even in the derivative. Gain loss is never a rocket science. Inflow minus outflow is the thing. For example, let's imagine, when do you have inflow? When you sell something. Sir, I sold something. I sold $10,000 at rupee per $68. Let's apply the basic conversion rule. Quantity is 10,000. Yes, sir, 10,000. Sorry, 10,000. Sir, rate is dollar. Quantity is dollar. Multiply. Quantity multiplied by 68. There is no bid ask. So when I sell dollar at a rate of rupee per $68, what do I have as my inflow? 10,000 into 68 is 6,80,000. Yes, sir, sorted. Which currency? Rupee. Needless to mention rupee. When you sell one currency, what you receive is another currency. Fine. Sir, now I need to talk about outflow. The rate at which I bought. $10,000 were bought at rupee per $65. Again, quantity dollar, rate dollar. So 10,000 multiplied by 65 give me 6,50,000 rupee of outflow. Fine, sir, basic. Sir, 680 inflow. I received 680 rupee, but I paid 650 rupee. The difference of 30,000, which is a positive number, is a gain to me in rupee terms. What have you learned? When you sell something, you have inflow of another currency. When you buy one currency, you have an outflow of another currency. Inflow minus outflow is the gain loss, but in the same currency in which inflow outflow were. Which means when you buy or sell dollar, the gain loss will not be in dollar. Obviously, the gain loss will be in another currency, which is rupee. The entire thing can also be done on a per unit basis rather than totality. Think of a single unit inflow outflow. Every dollar when I sell, rupee 68 is my inflow. That one particular dollar when I buy, rupee 65 is my outflow. I buy dollar, I have to pay 65 rupee. So this is the amount of gain. 3 rupees is the amount of gain I have on every dollar. So on $10,000, how much is the amount of gain? Rupee 30,000. Even this is fine. You can also think it mathematically. 10,000 when you take common mathematically here. 10,000 when you take common mathematically, you are left in the bracket with 68 minus 65, rupee 30,000 gain. My point to you all is what? Listen to me. This was an easy one. Sir, which one to prefer in exam? Per unit. In most of these question institute does per unit and not totality is what the first thing you need to understand. Please listen to me. The second thing. People, the second thing, please. Sir, you bought $10,000 at a rate dollar per rupee this and sold those $10,000 at a rate dollar per rupee this. Sir, can you please identify the difference between situation 1 and 2 is my most important question. Come on, identify the difference. Sir, here quantity of dollar is being bought sold where dollar's rate is given. Out here, quantity of dollar is being bought sold, rate of rupee has been given. Sir, you said you can buy sell. Sir, you said so. I am saying you can buy sell, but listen to me. Let's think of gross. Go to market, sell, take $10,000 in hand, sell it at the rate dollar per rupee 0.017. First, if I talk about inflow, dollar I write, quantity of dollar, rate of rupee, divide. Sir, I sold it at a rate of 0.017. This become my overall inflow. Fine. Let's talk about outflow. When I buy dollar, I have an outflow. Quantity of dollar, since rate of rupee and quantity of dollar I divide, and buying rate is 0.015. I mean, I have not been given the bid and ask. I have only one rate given. So when you buy something, this is the rate you use, and when you went to the sales, when you went to sell the same thing, you will have to use the rate, that rate. Simple. No bid ask, one way code. Fine. Sir, if you calculate the gain loss, again the same story. When you sell dollar, ultimately you will have rupee inflow. When you buy dollar, ultimately you will have the rupee outflow, and my final gain loss will be in rupee only. If the inflow is less, outflow is more. If the answer is negative, then it is a loss to me. Agreed. Sir, can I do the same thing on a per unit basis? Think mathematically. Here you could do 68 minus 65. Can you do 0.017 minus 0.015? The answer is no, because mathematically it's not happening. If you take 10,000 common, what you are left is not 0.017 minus 0.05. What you are rather left is 1 divided by 0.017 minus 1 divided by 0.015. That's how it is happening. Not saying it is impossible to do, but it does not make any sense to do such thing, because this doesn't have an interpretation. This has an interpretation, this does not have. Meaning to say, where will you go wrong in the exam? Let me now explain that. You will have 90% question of this type, where we gonna prefer per unit. We gonna do 68 minus 65 into 10,000. On a random day, one particular question of this category will come up, where quantity being bought sold dollar, but the rate being given as rupee. Now in that random question, since we are used to of this habit, we'll end up making that mistake. Okay, 0.017 minus 0.015. No boss. Please try to observe, it cannot happen on per unit basis. It is a case of division. You will have to do it on totality basis only and calculate the gain loss. Could I explain to you all what I was actually trying to explain? Please tell me, waiting for your responses. Could I explain what I was actually trying to explain? Come on, everyone in the class. Yes, people. Since I know that there are a lot of students making mistake in this particular thing, which is why we have specifically made it a concept that, okay, this one you prefer. But every time, each and every time, listen to my words, mark them. Each and every time when you do a gain loss calculation, you will have to consciously ask yourself a question. Boss, is it a per unit or a totality case? If this is the scenario, you do per unit. If this is the scenario, you do totality, is what you will have to remember. One more thing. Forex will not have anything out of the box. But those small things you will have to remember for each and every question. Sir, taking you to the next discussion, cross rate. Right? This is specifically something which you all might have learned to do in some other way, and I may teach it to do in some other way. At first, you may find it different or difficult, but once you are habitual, it will save significant amount of time and efforts to do cross currency. Right? Sir, what it is, let me tell you. Sir, if I have rupee per dollar and dollar per pound rate, I need to buy pound, but if I have rupee, so do you agree for that I either need rupee per pound or pound per rupee, one of the two rates, which I don't have. So using the two currency, if in those two currency, if there's something common like dollar, can I eliminate dollar and find an exchange rate using the other two currency, which is rupee and pound? The answer is yes. This is called as cross currency calculation. Using the two currency, when you have a common currency, you eliminate that common currency and the other two currency you use to calculate a third rate. Now sir, taking you ahead, please listen to me. Fine. The basics, I don't mind spending time, but I know these basics if you learn the question solving with speed up, right? So watch it with your best effort, these basics at least, so that the application of them in the practical question when we go become really smooth. Right, sir? This chart on this page is the most comprehensive chart. Beyond this situation, you will never have a situation of cross currency in the exam. That is what I want to tell you. If you undo this page, then any situation of cross currency you will be able to do. Yes, sir, teach us how. Let's think A by B, B by C. Because dollar, yen, dollar, rupee is comfortable. If it A by B, B by C, then you can do any currency. Sir, if I have been given one exchange rate as A by B, the rate of which is X. If I have been given another exchange rate B by C, the rate of which is Y. Can I calculate using this rate either A by C or C by A? Yes, because B is the common currency, can be eliminated. Think mathematically, if I have to eliminate it, if I multiply the two things, will I be able to eliminate B? Yes, sir. A by B, if you multiply LHS into B by C, you also multiply RHS, which is X into Y. When I do this, B to B gets cancelled and I automatically get A by C, the answer of which is X into Y. Suppose A by B is 50 and B by C is 1.2. So A by C become 1.2 into 50, which is 60. Simple? Fine, sir. Sir, if I have been given A by B and C by B, again, but the difference is this time both the B's are base currency. The rate is X and Y. You know that if you multiply, sir, it will be B square in the denominator, which means the multiplication will not work. Which means now I'll have to do what? I will have to divide to cancel it. Now division has a problem. See, if I have two rates, one rate is A and C. Rate 1 and rate 2, if I have two rates, multiplying is fine because 1 by 2 or 2 by 1, it is the same answer. But division has a problem. 1 by 2 is a different thing, 2 by 1 is a different thing. So I will have to learn that what exactly to be divided with what. Should I make this rate as the numerator and divide it with the denominator rate? Or should I make this as the numerator and divide it with the denominator rate? I'll have to choose one, is what I'm saying. Getting I all? I'll have to choose one. Sir, how do you choose? I was not inclined to tell you something really deriving behind it, but let me tell you. Let me do it once for you so that you get what my point is. Hold on for a minute. Let me find out that particular page if I can for you. Come on, I got it. Thank God. Thank God. Sir, let's say, we'll take 2 more minutes, but once you understand this, it'll be 100% clear to you. Listen to my thing very carefully. A by B is X. C by B is Y. Suppose I want to calculate A by C, but I am not able to figure out whether I should keep this one as numerator or I should keep the other rate as numerator. I am not able to figure out. So let's do it once both the ways. Let me make first this one the numerator and this one the denominator, which is A by B divided by C by B. Mathematically, when you solve it, listen to me, in a very few minutes I'll do it. When you mathematically solve it, it remains A by B. The numerator rate remain as it is, but the denominator rate gets inversed. So it's like A by B multiplied by B by C. You can convert this division sign to multiplication and do the inverse of the denominator rate, it becomes B by C. So B to B gets cancelled and what you're left is A by C. So now I got it. If I make this one the numerator and this one the denominator, what I get as my final answer is A by C. However, let's once try to make this particular rate as numerator and this particular rate as denominator, which is C by B whole divided by A by B. So it's like C by B, the rate in the numerator continue to remain as it is, but the rate in the denominator become inversed when you multiply, when you convert the division sign to the multiplication. So B to B get cancelled and what I'm left with ultimately is C by A, meaning to say if I keep this as numerator, then final answer is going, if this as denominator, then final answer is going to be C by A. So just by looking at this, were you able to figure out that if I need A by C, what should I do? No, it is only by trial it will happen. This is what we think now. Or if I have to calculate C by A, what should I do? So let me teach to you a trick to think. Once you learn this trick, any calculation of cross currency will be a matter of few seconds for you to do. Few seconds. Listen to me carefully. Sir, do you agree? Whichever rate you decide to keep in the numerator. Suppose I decide to keep A by B in the numerator. So sir, B is a common currency. In the final rate, B won't be there, it will get eliminated. But this numerator rate, if you observe, B will get eliminated. But A, which is in the price currency, continue to remain as it is. There is no inverse or nothing to the numerator rate. Everything happens only to the denominator rate. Sir, in this rate, B gets eliminated. But A is the price currency, ultimately travel to the end in the form of price currency. So if A is the price currency, then automatically C will become the base currency. So only by looking at it now I can say that, okay, if this becomes the numerator, B will not persist. B will not be there, sustain, it will not sustain. But A, which is the price currency in this numerator rate, will ultimately become the price currency in the final rate. Which means if I make this as numerator, I'll get A by C as my answer. Similarly, if you make this as numerator, you should now be able to connect that, sir, B, which is a common currency, will get eliminated. But C, which is a price currency right now, will ultimately become the price currency even in the final rate, which means I will get C by A if I keep this as numerator and this as denominator. Are you able to have the thought process which I wanted to teach? Everyone in the class, requesting your responses. Please come on, super fast. The underlying thought process is what you have, if learnt, is going to help you to solve every situation. Let me show that to you. If I have been given A by B and C by B, X and Y, I know multiply won't work. Then I need to divide. Sir, if I keep, in your brain think, if I keep this as numerator, B will not sustain. But A, which is the price currency, will also be the price currency in the final answer, so I'll get A by C. Do I need A by C? Yes, you're thinking it correctly. Make this numerator, make this denominator, which means do X by Y will be the final answer of A by C. Sir, using this rate, if I need C by A, let's suppose I by mistake take this as numerator in my brain. So I know B will not sustain. But I know final answer, A is price currency, final answer will continue to remain A by C, because A is my price currency, will continue to remain price currency in the numerator rate. A is price currency, final answer again A is the price currency. Do I need A by C? No, I need C by A. Don't worry, take a moment, do it. Otherwise, this time make this numerator, make this denominator, it will happen. C is the price currency, it will continue to remain price currency, which means A will become base currency. This is what I need. So Y by X is the answer to C by A. Could you all please, everyone, connect to it? Let me teach you even this situation. This time both the B's are price currency. This time both the B's are price currency. B by A, B by C, X and Y. I know if I multiply, it will become B square, so I need to divide. When I divide, boss, listen to me carefully. When I divide, what do I divide with what? Common sense. Sir, let's make this numerator. Listen to my line carefully. Let's make this numerator. Till the final answer, B won't be there. B will get eliminated. But A, in the numerator rate, please observe, if A is the base currency, then even in the final answer, A will continue to remain base currency, which means C will become price currency. So if I make this numerator and this denominator, final answer will be C by A. Do I need C by A? No, I need A by C. So don't worry, make it otherwise. Make this as numerator and this as denominator. If I do so, B will not sustain, will not survive. C will become price currency. Yes, because numerator rate as it is gets followed, C become price currency, means A become base currency, and that is what I need. So Y divided by X is the answer. Yes, boss. Similarly, if I need C by A, Let's make this as numerator and this as denominator. Try it. B gets cancelled. A. In the numerator, rate A is the base currency. In the final, rate A will be base currency, means C will be the price currency. That is what I need. X divided by Y is the answer. Could I, people in the class, really teach you how do you very quickly decide? Multiply is sorted. Multiply anything with anything. Division, what is to be divided with what to get the correct rate is what I'm asking. Are you people clear? I'll try to teach you one illustration of this and you will be all set. Come on. Every single live student sitting here, could you understand it? Come on, tell me. People in the class. Shall we proceed? Sir, let me take you to an example of it. I have been given, listen to me, don't look at the answer, listen to me. I have been given dollar per pound 1.5 and dollar per yen 0.095. I have been asked to calculate yen per pound. First think of multiply. Will the multiply eliminate dollar? No, it will rather make it squared. Then what do I do? Sir, let's try to think divide. Take any random rate. Sir, for a divide, let me assume this as numerator and this as denominator. Do you agree dollar being a common currency will not be there till the final answer? But in this numerator rate, pound, which is the base currency, in the final answer also it will become the base currency. And that is what I need, which means what you're thinking is correct. Make this numerator, make this denominator, solve it. 1.5 divided by 0.095 will be the answer of yen per pound. Hello? If the examiner asks me to calculate pound per yen in this case, suppose I make this as numerator. So I know that final answer base currency is pound, but that is what not I need. So no worries, make this numerator and think again. Sir, pound dollar gets cancelled, but the base currency is going to be yen, and that is what, sir, I need. Pound per yen is what I need. Think incorrectly, make it numerator, make it denominator, solve it, will be the answer. That's simple. The cross currency has become. Yes, boss, really that simple. I know some student used to do it some other way. They first convert this rate to 1 divided by 0.0095 kind of, then multiply the two things. Different people have different ways of teaching it. The one which I found to be really easy, I'm teaching you that way. Just a small feedback. Those who have taken my classes, obviously you do the same way. But others, is it the same way? You had learnt it earlier or some different way? Come on, tell me. Is it the same way or some different way? Sir, now I have to teach you one more thing. People, so far you were learning one-way code. Only XY, XY, XY. This rate, one code, this rate, one code. No bid ask. This time I want to teach you, suppose I have been given A by B, rate is X and Y. B by C is given, rate is bid is P, ask is Q. In that case, sir, what do you do? So I know to calculate A by C, I need to multiply. B to B get cancelled, I am left with A by C. Basic common sense. Bid gets multiplied with bid, X multiplied with P. Ask rate gets multiplied with the ask rate, Y gets multiplied with Q. This is my bid, this is my ask. Fine, sir? Fine. Sir, one more thing to teach. If I multiply the two, I get A by C. If I need to calculate C by A, what do I do? What do I do? Inverse. Using multiplication when B gets eliminated, you will always get A by C only. If you need C by A, don't think that, okay, now let me divide. If B has got eliminated, which means the multiplication was correct, you just need to now inverse it to calculate C by A, and you know inverse. 1 divided by ask rate will give you bid rate, and 1 divided by bid rate will give you ask rate. So you have to do the inverse and crosses what you already know. Logic? Cool, fine, next. Sir, I've been given A by C, A by B and C by B, right? This is rate number 1, this is rate number 2. If I need to calculate A by C, what will be your numerator rate? 1 or 2 is my question to you all. I need to calculate A by C. What will be your numerator rate? 1 or 2? Tell me. People, think. Sir, 1 will be the numerator rate because B gets eliminated. A price currency continue to remain price. That's what I want. 1 become numerator rate. So please now learn one particular thing. A by B become the numerator rate. So sir, whatever is the numerator rate, the bid and ask of numerator rate gets followed as it is. Means X become the numerator rate, right? Sorry, X is the bid rate, Y is the ask rate. Fine. Now you know C by B is to be divided, but the division happen in cross. X gets divided with Q, X gets divided with Q, Y, which is the ask rate, gets divided with P, which is the bid rate, which means the denominator rate go to the cross, the numerator rate continue to gets followed as it is. So to calculate A by C, I need to make it numerator, make it denominator, XY bid ask remains same, Q and P it become. So finally this is the answer of bid and this is the answer of ask. Simply what you had to learn is to do cross. Yes, sir, if I have been given B by A and B by C, if I need to calculate A by C, I can see that B ultimately gets cancelled. Base currency will be A or C. What do you want? I want the base currency to be C. So, sir, let's make this as numerator. So that B gets cancelled and base currency C. So this become denominator. The bid ask of numerator as it is gets followed. P bid become bid. Q ask remain ask. Bid remain bid, ask remain ask. But the denominator rate gets crossed, which means for B by A rate, X goes here, Y goes here. So P divided by Y and Q divided by ask become the bid and ask rate of A by C. My request to you all, how much out of 10 are you people clear? Come on, tell me. How much out of 10 are you people clear? The way you have done it for A by C for these two situations, please solve it for C by A in the next 10 seconds at your own in the class right now. Solve it for C by A at your own in the class right now. And give me a second and then I take you to something on which the examiner is going to ask you the practical questions. Done it. Easy, basic, sorted. So boss, now finally we're gonna learn the first topic on which institute asks you the practical question. Whatever things you have read so far was not a particular practical question, but in a given practical question they were going to be all used. Now you're gonna solve a particular question, you're gonna learn a particular concept based on which a particular question will do, right? So finally, let's get started and figure out whatever basics we have learned. How do you apply all of them collectively to a single question? Sir, transactions to cover a square of a position. Sir, I want to cover a position, I want to square off a position. In both the case, what do you do? So imagine I have a long position in any asset. In the derivatives or in the portfolio management, now you know what a long position is. Sir, when I buy a calculator, it's with me, it is my long position. When I have sold a calculator, I don't have any calculator as of now, but I have sold it. I was zero, but after selling, I have become negative. That is a short position. The way you are imagining anything for this calculator, imagine it for dollars. I don't have anything. If I buy dollar, that is my long position in the dollar. I don't have anything, but I sell dollar, that is my short position in the dollar. So if you already have a long position or if you already have a short position, how do you square off a position? Sir, such a common sense. I didn't have anything. I bought a dollar, now I have a long position. What do I do to square off? To cancel, to nullify, to make myself zero. Sell this dollar. If you have the dollar, if you have the long position, go to the market, sell it off. That simple is the case. Similarly, if I have already sold something, I have a short position, how to nullify it? Sir, buy it back. Buying will nullify, or buying will square off the transaction. That simple is the thing, right? So by squaring off a transaction, to square off a transaction, I have to take this action. After taking this action, you know that long position means I bought at a particular rate, now I'm selling it. Similarly, short position is I sold at a particular rate, now I'm buying it. If you observe, whenever you sell something, you have inflow. Whenever you buy something, you have outflow. And inflow minus outflow is the gain loss. You have learned, people in the class, this question is specifically asked you to calculate the gain loss on this transaction. Yes, sir, what I have taught to you for square off, exactly same applies to cover. Cover means the same thing. Let's not go into the detailing. Sir, when I have a long position, to cover it up, I will go to the market to sell it off. I have a short position, to cover it up, I will buy it in the market. That simple is the thing. Fine. Not going into the detail of it, gain loss calculation you know. Let's immediately solve a practical question of this type. Finally it gets interesting. Sir, question 4th is the first comprehensive question we do, right? Although the question has not been asked multiple times in the exam, but it teaches you something also. It is from the study material, so let's immediately solve it. People, what it says, right? Your forex dealer entered into cross currency deal, had sold USD 10 lakh against euro at $1 is equal to euro 1.44 for a spot delivery. Sir, read the line again, quick, read the line again. Entered cross currency deal, I don't know why has that been written, had sold USD. Sir, what is the currency being sold? What is the quantity being sold? USD has been sold. Sir, my position is short. And when I sold that, what is the other currency I received? Euro. The rate has been given $1 is equal to euro 1.44, which means euro per dollar is the rate. Meaning to say dollar is the base currency, euro is the price currency. In the spot market, I did this transaction. You remember the derivative spot market where the asset gets traded, derivative market where forward future option gets traded. So in the spot market means I didn't sell the forward contract, I sold the dollar itself. Fine. Later during the day, market became volatile and I had to square up the position. Apply common sense and tell me, I sold $10,000 somewhere. My position is short. I need to square off the transaction. What will I do? Sir, buy those dollars, you will get squared off. And when I go to buy it, against which currency will I buy? Sir, you sold it against euro at the rate of euro per dollar. Now you buy it back again against euro. You wanted to buy, to square up, buy it again euro only. Fine. So I went to the market to see, ignore these rates in the red bracket. All you need to see is this and this, right? I went to the market to see USD1 is equal to INR 31.43 and 31.45. Listen to the interpretation of this. 31.43/45 does not mean it is 31.43 and 45.00. It is like 31.4300 and 31.4500 as bid and ask. Similarly, 1.440 bid and 1.4450 ask. Cool, sir. So I have been given $1 is equal to rupee. This means it is the rate of dollar. Dollar become base currency, rupee per dollar. Similarly, $1 is equal to euro. So euro per dollar. When I sold dollar against euro, I will buy it back against euro only and not rupee. Can you please choose one particular rate that will be used for the purpose of buying the dollar? Please. Among bid and ask, can you choose? Sir, I want to buy dollar. Rate is also of dollar. When I buy, the other party sell it. The other party sell it at ask rate. So 114450 is the rate at which I will buy. Agreed? I will buy. Sir, what will be the gain loss on the transaction? Really simple question. I buy dollar at this rate. I sell dollar. I have already sold a dollar at this rate. And inflow minus outflow give me gain loss. Let's start to apply the brain. Sir, before calculating the gain loss, one particular thing you all need to always think. What was that? Figuring out whether it is a situation 1 where per unit should happen or it is situation 2 where totality should happen. Sir, quantity being bought and sold is dollar. Rate is also of dollar. I can do per unit. It is all fine, absolutely okay. So let's do per unit. Yes, this is who? Satyesh Chaudhary. Thank you. I mean randomly thank you. Why? Let's people in the class do per unit totality thought. Sir, per unit can happen, right? Quantity dollar, rate is of dollar. So let's think per unit inflow outflow. Sir, when I sell dollar, I have inflow of 1.44 euro. Common sense. When you sell one currency, you receive another currency. 1.44 euro inflow. When I buy dollar, I will have to pay euro 1.440. So selling gives me inflow, buying gives me outflow. Net is the gain loss. Everyone in the class, 1.4400 minus 1.4450. Give me 0.005 is the per unit gain loss. Multiplied by the quantity of 10 lakhs give me, sir, most importantly, 5,000 as the answer. But in which currency? Euro as my loss. Since the answer is negative, 5,000 euro is the loss. Inflows, outflows were in euro. Final gain loss will be in euro. This much question are you people 10 out of 10 set? Easy, basic. You taught everything. You learnt everything. Correct? Now taking you to a step ahead. Sir, whenever examiner does not tell you your home currency, see, you should always know that to you, to me, to anyone, what ultimately matters? The home currency inflow and outflow. That is what ultimately is of matter. The home currency inflow outflow. You had a gain loss in euro terms. Won't matter as much as how much is the gain loss in your home currency terms. But sir, the examiner has not specified which is my country, but if he doesn't specify which is the actual country in your heart right now, sir, India, right? We are from India. So India, assume practically you are an Indian. In the book you assume that you are an Indian. Your home currency is rupee, and try to figure out, has the examiner given you any hint to convert your final euro gain loss to rupee gain loss? Do you think the euro gain loss can be converted to rupee gain loss? Yes, sir. I have been given a rate. I have been given the rates where I can somehow find the rate between rupee and euro, so that I can convert my euro loss to rupee loss, which means the cross currency has to happen. Now again for our cross currency, let me teach you detailing. See, initially few questions you may find it difficult to process so many things. But if I don't teach you, you won't learn to apply those basics. Initially you may find it hard, but after 3 or 4 questions you may find it obvious that okay, this is how I should think. I'm trying to not solve a question, I'm trying to teach you how should you think for a question. Sir, to convert my rate loss from euro to rupee, I need a rate between euro and rupee. My question to you is, between euro and rupee there is one rate, rupee per euro, there is another rate, euro per rupee. 1 and 2, what do you think you will calculate? Rupee per euro or euro per rupee? Come on everyone, both the things can happen. If I don't teach you this, you won't ever know that okay, even this was supposed to be thought. I'll directly calculate rupee per euro for you, but you will never know that actually euro per rupee could have been calculated. What do you calculate? Sir, rupee per euro 1. Why? If the quantity is euro, it is easy to think every time in every concept if the rate is rupee per euro only. Quantity euro, rate is euro, life is sorted. So I need to calculate rupee per euro. Now you tell me. I have first rate rupee per dollar. I have second rate euro per dollar. To calculate rupee per euro, what will you do? 1 multiplied by 2, 1 divided by 2, 2 divided by 1, what will you do? Please tell me. Sir, I know dollar gets cancelled. If I make this as numerator, rupee will remain the price currency, that is what I want. So I'm thinking it correctly. 1 divided by 2, I will have to do rupee per euro I will get. But sir, again, rupee per euro, which rupee per euro I need? Rupee per euro is fine, but which rupee per euro I need? Bid or ask? Bid or ask? Boss, why do you calculate both? Find out what you ultimately need and calculate that only. Let's save time. Let's save time. Sir, again, point of learning. I mean, this single question has so many things to learn, frankly. Sir, I need to buy 5,000 euro or I need to sell 5,000 euro. First, you think that. Why are you going to the forex market? Buying it or selling it? In the first topic, you went to the forex market, right? In the very first topic of forex, why do you want to go? Buy or sell? Sir, I have a loss of euro. If it is profit of euro, it is available with me. I can go to the market and sell it. It is the loss of euro. I'll have to go to the market to buy the euro. So let's go to the market to buy the euro. Sir, rate is also of euro. When I buy it, the other party will sell it, the bank will sell it, and I need a ask rate. Do you agree to what I explained? It is a loss to me of euro. I want to buy euro. The rate is also of euro. We have particularly kept rupee per euro as the rate, right? So if I buy euro, the other party will sell it, I need a ask rate. If this is a numerator, I can directly take ask of it. But if it is the denominator, I'll have to do cross. So 31.45 divided by 1.44 give me 21.8403 on a rounded off basis, 21.8403 as the final rupee per euro, first. Second ask rate. Sir, these outnotes that you are referring to has all those things mentioned, those small minuteness explained in the pink text which you want to know, or which are the learnings of this question. That since 5,000 is in euro, we will calculate rupee per euro and not euro per rupee. Since it's a loss, we will buy it, therefore we will need to use ask rate. Everything has been mentioned everywhere. Fine, sir. Fine. Rupee per euro is 24.8403. 5,000 euro. Let's buy using this rate. Quantity euro, rate euro, let's multiply. It's already ask rate. 5,000 multiplied by this give me final answer of rupee outflow. When I buy one currency, I have to pay another currency. Loss in rupee is this. I hope I could explain this entire thing. So when you calculate rupee per euro ask rate, to the examiner you don't have to explain the entire background, I need to buy this or sell this, no. You directly say loss of 5,000 we buy from the market at rupee per euro ask rate directly. Calculated below. कैसे? ये भी मत लिखो. Sorry, I spoke in Hindi. Don't even write this. You have to write this divided by this. If you want, you can write this for your comfort, but examiner need only this divided by this and the final answer. In Forex, you must always remember the final answer has to be in with the attached currency. It's in rupee, it's in euro. It will not only get you marks, it will save you from making mistakes. So this comprehensive question, if you have to summarize your learning, identify the position, identify the base currency, identify the quantity. If it's position to square off, you will do otherwise, but you will do the otherwise. You will buy the dollar against euro only, so you lose this rate. Figure out bid ask, figure out per unit totality for gain loss, figure out the final answer and its currency. If it is loss, you know you should buy it. You should know that, okay, if nothing is mentioned, I am Indian, provided things to convert the final answer into rupee has been given. I have been given this rate, which means rupee conversion is possible. Assuming yourself Indian, home currency being rupee, get the final answer in rupee. Sir, once you have need the final answer, sir, you should know that, okay, euro to be converted to rupee, I need rupee per euro rate. Since euro is the quantity, let me keep euro as my base currency. Then you need clear that, okay, I need a ask rate. Directly calculate ask rate. And using the ask rate, convert the way you want it, and final answer is here. Question 4th, I have explained. Question 5th, I will not explain. I'll just give you a hint. In fact, question 5th, let's not do it in the class. I mean, there's no point of doing then every question. Cool? One question of this particular concept gets done where you have, and we have done the most comprehensive question which has the most of the things. Now the next concept called as triangular arbitrage we need to learn. Super fast, boss. The concept of triangular arbitrage, super fast we gonna do. Are we all there? Are we all ready? Let's do triangular arbitrage. People, the entire story you will have to actually learn to be able to do this concept. Let me, hold on, check it if it is worth doing or not. Give me a second. Hold on for a minute. Cool. So now I see that relative to the efforts it will take to explain, to understand, the marks it will get you is less probable, because this particular concept has got no relation with any other concept in the entire Forex, which is why I'm wondering if we should do this or not in this YouTube video. I mean, all the things that we have done otherwise will be of use in all the questions. Triangular arbitrage, people in the class, I am wondering, so let me be completely transparent. First, I thought we should do, okay, but now I feel we should skip for common interest of all the students, right? Sir, we are not doing this particular topic in the class, and I'm being 100% transparent because these are the batches, or these are the books of regular batches. Everything that has been taught in that regular batch of say 200 hours, right, is there in this book. So if I don't do anything, it will be 100% transparent that, okay, what have been taught to them, or if you are a regular batch student, what was being taught to you and not being discussed now. Triangular arbitrage is something we are not discussing in this discussion, right? And hold on for a minute. Although institute has asked the question, not that the institute never asked the question from it. So I would request you all to please cover up this particular topic using your existing knowledge. The batch students, you already have a 10 on 10 conceptual clarity on this particular thing, right? Those who have OutScanner, let me tell you, if you scan this QR code, you will be able to see the video solution of this particular question, right, as many times as you want. So you can make use of this. You can make use of your existing knowledge, the non-batch students, to understand the concept and then solve this particular question, right? I'm being transparent. We find it really hard to cover this particular thing. Fine. So taking you ahead to discuss the next concept, which is forward contract. Boss, another really interesting thing, forward contract. Are you all people okay? Settled with it? Come on, tell me. I mean, what do you all want? If we do this, it will take next half an hour at least, frankly, this one particular thing. Better to focus on the things which is of common applicability every year. Are you all aligned to me? Come on, come on, come on. All the live people sitting here, kindly respond. Should we go to the next topic? What do you all say? And give me a second. Come on. Yes, boss? Cool. But one thing I just came to know. I got to know. It came to my mind. Let me not blindly leave it. Just give you a context of the topic. Context is important so that when you start to do it at your own, you can have a background. Context is, in the spot market, I have three different rates. For example, I have rupee per dollar rate, I have dollar per pound rate, and I have rupee per pound rate. Sir, using any two rates, you can calculate the third one. For example, using rupee per dollar and dollar per pound, you can at your own calculate rupee per pound. When you calculate this rupee per pound, which you calculate is a fair rate. Using the two rate, when you calculate the third one, it is the fair rate, meaning to say according to you what should be the rate of pound per rupee. But there is actually a rate of pound in the market which prevails in the market. You comment on the actual, you compare it with the fair and comment on the actual if the actual pound is overvalued or undervalued and so on, and accordingly you decide an arbitrage process. The word arbitrage relates to simply buying at a lower price, selling at a higher price. Yes, you comment on the actual pound if the pound is overvalued and undervalued, and accordingly decide your process if you should. Again, not explaining entirely, just trying to give you a sense if you already know whether I should go clockwise or I should go anti-clockwise. Meaning to say, if you already have dollars, whether you should sell dollar, buy pound and buy pound, sell the pound and buy rupee and sell rupee to again buy dollar. Should I go this or I go this? Meaning to say I should, if I have dollar, I should sell dollar to buy rupee, sell rupee to buy pound and sell pound to again get dollar. Should I follow this way? One of the two ways will give you profit, right? Rest of the things you will have to do, please, at your own. Requesting people in the class your responses. Just wanted to explain it. Cool? Taking you all to the actual topic that we want to really cover with great detail. Listen to me, forward contract. Do you know derivative? Forward contract was, today you enter into a contract to buy or sell the underlying asset on a future date, say after 3 months. So today only the contract is being entered at which tells you the quantity of that underlying asset to be bought, sold in future at a rate which is decided today only. So suppose I stand at 0 point. In the market today prevails a rupee per dollar rate 60. Now this forward contract is not with reference to the share of TCS or gold or rice or copper. It is with respect to the currency because you are in Forex. Rupee per dollar spot rate, which means the rate in the spot market. The spot market means the place where dollar is being traded. If you want to buy dollar today, go to the spot market, pay rupee. If you want to sell dollar today, go to the spot market, sell dollar, receive rupee. That is fine. If you want to buy, sell dollar after 6 months, do you know today what is going to be the rate of rupee per dollar after 6 months? No, this fact is uncertain. So to eliminate those uncertainty, you enter into a forward contract today. Link it with the derivative. I am not explaining it this is the derivative part I am re-explaining if you realize. You enter into a forward contract today to buy or sell a particular underlying asset dollar after 3 months of a particular quantity at a rate fixed today only. So this rate is called as forward rate at which the contract is entered today of which the execution or the settlement will happen here. Sir, before we are able to, let me tell you, this is not just this particular topic, but a common disclaimer to all the students. Only if you are clear with the concept of forward, future, option in derivatives, then only you will be able to connect to this topic. As I said, the playlist link which is attached below in the description, I'll attach it, right? The playlist has all the videos connected there. So derivatives you should be clear with. If you are already clear here, you can watch it directly. If you are not clear, you'll have to first watch derivative, then only do this. Fine. Sir, forward rate, and not just me, any revision video of Forex, unless you have the clarity of derivative, you cannot have a crystal crisp clarity of Forex, right? Sir, rupee per dollar rate is 66, which means the rate is also decided today at which the execution will happen here. Sir, please, there is a difference. The execution will happen here, but the given rate at the rate which is at the rate of rupee per dollar 66 at which the execution will happen here is fixed today only. It is considered the rate of today, not the rate of 3 months. It is today's forward rate, the forward which will expire after 3 months. So I have two rates of today. One is a spot, one is forward. One is a spot, one is forward. Sir, let's make the contract expiry as 6 months. Fine. Sir, in Forex, what do we need to do? We will use this forward contract to hedge for arbitrage, because in the derivatives you have learned that any contract is entered into for only 3 reasons: hedging, speculation, arbitrage. Sir, we are right now entering it specifically for the purpose of hedging as of now. Sir, when you went to the market, you saw that rupee per dollar in the spot market is 60 and rupee per dollar 6 month forward rate is 66. Can you tell me if $1 is equals to 60 rupee in the spot market today and in the forward market today, how do I denote it? A spot rate today is S0, a spot rate after 3 months is ST, forward rate today is F0. So in the forward market today, the rate is $1 is equal to rupee 66. Can you tell me the dollar is expensive in which market? Dollar is expensive in which market? Sir, $1 which is rupee 66, 60 in the spot market, the same dollar is rupee 66 in the forward market. Please understand, when you feel that rupee has become 60, rupee has become 66 in the forward market, so please don't feel that rupee is expensive. No, it is the rate of dollar that you should realize is expensive. So you have to comment on dollar because the base currency is dollar, because the rate of dollar has been given. So you comment on dollar and you see that dollar is expensive in the forward market, right? So the currency which is expensive in the forward market is called as forward premium. So in the forward market, we see which currency is expensive, dollar is expensive, we say dollar is at forward premium. Since the rate of is dollar, my primary comment is on dollar, right? The rate is of dollar, my primary calculation is dollar. For example, if someone asks you in percentage terms, how much is it? Can I say in the forward market, dollar is 10% expensive. How do you calculate 66 minus 60 divided by 60? In other word, forward minus spot divided by spot. In other word, forward minus spot divided by spot. Yes. F minus S by S is the tell you in percentage terms how much is it expensive, calling it to be the premium or discount. Calculating the premium discount. Here we said dollars at forward premium. But what percentage? F minus S by S. Sir, you need to also annualize it. Since it was a 6 month forward, the premium is 10%. If it is a 12 month forward, the premium will be annualizing it into 365 or 12 divided by n into 100. 66 minus 60 divided by 60 give you 10% premium, but annualize this into 12 by 6 give me 20% premium. Please observe, The base currency is what you primarily comment on. I comment on dollar, which is 66 minus 60 by 60. This entire formula give me premium. Answer is positive. Sir, if it is by chance 54, what will you say? You can see the rate of dollar in the forward market is less. It is at discount, but what discount? Again, F minus S by S. 54 minus 60 divided by 60 give me negative 20% as my answer, means dollar is at discount. So does it mean that if the rate of dollar is given, does it mean we cannot comment on rupee? Sir, ideally we should not, but we can. There is a way to also comment on rupee, to also calculate the premium discount on rupee. Please look at this. When the dollar is at forward premium, it automatically implies that rupee is at discount. Sir, rupee is at discount, but what discount, sir? There is a shortcut to it. The derivation I won't tell you right now, but the shortcut is really simple. In place of F, you write S, and in place of S, you write F, which means although it is a rate of dollar, but using the rate of dollar, I can also find out the premium discount of my price currency, which is everyone in the class, rupee, which is S minus F by F into annualizing factor. So 60 minus 66 divided by 66 into 12 by 6 give me 18.18% discount. Using the rate of dollar, I have found out the rupee premium discount just by modifying my formula S minus F by F. In this discussion, you have learned. Today you have a spot rate, today you have a forward rate. Using these two rates, you can not only find the premium discount of dollar, which is your base currency, you can also find out the premium discount of price currency, which has otherwise formula. You can also look at the currency and comment. Primary comment is on the base currency, but you can also comment otherwise on the price currency. Are you people set with this? The basics of forward and spot I want to teach you. And on these basics, there are questions taking you ahead. Sir, will the examiner always give you forward rate to me like this? No. Sometime it give you the spot rate and give you forward margin and expect you to calculate forward rate. To the spot rate, when you add or when you deduct the forward margin, forward point, swap point, all three names, forward margin, forward point, swap points, when you add or deduct the forward swap points, you get forward rate. Sir, please tell me, do you agree that to the spot rate, if it is premium, if the forward rate is at premium, if the forward rate is premium, then I will have to add something. Sir, to make 60 as 66, I will have to add something. However, if it is discount, I will have to deduct it to make it at discount. So, sir, if I have been given the spot rate, if I have given the forward margin, which is at premium, I need to add it. However, if it is at discount, I need to deduct the forward margin from the spot rate to find out the forward rate. So premium swap points to be added, discount swap points to be deducted, basic. However, if the question is silent, please listen to me. Sir, you will have to look at low, high, high, low. Look at what it is. Sir, if the swap points, for example, rupee per dollar rate is 50 and 51, bid and ask. The swap point low, high, high, low, we mean to say bid and ask. Observe bid and ask. If it is 0.5 and 0.75, it is low, high, bid and ask. However, if it is 0.8 and 0.6, it is high, low. Bid is high, then the ask is low. If it is low, high, you consider it as premium and add 0.5 and 0.75, you add. However, if it is if it is high, low, you consider it as discount and deduct 0.8 and 0.6. Yes, because you consider it as discount. So observing the bid and ask, by observing the bid and ask, if the bid ask is low, high, you consider premium, add it. High, low, assume discount, deduct it, and that's how by adding, deducting the forward points using spot you can calculate the forward rate. It was such a basic thing. Sir, let us do a very simple illustration of it so that you get an understanding of what exactly is needed to be done. Come on, let's say. Sir, let's say the rate is 7.75.455750 is given. So first complete the rate from incomplete. What do you call it? 75.455 and 75.750. The rate which is given, the swap points is 1.010, 1.005. So you should realize that since you have 3 digits after the decimal point, here also you should consider 3 digit after the decimal point. So it become 1.010 and 1.005. Since it is high and low, I'll have to consider it as my discount point and deduct it. Sir, 75.455 minus 1.010 give me 74 point, one second, 75.455 minus 1.010 give me 74.445. Similarly, if I have 75.750 minus 1.005 give me 74.745. That's how you observe low, high, high, low. Imagine again a point of thing you will have to always remember. Meaning to say, sir, if you are not cautious enough, if you miss if it is low, high and high, low, if you end up making this mistake, you make a very basic mistake of calculating a correct forward rate. Now imagine doing rest of the question incorrectly, it is all gone. As I said, the question of Forex is not about technicalities, it is consciously applying those small basics to be able to do the correct solution. Are you all? Please connecting premium or discount swap points is really important to always figure out. This was a basic I wanted to explain. Sir, if the swap points are given, you convert it to currency by, for example, it was 3 digits after the decimal point. You divided it by 3. You put a decimal point after 3 digits to simply add or deduct. It is possible examiner might directly give you the thing with the decimal point. For example, 1.20 is already in decimal. You simply 7.455 on your calculator plus simply add 1 point to it. You get the answer which you want. That's simple. 75.750, you add 1.535 to it on the calc, you get the answer. That simple is the thing. That was learning to calculate forward rate, using spot rate and forward margin. You have also learned how do you calculate premium discount. You have also learned how do you people in the class understand the spot and the forward rate. Now let's solve 1 or 2 practical questions of this type and then we learn further concepts. We are in the second or third section of Forex. In this section, we are doing the forward things. Yes, so let's take a quick 2-minute space, 2-minute break, after which we will start. It is 10:05 right now. It is not a proper stretched break we will take. We will meet after 2 minutes. Let's settle down and then we solve some question of forward. Yes. So far there were concepts and concepts primarily. Now there will be questions and questions primarily. Yes. So guys, let's meet back after 2 minutes. Bye. See you all. Yes, boss. There, please. Come on, come on, come on, come on, come on, everyone in the class, there, please. So, question 10th, a basic but brilliant question, right? Tries to teach you multiple things. It tries to teach you how do you apply the multiple basics in a single question together, right? So, let's learn. Sir, an importer customer of your bank wishes to book a forward contract with your bank on 3rd September for sale to him of SGD 5 lakh to be delivered on 30th of October. Right. Sir, let's develop, although if you are my class student, the skill is already there with you. But to other students, let me tell you, let's develop the skill of understanding the question with every specification. Sir, you are an importer customer, which means you have to, in your understanding, you'll have to realize that okay, I will have to buy the foreign currency for which I will have to pay the home currency. Of your bank wishes to book a forward contract with your bank on 3rd September. 3rd September is the point where contract will happen for sale to him. Bank will sell means the customer will buy the foreign currency, and that is what even we thought, right? That a customer buy the foreign currency means the bank will sell to him the foreign currency of SGD 5 lakh. So 5 lakh Singapore dollar is the foreign currency I am clear with, which is what is needed to be bought. The contract which happens on 3rd September will get executed on 30th of October. The delivery will happen on 30th of October, right? Fine. This is the language of Forex mixed with the language of derivatives I am speaking. Contract happens here, the settlement or the delivery happens there, fine. The bank wants to enter into a contract to sell, customer wants to buy, fine. The spot rate on 3rd September, when we went to the market on 3rd September, the spot rate were as follows. Sir, USD, the spot rate, let me present to you how examiner specified the rate. USD 49.373800 and USD SGD 1.705868. When I looked at these rates, it seemed to me if these are ISO codes, I mean these are Swift codes or normal symbolic rate. Fine. And most importantly, when they say USD this, I am not able to figure out which is the another currency. USD, Euro, Yen, which is pound, which is that another currency along with the USD here. I am not able to figure out. If the examiner is silent, you are from India, which means another currency has to be rupee ideally. Let's see what happens further. So I have been given the spot rates, this and this. The swap points are, when I go to the swap point, I see that USD per rupee is mentioned. So that is how I got to know that okay, there is another currency which is rupee here. Now you all please think and tell me, when it is 49, it should be rupee per dollar or it should be dollar per rupee? Sir, obviously 49 cannot be dollar per rupee, it has to be rupee per dollar. So boss, if it is rupee per dollar, which means, are you observing, institute has assumed it as Swift code. Dollar which is written first is the base currency. So similarly, dollar which is written first should be the base currency, which means this rate is ideally Singapore dollar per US dollar, similar to how this rate is rupee per US dollar. Are you able to understand? Sometimes if the question is ambiguous, we'll have to put in the efforts to first of all figure out what kind of rate is given. I understand it's not your problem, but it's unfortunate. Please accept it. Every other student in the market is accepting it, right? Sir, when I figured out it's rupee, then I realized 49 has to be rupee per USD, which means this also has to be SGD per USD. In the same question, examiner will either give you ISO or symbolic. In a single question, you won't have a combo of symbolic. In a single question, you won't have a combination of ISO and the Swift code and the symbolic. It will be either of one. So I realized that it is all ISO or the Swift code the examiner has given, which is what I'll have to particularly follow. Fine. So finally in my brain I'm clear. I've been given rupee USD, SGD USD. My foreign currency is SGD. I said if the examiner is silent and rupee is given, your home currency is rupee, which means, do you people agree? that ultimately I need a rate between rupee and SGD to be able to solve the question, which can be technically done. Which can be technically done. Are you able to connect what is going on? So I've been given two spot rates. September, October, November, December, January, respective expiry, forward rate, swap points being given, swap points. 1 month, 2 month forward, swap points given. Calculate the rate to be quoted to the importer by the bank, assuming exchange margin of 5 paisa. Sir, first, let's finally know what do we have to calculate. I am bank, you are a customer, you will buy SGD 5 lakh from me, I will sell SGD 5 lakhs to you. Finally, which rate will I quote to you? Which rate am I going to quote to you? Exchange margin is 5 paisa. Answer yourself multiple thing. You need to figure out a spot versus forward. You need to figure out bid versus ask. You need to figure out interbank versus merchant rate. All these answer when you give to yourself, you will get the final answer. Sir, want to enter into a forward contract, which means I need a forward rate. Second, since it's a contract of the bank with the customer, meaning to say I want a merchant rate. And third is figuring out bid versus ask. Sir, please tell me, everyone in the class, please tell me, if you are Indian, one currency is rupee which is fixed, foreign currency is SGD, so I obviously need a rate between rupee per SGD. My question is, which rate will you calculate? 1 rupee per SGD or SGD per rupee 2? Sir, since the quantity in SGD, I would want to make SGD as my base currency, so I need rupee per SGD rate. You are a customer, you want to buy SGD. When you buy me as a bank, I will sell to you, which means we need to ask rupee per SGD merchant rate, merchant forward rate. First merchant, not interbank, and that too a forward rate. Is it conceptually clear? Sir, now what is the sequence? One option is to do the cross currency. First to do cross currency, then calculate forward. Another, sir, using spot, first calculate forward rate. Do the adjustment margin, calculate respective forward. And sir, then you do cross currency to finally calculate rupee per SGD rate. What is the sequence? Page number 186 of OutNotes. I have clearly taught you and clearly made you people understand through a diagram. One of my favorite diagrams, one of my favorite. Sir, if you have to make the adjustment of spot forward, if you have to also make the adjustment of cross currency, if you have to also make the adjustment of exchange margin, the first thing you should do is to convert the spot to forward. Meaning to say, if you have a spot rate, right, it is interbank only right now, no margin, no exchange margin has been adjusted. Do adjustment of forward margin. If it is premium, add. If it is discount, deduct. Using spot, first calculate forward. Suppose you had rupee per dollar and dollar per pound rate. So then you figure out, then you apply the thought of cross currency, whether multiply or divide, do figure it out and calculate what is the final rate you want. Do you realize it is forward, it is rupee per pound, but it is still interbank? Then apply the exchange margin. To the ask you add, to the bid you deduct, and then you finally find a merchant rate, which is a forward of the needed currency, rupee per pound. This is the sequence. This is how we learn the things in the OutNotes to make your learnings. Like we make these charts in the class. I know that this chart has helped every regular student to remember how do you solve a question right till the exam, to always remember it. Sir, now one more level of detailing I want to add. Sir, do I calculate the spot rate, both bid and ask for both the currencies, like both the exchange rate I take bid ask? No. The final rate you figure out, I need ask or bid. Accordingly, think right from the scratch which one do I want and do the calculation only for that, not both bid and ask. Which means if I have to complete this chart, it should be like this. It should be like this. Yes, boss. Yes, boss. It's a linked thing. That final rate, what do you want? Accordingly, the first rate bid ask, you decide and do the calculation. Sir, whatever I have taught to you, let me apply this in the practical question. Right? Finally, don't think that every question is so typical, so difficult. I have chosen those questions to be done in the class which are very vast, comprehensive, so that similar nature easy questions you can do at home at your own. Correct? So now let's learn. Boss, please be here. Let's be specific. Let's proceed. Sir, I need rupee per SGD forward merchant bid or ask rate. So if I need a ask rate of rupee per dollar, please tell me, I should not do all the calculations for both bid and ask. Let me first of all figure out for which exchange rate I need bid versus ask. If I need rupee per SGD, right, I have rupee per USD rate number 1, I have SGD per USD rate number 2. I need to calculate rupee per SGD. What should be? Like, what do I do? 1 multiplied by 2, 1 divided by 2, 2 divided by 1. Sir, obviously you can see USD se USD get cancelled. Rupee, so if I multiply it becomes square, I need to divide. Rupee, if I make numerator, first rate if I make numerator, the rupee which is in price currency continue to remain price currency means I need to do 1 divided by 2. Which means this is going to be my numerator rate, this is going to be my denominator rate. Do you agree that the bid ask of numerator as it is gets followed? So if I need a ask rate, so I will need the ask rate of the numerator and bid rate of the denominator. Which means you will do the cross currency later, but at least now you know that using spot, if you calculate forward, right, of October month, you need the ask of numerator rate and the bid of the denominator rate. So you calculate forward only for that particular rate is the conceptual clarity I want to deliver in the class. So now you say 49.3800 plus 0.13. Sir, my expiry is October end. I will choose the contract which is expiring on October. It is low high means considered to be premium. It will be added. 49.38 plus 0.3 give me this forward rate, which is a interbank rupee per dollar ask forward rate. Now SGD per USD bid forward rate of 2 month is 1.7058. Sir, again low high premium 0.96, 0.0096 added 0.71, 1.7154. It is a interbank SGD per USD bid rate. Once you calculate forward, then you do cross currency. Sir, if I divide this with this, I will get interbank ask forward rate of rupee per SGD. Rupee per SGD. Now I have done the cross currency. The answer is 28.8621. Right? We have already thought this numerator, this denominator, it will give me rupee per SGD. We need ask, all that we have thought already. We just need to do it now. And sir, once you have the rupee per SGD forward rate, ask only interbank, you add the exchange margin at the end to get the rupee per SGD merchant ask forward rate. But merchant rate is this. What is the observation? Sir, this is 5 paisa. Can I say 5 paisa is 0.05 rupee? So if SGD rate in terms of rupee is 28.8621 rupee, adding 0.05 rupee, since it is ask rate, I will add margin. If it would have been a bid rate, I would have deducted margin. So that's how 0.05 rupee when you add to 28.86 rupee, it is 28.9121 rupee. Could I explain the beauty of question 10? I mean, when you do this question, we had a choice to complete it in 5 minutes where I did not explain all the possibilities, all this sequence and everything. I'll just teach you. You won't realize what has not been taught. Now when you learn it, you know what it is. Boss, question 10th gets done. Another very easy question 12 we do in the class right now. Come on. Another very easy question 12 we do in the class. Right? I'll soon come up with the LDR file of this concept. Now, there's a possibility you watch this video after 2 years. Listen to me carefully. You watch this video after 2 years, for example, right? And after 2 years, the OutScanner or the hard copy or the soft copy of the OutScanner that you refer, this particular question is question 10 or question 15, maybe 2-3 questions, 1 or 2 questions here and there, kindly consider it. Right? You have to look at which question are we solving in the class, not the question number specifically. Yes, boss. Can I have a quick feedback from all of you? Quick feedback. First of all, who all do I have live in the class right now? Come on, who all do we have live in the class right now? Super fast. Navya. Are you again comfortable with the language, with the way we are learning, with the speed, everything? Come on, others. So I would request all other recorded people, if you are really finding this video sensible, adding value, effective, then please do comment on the comment section of this video. It really motivates me to figure out if I should come up with such similar helpful videos or not. Yes, so that's a part of your responsibility. If you feel that I'm doing my responsibilities fairly, then that's your responsibility, you'll have to do. Yes, boss. So come on, 12th is the next easy question, right? But does not relate to a particular concept. I mean, has something which is typical, is specifically applicable for such questions, but easy. Sir, on 3rd April, bank quotes the following. Spot exchange rate USD is INR this and this, which means rupee per dollar bid ask given. 2 month swap points, 3 month swap point, low high given. In the spot transaction, delivery is made after 2 days, meaning to say when you buy today, you don't get the asset today, you get it after 2 days. For us, it is irrelevant. Assume spot rate April 5th, 2015. Spot date is 5th April 2016, which means after 2 days. Assume one swap point is 0.0001. That is what we do. If this is 4 digits after decimal point, we do 4 digits here, so it is 0.0070 anyways, 0.0090 anyways. Cool, fine. You are required to a certain swap point for 2 months and 15 days. Sir, if I have been given 2 months and 3 months, can we calculate 2 months 15 days? Yes, basic interpolation you will have to do. 2 months is this, 3 months is this, how much 2 months 15 days will be? Can I say somewhere the average of these two, right? A midpoint to it. Or you can also apply the concept of interpolation learned in the basics at your own. Right now in the class, I'm not going to teach you interpolation. If you know interpolation, you should know if I have 2 month, if I have 3 month point, how do I calculate midpoint? So midpoint is, where is that? Midpoint of 70 plus 160 divided by 2 is 115. Yes. Sir, midpoint of 90 and 186, 90 plus 186 divided by 2 is 138. Yes sir, the 2 month 15 days swap points are here. I have applied a shortcut. Actually, you should do interpolation, which is here, right? There's no particular method of interpolation I've taught to you. So continue to stick the interpolation method you know. In the regular faster batches I've taught to other students not taking my batches, you apply your method of interpolation, do it. Correct? Fine. So next. Determine exchange rate for June 20th. Sir, ideally there is no such rule that interpolation can happen, but there's no other choice in the we have. So particularly for this question, which is why I've called it typical, although it is common sense based, please, if 2 and 3 is given or 4 or 5 is given, examiner asks you 4.5, do interpolation simply. But only when they specifically ask you for 2 month 15 days. When they don't ask you any such thing, never do interpolation. Yes? Sir, next. Sir, determine exchange rate of 20th Jan. If I have the spot rate, if I have the swap points, can I calculate the 20th Jan exchange rate? Yes sir, low high. Simply add it, you get the forward rates to the spot rate. I'm not doing the maths because it's quite understood. Sir, annual rate of premium discount on USD. Sir, premium discount, the rate of dollar has been asked. Primarily dollar premium discount we can calculate. Although we can calculate for rupee also, price currency also, but fortunately examiner has also asked me to calculate the base currency premium discount. So on an average rate is the main ambiguity. Sir, on an average rate does not mean the average of bid ask. Rather, sir, generally we have F minus S by S, the formula for base currency premium discount, correct? Sir, by average they mean do the average of spot and forward in the denominator. Sir, what kind of logic is this? No logic. No logic. Yes, but unfortunately there's no logic, but unfortunately you will have to do it as it is even in the exam, because that's what institute has been doing. So let's do it. Sir, if I have the spot rate, if I have the forward rate, so forward minus a spot divided by the average of these two rates. People in the class, please take the average of these two rates, 66.2525 plus 66.2525 plus 66.264 divided by 2. Average is 66.2583 on a rounded off basis. So F minus S by, rather than S, I should write the average of F and S here. That is what has been taken, which is then annualized 12 into 2.5. Please remember, when examiner asks you to calculate premium discount, it is always annualized. Even if it does not specify it, it is annualized. Right? Yes, sir. Of base currency, which is USD, it has asked. Right? So we have applied the formula of base currency and the final answer is 0.833 for bid, and similarly some answer for ask as the answer of premium. Question 12th, an easy question I wanted to make you people do. Are you people settled? Could I explain? 12th question gets done. The next question we gonna do is question 16th, for which you will have to first learn hedging. After learning the basics of forward, I am now going to teach you how do you hedge, which is really great. But before hedging, let me also teach you another easy concept. In our Forex notes, you will find that at a lot of time we have made certain concept specific in the OutNotes, whereas there's no need to create them as concept. But if you learn it in the OutNotes, till the exam you remember it to be a concept, not just a part of any random question. Sir, learn what is an expected spot rate. There's a spot rate today, which is rupee per $50. Yes. Similarly, what will be the spot rate tomorrow or after 3 months or after 6 months? That today you don't know. It is uncertain. Yes. But can we try to estimate or predict that rate? Yes. That rate which you predict, estimate for future, forecast for future is called as estimated spot rate. When you come to this point, you will know what is the actual spot rate of that day, what is the actual ST. But today when I stand, all I can do is I can forecast. That forecasted rate is called as EST, expected spot rate. Rupee per dollar is 50. Rupee per dollar is expected to become 55. Do you agree? It is the rate of dollar given to me. So my primary comment can be on dollar. Can you tell me the rate of dollar is expected to increase in the market or decrease in the market? Is going to increase or decrease in future in the spot market? Sir, in the spot market, please understand, I am comparing S0 with EST, not S0 with F0, which will execute here. Comparing S0 with EST. The market, in the market, the rate of dollar has been given. I will comment on dollar that dollar's rate is expected to increase, which is why I say base currency dollar expected to appreciate. Although the rate of dollar is given, my primary comment should be on dollar, but I can also comment on rupee as well, that rupee is expected to depreciate. Primarily I should not, but I can, that if the dollar is expected to appreciate, rupee is expected to depreciate. Sir, next, what are the ways? What are the ways institute can make us calculate expected spot rate? First, it may give you the possible spot rate with the probability that after 3 months rupee per dollar rate may become 55, 57, 53. With these probability, you calculate the expected spot rate easy. You have been doing it. Second possibility, Examiner may give you appreciation, depreciation, which is a common sense. For example, if the gold price in the market right now is 1 lakh, and if I tell you, for example, after 3 months it will appreciate by 10%, what will be the price? Isn't it 1,10,000? That's simple. So rupee per dollar right now is 50 in the spot market. If it is expected to appreciate by 10%, so it obviously means it is expected to become 55, which is 50 plus 10%. If it is expected to depreciate by 10%, it is 50 minus 10%, which is 45 rupee per dollar. The point, people in the classes, if rupee per dollar has been given, which means the rate of dollar has been given. If dollar appreciate, we do this. If dollar depreciate, we do this. Sir, what if rupee appreciation, depreciation is given? What if this is given? Please listen to me, what is illogical, but you have to follow because institute follows it, and also easy. Not just illogical, but also easy. You get marks because institute do follow. If rupee appreciate by 10, you assume that okay, rupee appreciate by 10 is dollar depreciate by 10. So rate will be 50 minus 10% as 45. Getting it? If rupee depreciate by 10, you assume rupee depreciate by 10 is equal to dollar appreciation by 10, and rate of dollar will be 50 plus 10. Meaning to say, if dollar rate is given, you have to ultimately think of it as dollar appreciation, depreciation, even if rupee appreciation, depreciation given. Is the conclusion. Yes. Anuka, absolutely correct. Your conclusion is correct that you have to think from the base currency point of view. Yes. So these are the two ways in which examiner may ask you to calculate EST. If it is directly given, lucky. Not given, one of the two possibilities. Fine, sir. Main, this is going to be a part of some other question. What is going to be the main question? Let me try to teach you how do you hedge anything with the help of forward contract. Sir, go to the basics of derivatives, the hedging in derivatives. Do you remember the golden rule I taught to you? Do in derivatives today what you will do in the spot market on a later date. If you want to hedge in the derivatives today, do what you will do in the spot market. Let's learn that specifically. Sir, I am an importer. Suppose I import today, which means I'll have to pay the foreign currency to him after 3 months, which means I'll have to buy the foreign currency from the forex market after 3 months. Similarly, if I export today, I know I will receive the foreign currency from him after 3 months. So I'll have to go to the forex market to sell that foreign currency after 3 months. Are you able to connect? Yes, sir. Problem is, today what is the rate we know? But after 3 months in the forex market to buy and sell the foreign currency, what will be the rate? Do we know with certainty? No, sir, it is uncertain. We are trying to predict the future, which is uncertain. Sir, to hedge, to eliminate this uncertainty, you remember the definition of hedging, the meaning of hedging. Sir, in the spot market, there is a risk, there is an uncertainty, there is a loss which may happen. To avoid that risk, loss or uncertainty, we take a position in the derivative market today. What was the intention? To avoid those uncertainty and losses. When you take that derivative position, it is called as hedging. Yes. So today, when I'm afraid of uncertainty, I take the position in the derivative, which means my hedging starts. Whenever the foreign currency has been bought or the foreign currency has been sold, I'm not worried now. My hedging gets over. I can now settle the positions. Yes, when you take the position, please understand the rates. Today I have a spot rate in the market that I know. Today I have a forward rate in the market which will get executed, settled here. Today I have also estimated the spot rate, which is fine. On this day, I will have the actual spot rate of this point, right? Using these rates, a question of forward will be solved. Sir, the question primarily will be gain-loss based. For example, first you learn to take the position. First you learn to take the position. Sir, what position in the forward contract will you take here, which will get executed here? The golden rule, do in derivatives today what you will do in spot on a later date. Golden rule of hedging, do in derivatives today what you will do spot on a later date. Sir, you are an importer. Will you buy the foreign currency on a later date? Buy it right now only in the derivatives, sir. So if you are an importer, buy the foreign currency forward. Simple. If you are an exporter, in the spot market you will sell the foreign currency. Why don't you sell forward in the derivative market today only? Sell forward in the derivative market today only. That simple is the golden rule. Sir, what kind of questions can I expect? Examiner say, possibility 1, you are an importer, you need to buy the foreign currency. Examiner say, today this is the rate and this is going to be the rate we are estimating. This is the rate today, this is going to be the rate we are estimating. Calculate the forward gain, so calculate the gain loss. So it's like, if I buy today, what would have been the outflow? But since the payment is to be made after 3 months, I will buy after 3 months or 6 months, what will be the outflow? So you have to compare what would have been the outflow versus what will be the outflow and comment gain loss. Common sense? Sir, you are an exporter. You will sell foreign currency. If you sell it today at S0 would have been the inflow. But now since the amount is received after 6 months, the foreign currency is received after 6 months, you will sell it after 6 months, this will be the outflow. Would have been the inflow versus will be the inflow comparison. So not gain loss is always inflow minus outflow. Another possibility of gain loss which is written in the basics I did not teach you. You remember that per unit totality chart? Out there it is written, I did not teach you. Now I am teaching you. Would have been the inflow versus will be the inflow. Are you all able to 10 on 10 connect to everything which is being spoken in the class? Let me tell you, we may take some extra time, but it is going to give you that extra 1 hour is going to save a lot of your hours and possible mistakes is what I'm trying to tell you. And we are solving one question of every time. Yes. So sir, another possibility is what would have been the inflow versus what will be the inflow. So one possibility is comparing this and this. Then institute will say, suppose now we hedge. So what to do? So if you hedge, then that outflow and inflow will not happen at this rate. That inflow and outflow will happen now at a forward rate because contract has been booked. So since the contract is booked, now you compare. This is out of picture. Now you compare this and this. That had I have purchased the foreign currency or sold the foreign currency, this would have been my outflow inflow. But due to forward, this will be my outflow inflow. How much is gain loss after hedging? Before hedging, gain loss was this. After hedging, gain loss will be this. That's what examiner says. Right? Then examiner says, suppose you have hedged. But in reality, the actual spot rate turns out to be this. We estimated this, but actual turns out to be this. So please tell me, if we would have not hedged, if this was not taken, what would have been the actual gain loss comparing this and this? That had we have not hedged, then the ST become this. So what is the actual gain loss that would have become when I stand at this point now? Now there is no prediction, these are the actual ST. So depending upon the language, we will have to figure out what is to be compared with what. Sometimes you may be needed to compare only this and this. This is irrelevant. Examiners say you have two choices, hedge or unhedge. If you unhedge, this is the outflow. If you hedge, this is the outflow or inflow, whatever. As an importer, outflow when you buy foreign currency. As an exporter, inflow when you sell foreign currency. So if you hedge, this is the inflow outflow. Don't hedge, this is the inflow outflow. If you hedge, this is the inflow outflow. Tell me what is better and what is the gain loss due to hedging. Depending upon the language, we will have to identify examiners asking us to compare which numbers. But ultimately, one basic thing you should remember. I am importer or exporter, whatever. To me, ultimately, what matters to me is my home currency inflow outflow. When I buy foreign currency, sir, it is as an importer, it is my home currency outflow which matters to me. Lower is better. Home currency, least it goes out, best it is. When I am an exporter. I will sell foreign currency. To me, it will ultimately be my home currency inflow. Higher is better. The more inflow I have, higher is better. Everything regarding this has been explained. And now if you realize, it is about calculating gain loss in this topic again. And when it comes to the gain loss calculation, do you remember in the basics I've taught you the gain loss per unit versus totality thought you will have to always apply. Yes, boss. So come on, let's do practical questions of this type and you will realize how easy this particular thing is. Come on. Question 16th actually is a very basic question. The more comprehensive question of this type that we should do in the class is question number 20th, if I tell you. Both are a study material question, but let's do the question which is more comprehensive. So 16, 17, see 17 and 18 are same question, like minor difference. So 16 and 17 are two variety, but we will do more comprehensive question of this type, which is question number, let me tell you, 20 and 21. Let's solve them one by one. 20th question, people in the class, let me open the regular batch handwritten notes, because in the handwritten notes we try to create the questions solutions on the timeline. Hopefully we have created it on question number 20. Hopefully. Timeline makes the understanding really easy. We have seen it multiple times even in the derivatives. See, observe. These are the timelines, how we understand or simplify the question. This is the timeline where entire question gets summarized. Similarly for Forex question 20, wow, we have the timeline. You know, this should be the way of learning. Do you agree the timeline looks similar to the concept we have learnt S0, EST, F, actual ST? That is why we spend so much time on the concept, that once we learn the concept, and we also spend time in the question. If you realize, we are talking about minuteness. Why? We want to fit any given question to the concept, apply that concept to the question, solve it so that you find it easy and you solve it accurately. Done. Let's solve question number 20th. Sir, after 20 and 21 we go for a break, around 15-20 minute break, proper break. Yes. Come on. So thank you so much for being patient, sitting here. Let's get started with question number 20. Everyone in the class. JKL Limited, Indian company. Wow. When someone tells me I'm an Indian company, you should realize what is my home currency. Hello. I'm Indian company. My home currency rupee has exported. When I export something, I receive the foreign currency, I go to the forex market to sell that foreign currency. Ultimately, I will have my home currency rupee inflow, sir, of JPY 10 million JPY I will receive and sell it on 31st August. Japanese yen is not directly quoted. I have rupee per dollar rate, yen per dollar rate, which means dollar is the cross currency. I can calculate rupee per yen and yen per rupee. My question to you is, what will you calculate? Sir, since quantity is yen, now you know. Repeatedly when I ask you these things, you realize that, sir, quantity is yen. Therefore, I would want to calculate rupee per yen and not yen per rupee. First question you found it difficult. And this is, sir, directly 20th question. When you do it, you do each and every question. So by 20th question, you will become pro of it. We have tried it in exam oriented and regular batches. Yes, sir, yen quantity, which means we need rupee per yen. So in the class right now, I'm not making you do cross currency. We have done it multiple times. So it's like I have been given rupee per yen rates directly. Sir, what are the rates? This is the spot rate of rupee per yen. It is estimated that rates will change like this. So EST rupee per yen is this. Forward rate for August expiry. Rupee per yen is this. Question: what is the expected loss if hedging is not done? Examiner did not say loss, it say expected loss if the hedging is not done. What does it mean? That today when you stand here, if you don't do hedging, you don't make use of the forward rate. Agreed. So you may incur some gain loss. But is that loss sure shot? No, because the spot rate that will prevail is not sure shot. So the gain loss you may have is also not sure shot, it is expected only. So I am an exporter. As an exporter, I have inflow. So I will have to think that if I don't hedge, the inflow will be at this rate. Whereas at 0 point if I receive, it would have been at this rate. Would have been the inflow and will be the inflow. Can you feel? Would have been the inflow versus will be the inflow. Using EST, not actual ST, using EST. Correct? Sir, before calculating gain loss, the first thing you all should think is what? Please think. Before I proceed to calculate gain loss, every time I need to apply my brain to figure out one particular thing. What is that particular thing, sir? Per unit versus totality. Quantity is yen. Rate, we have intentionally calculated yen so that per unit can happen. Sir, would have been the inflow versus actually the inflow. Can you feel the loss? I could have received rupee 0.6080 per yen, but I receive 0.5242 per yen multiplied by this 8 lakh. Where is that? 8,38,000 is the amount of expected loss. Part B, how the position will change, how the amount of loss will change if the firm takes forward. Now, if you take forward, EST is of not use. Now you will have the inflow at this rate. So would have had inflow and will have the inflow is this now. I would have sold it at 0.6080, but now I'll sell it at 0.6026 on 10 million gives me 54,000 of loss. So it is still a loss to me. So we'd say the position changed. It is not only about calculating gain loss, also writing what are you doing. Sir, the loss position will change from 838 to only 54,000. Hedging has done miracles to us. Yes. Part 3. If the spot rate on 31st August, now I am standing here, the actual spot rate on 31st August turns out to be rupee per yen 0.5977. So except for cross currency, we have done everything and it exactly copies the concept we have learned. Right? Is the forward cover justified? See, you did this calculation, loss was 838. So to eliminate that, you have taken a forward. And forward made the loss 54,000. Yes, but the actual rate is not this. Actual rate is this. Now think, had we have not taken a forward, what would have been my actual loss? Not the expected, actual loss. If I would have not taken a forward, sir, inflow would have been 0.6080 minus it is actually 0.5977 gives me 1,03,000 rupee of loss. Meaning to say, had I have not done a forward, then actual loss would have been 103. It's way less than the expected loss of 838, but actual is 103. Do you agree it is still higher than the loss I have if I take the forward? If I take the forward, loss is 54. If I don't take it, it is 103. And the forward taking is still justified. People, are you understanding? Question 20th. Once you learn the concept effectively, question solving become at its ease. 20th question gets done. 21, the last question before we go for a break, we gonna do in the class right now. Come on. Are you all ready with it for me? Wow. Question 21. I started to feel hungry. I guess you also must be. I'm sorry for keeping you hungry, but this particular question, then we go. And please eat limited. We don't want to sleep. It will impact your learning. I am literal on this, huh? Eat, keep a stomach little empty. Eat, but don't make it 100%. Make it 90-95. That 5% will impact your result is my point. 5% of your food. Sorry. The company operating in Japan has today effected sales to Indian company. When you read the first line, it seems that you are a Japanese company and we have exported to Indian. The payment due in 3 months. Fine, you will receive the amount in 3 months from the date of invoice. The invoice amount is 108 lakh yen. Now you apply common sense. If you are a Japanese company and you export something in yen, the other party will pay you yen. It is a home currency transaction for you. Why are you here in the chapter of Forex? Sir, which means this question must be from the Indian company perspective. An Indian company has purchased something from Japan. It has to make the payment of yen. Now it is a foreign currency transaction. So home currency India. Purchased means foreign currency has to be bought. Home currency has to be outflow. At today's spot rate, it is equivalent to rupee 30 lakh. 108 lakh yen is equal to rupee 30 lakh. It is a hint to calculate a spot rate, but we don't know whether to calculate rupee per yen or yen per rupee. Fine, we'll figure it out. It is anticipated, expected that rate will decline by 10%. Again a question. Rupee per yen should decline by 10 or yen per rupee should decline by 10. Fine, over 3 months. And in order to protect the yen payments, the importer proposes to take the action. Do you agree? The Indian company's perspective is the question. Indian company proposes to take the action in the forex market. Can you feel the language of hedging? First they say in the spot market after 3 months I have to do something. Now in order to avoid the loss of the spot market I have to do something in the derivative market. These are the words, these are the languages of derivative chapter you must see in the derivative video. Yes. So sir, the proposes to take the action. As per golden rule, what action will you take? Do in derivatives what you will do in spot. As an importer, after 3 months you will buy from the spot the needed quantity of yen, right? 108 lakhs yen you will buy. Why don't you buy it today in the derivative? Long position in the forward. Fine. The 3-month forward rate is 3.3 yen per rupee. If to me yen per rupee has been given, then the spot rate also I would want to calculate yen per rupee. Right? Sir, 108 lakh yen is equal to 30 lakh rupee. So yen per rupee means 1 rupee is equal to how much? Sir, 108 divided by 30 gives me 3.6. Which means the spot rate, people in the class, question number 21, the spot rate is 3.6 yen per rupee. The anticipated rate declined by 10%, so minus 10% yen per rupee is 3.24. Fine, cool. And forward rate presently, I can also enter into a forward contract at yen per rupee 3.3 are required to calculate. Look at the words. Required to calculate expected loss. First part, show how can it be hedged using forward. Common sense, feel the common sense. Expected loss meaning to say, because in the second line they are using forward. So in the first line it is without forward. So obviously you don't have a choice. Compare this two. How will you hedge it using forward, which means rather than this, if you do this, what is the gain loss? Is the simple question. Sir, let's think of the gain loss. I am an importer. I will buy yen, so I will pay rupee. Means home currency outflow. Outflow would have happened at 0 point at 3.6, but now the outflow will happen at 3.24. What do you feel, gain or loss? Would have happened at 3.6, but will happen at 3.4. What do you feel, gain or loss? Come on. Sir, outflow will happen at a lower rate. I feel a gain. If I feel a gain, why is examiner asking for a loss? 3 points, sir, as I said. One day will be the exam question where since you will be habitual of using per unit, you will end up using per unit, sir. And imagine if it say profit versus loss, you won't even realize what is your mistake. You will be like, inflow would have happened at 3.6. Now the inflow is 3.24. Difference is my loss. Sorry, outflow. Sorry. Outflow would have been 3.6. Outflow is 3.24. Difference is the gain. Sorry for the background noise. Sorry for the background noise. Are you able to listen to the background noise or no? People, you are able to or no? Just give me a minute. Okay, now kid crying. So my sister's kid are at home and I have lost to figure out how do you manage the new category of kids. Anyways, back to the point. Sir, uh, now you realize it is totality, correct? So which is why you will have to apply totality. The per unit thing cannot happen. You focus on me, you focus on nothing else. Sir, point is, sir, now per unit outflow would have been this, but outflow will be now at this rate, but think totality. Sir, when I buy 108 lakh yen, think the basic rule of conversion, right? The rate is yen per rupee, so I have to divide. So outflow is how much? 108 lakh divided by 3.6 give me 30 lakh rupees outflow. Where is the question? 30 lakh rupee outflow. If I buy at a rate of 3.24, the outflow to buy 108 lakh yen is 108 divided by 3.24, giving me 33,033 lakhs of outflow. So when I compare this, I see that using expected spot rate, there is a higher outflow, which is why it is a loss to me, expected loss. Able to connect? If I take forward, the outflow will be at a rate of 3.3, right? So 108 lakh yen divided by 3.3 give me 32 lakh 72,000 of outflow. So using S0 30 lakh rupee outflow, but now it is 32 lakh 72 outflow. The loss is still a loss. But as compared to EST where it was 3,33,000 loss, the loss under forward is 2,72,000, which is what the hedging has done. Sir, show how can it be hedged using a forward contract. Using a forward contract, it may be hedged from 3,33,000 to 2,72,000. That is what question number 21 is. This question has taught you multiple things. First, it has taught you whose perspective the question is being solved, someone who has a risk, someone for whom it is a foreign currency transaction. Second, sir, when you have been given the rates like this, 108 lakh yen is equals to 30 lakh rupees. It can also be rupee per yen and yen per rupee if you want to calculate. Observe other rates in the question and do calculate the same rate. Third, the concept of totality gain loss it has taught to you. 21 question, we are all done. Before we go to the next question, people, we will have to learn the next concept, and before going to the next concept, people, we will have to take a break now to have lunch. It is 2:05 right now. Let us take a 20-minute break. Let's meet back at 2:25, right? All those who have been watching live but lagging behind by 5-10 minutes, please come to the latest point so that we can continue to be live then, communicating on a real-time basis. Yes, so everyone please be back by 2:25, then we all continue this. See you all after 20 minutes. All right, just give me a yes. Everyone in the class, back please. After the break. Come on, people. Yes. So we need to now move to the next concept. But before that, let me really figure out what about the questions. The next question, people, is 24. 24 is a good question, but again, no point of doing the same question again because we have solved two questions on the forward, right? One on totality thought, one on per unit thought. So the next question we're gonna do is on the exchange rate theories, for which I'll have to teach you the next concept, right? Super fast, people in the class, quick. The concept won't take time. Yes. Are you all there? Back? Everyone in the class, please. Come on, tell me so that I can proceed ahead. Yes, please. So come on. Exchange rate theories. In this topic, we will read primarily two theories. These theory will help you to understand how do you calculate a forward rate or how do you calculate a expected spot rate. Yes. Interest rate parity. It tells you how do you calculate a forward rate. So imagine I've been given a spot rate. $1 is equals to rupee 50. According to this theory, if I have the interest rate of the countries, for example, dollar is US, if I have the interest rate of dollar, rupee is India. If I have the interest rate of India, then I can also calculate the rupee per dollar forward rate. What is the way to calculate is really simple. Sir, how do you calculate? Sir, to find the forward rate. So the question is, sir, how would I find the forward rate? How would we find the forward rate? So what actually prevails in the market is the actual forward rate. What we calculate is a fair forward rate. The logic is really simple. To the spot rate, you multiply a future value factor, you divide a future value factor. Can you relate this way of presentation with something we have already learned in derivatives, that the compounding can be discrete, the compounding can be continuous, or the compounding can even be silent. Depending upon the nature of compounding, the future value factor calculation changes, right? So to the spot rate, I need to multiply a future value factor and I need to divide a future value factor. Similar to the spot rate, multiply and divide future value factors. Sir, since there are two different interest rates, there are two different future value factor. When the spot rate is rupee per dollar, right? For example, it is 50. So I write down 50 here, right? Price currency future value factor is in the numerator. Base currency future value factor is in the base, is in the denominator. Common sense is really simple. When I say rupee 50 per dollar, so it is like 50 divided by 1. 50 is rupee. So multiply rupee rate to rupee and multiply dollar, which is base currency's rate, to base currency. First thing, the future value factor of price currency is in the numerator. The future value factor of base currency is in the denominator. First thing. Second thing, sir, depending upon the nature of compounding, if it is discrete, the formula will be 1 plus rate of price currency per annum divided by K, divided by 1 plus rate of base currency per annum divided by K. Do you people remember what was K in derivative? The compounding frequency. Whole to the power nk. What is n? N is the time period. Please also imagine it on the timeline so that it is not purely be a mug for you. At 0 point when you stand, you want to enter into a forward contract which will expire after a year. So to the rupee, you add rupee interest. To the dollar, you add dollar interest. For what period? Sir, it is till expiry at respective rate. So when you multiply future value factor to the rupee, you are adding rupee interest. To the dollar, you are adding dollar interest. For n time period, which is your time till expiry, right? Multiplied by k is again your compounding frequency. Similarly, e raised to r, the rate of interest per annum of price currency into time divided by e raised to rate of interest of base currency multiplied by time period. Sir, S0, which is spot rate at 0 point multiplied by 1 plus price currency rate into n divided by 1 plus base currency rate into n. With this simple formula, you can calculate the rate of the forward rate that should prevail in the market. Sir, once I calculate the forward rate and if I have the spot rate, can I also make further calculation like premium or discount etc. on it? Because once I have a forward rate, see, on the timeline it looks like a forward rate of here, although the transaction gets executed here, but it is a fair forward rate of 0 point only. So if I have 0 point spot rate and 0 point fair forward rate, I can calculate the premium, discount etc. things. Let's proceed to solve the practical question of this type. Question 25th, super fast, easy question. What do you say? Nishant, there are similar marathons already there in English. Similar marathons are already there in English. We came up with the chapter-wise revision in English language because very less content is there to serve these people from southern India because they are not able to understand Hindi really well, right? Maybe in the next attempt we'll come up with similar videos, you know, chapter-wise detailed revision video in English language. Cool. Yes. So anyways, question number 25. People in the class, let's learn what this question is. US dollar is selling in India at rupee 72. You have been given rupee per dollar rate. If the interest rate for 3-month borrowing in India is 6% per annum and the corresponding rate in USA is 2.75%. Sir, do you remember one particular thing? 3-month borrowing means you have to borrow for 3 months at 6% per annum. But sir, if someone wants to borrow for 6 months, then there will be compounding every third month. Wants to borrow for a year, they'll be compounding every 3 months, there'll be 4 compounding in a year, which means it becomes a case of discrete, right? Fine. Do you expect US dollar will be premium or discount at Indian Forex market? First, sir, rate of interest. 1 minute. Let me tell you one more thing related to basics before I take you to the practical question, sir. If you observe, dollar which was rupee 50 will become 52.38 as per our calculation in the forward market, or is there 52.38 in the forward market? Is the dollar at premium? Yes, sir. From 50, in the spot it is 50, in the forward 52. Dollars at premium. Do you know why? The conclusion is the country whose currency has a lower interest rate is at premium. The country whose currency has a higher interest rate is at discount is the main thing I want to tell you. Are you understanding? So in conclusion, when we say, sir, US will be at premium or discount, sir, rate of interest in US is less, it will be at forward premium. What is the expected 3-month forward rate? Calculating forward using spot. So spot is 72.5. Multiplied by, apply the thought of discrete and calculate 1 plus 0.06 divided by k is 4, right? Into 1 plus 0.0275 divided by 4, right? Whole to the power n is 3 by 12 and k, everyone in the class, is 4. When you solve it, people, it is to the power 1. So effectively what you're left with is 1.06 divided by 4. So 0.06 divided by 4 plus 1 m plus, and 0.0275 divided by 4 plus 1. Divide equal to into memory recollect into 72.5 gives me 73.0850 being the rate. Sir, in this question you will observe that institute has in its official solution applied simple interest thought third category. But you don't have to apply third category, you will have to, people in the class, apply the first category, which is discrete. Obviously it gives you the same answer, but the correct way to present is this. Yes, first thing. Sir, what will be the forward premium discount on rupee or dollar? Since the rate of dollar has been given, primarily you should be able to calculate the premium or discount of dollar, right? F minus S by S, 73.085 minus 70.25 divide 7. Annualizing it, 3.26% positive answer, premium on dollar. Question 25th gets done, right? Question 27th, just one particular part of this we gonna do, right? I'm explaining it because it has an ambiguity. Ambiguity is, they say the spot rate is 7.05 franc per dollar. The rate of French franc has been given on a per dollar basis, base currency dollar, price currency French franc. Complete the entry. If you have dollar interest rate and French franc interest rate, right, where it says it is annually compounded, the only question I want to tell you is that even if the question is specifically say it is annually compounded, institute has assumed uh, discrete only, but in the discrete the k is not considered 1 based on annual, the k is considered 4 here, the k is considered 2 here, because every 3 months if the rate compounds then k become 4, every 6 months if the rate compound k become 2, if every 1 year rate compounds k become 1. So this is how, even if it is annual compounding where k can be 1, k should be 1, in case of this column they have assumed 4 as k. Rate has been assumed quarterly compounding. This is why question 27 is considered ambiguous, and that's how even you will have to solve it in the exam. Please remember, that is how even you will have to solve it in the exam. Not the one which is logical because it says annual compounding, but the one which the institute has done. The only reason for solving 27th question was this. But otherwise, there is nothing new. Using spot and the two interest rate, can we calculate forward? Yes, sir, we just did. Using forward and the spot, can we calculate premium discount? Yes. Third question was really easy. Challenge is question number, the second and third part of this question, which has some kind of reverse calculation. If you have been given the discount, a spot is given, can you back calculate forward? F minus S by S is the formula, or otherwise is the formula for price currency. If I have the spot rate, if I have the premium discount, can you calculate the forward rate? Yes. If you have the forward rate, if you have the interest rate one of the current countries, can you find out the interest rate for another country? That's how it is. People in the class, 27th will be your own. Now, before I take you to the next one brilliant question that we're gonna solve in the class is question number 28. Come on. One of my favorite question. This question literally ask really variety of things. Ashish, my God, one of the most underrated faculties, sir, you are. Okay, thank you so much, Ashish, for your message. Fine. Have you been my student, is it? So, people in the class, let's proceed. ABC Limited of UK. Listen to this question, brilliant question we're gonna do in the class. ABC Limited of UK has exported goods worth rupees Canadian dollar receivable in 6 months. What a line. When someone says you are from UK, you should know my home currency is pound. When you export good, which means you will receive foreign currency, you will go to the market to sell the foreign currency, ultimately it will be home currency inflow. What is that foreign currency? Pound. In 6 months you will receive. The exporter wants to hedge the receipt in the forward market, which means I will sell those Canadian dollar against pound in the forward market, for which the contract has to be entered today only. Following information is available: spot rate and the two interest rate. Did you observe something? I want to hedge using forward rate and the forward rate has not been given. But sir, basic common sense, when the spot and interest rates are given, I can calculate forward rate. What I calculate will be fair, but if I assume fair to be actual, then I can do the hedging using actual. Sir, this particular line ultimately means fair is equal to actual. Moving to the main line of the question. Find out the gain loss to UK exporter. Gain loss to the UK exporter. If Canadian dollar spot rate decline 2%, gain 4%, remain unchanged. In a single question, they have made you people do IRPT and hedging. Sir, what is going on? Let me explain. Do you remember the concept of forward I just taught to you? Hedging. If I have the spot rate today, if I have the ST or EST, and if I don't have forward rate, but I calculate using IRPT, then also can it become the question of hedging? Yes, that's what this question is. Yes, super ultra fast everyone in the class. Let's first calculate IRPT. Sir, spot rate is Canadian dollar 2.5 per pound. Canadian dollar price currency, pound base currency. So Canadian dollar rate in the numerator, pound rate in the denominator. Time period is 6 months. Simple interest, no compounding frequency. 2.5 plus 0.15 into 6 by 12 plus 1, 0.12 into 6 by 12 plus 1. When you solve, it is Canadian dollar 5345 per pound. Using this rate, you enter into a forward contract, which means you enter into a sell Canadian dollar at this rate and you have some inflow. Fine. Find out the gain loss to UK exporter. To me, how much is the gain loss if Canadian dollar spot rate declined by 2? Which means this is the information regarding EST or ST, that on the day of expiry, after 6 months, over the next 6 months, if the ST become this, what it become? Canadian dollar spot rate decline by 2. You might think that the spot rate right now is 2.5. If it decline by 2, see, forward has nothing to do with the incline decline. Incline decline relates to S0 and ST. S0 is 2.5, ST is declined by 2%. Don't make it 2.5 minus 2%. Why? It is the rate of pound which is given. Pay attention to small details. It is the rate of pound which is given. Do you people agree? Do you people agree that examiner did not speak about the pound appreciating, depreciate? It speaks about Canadian dollar and declining. Did we not learn today that Canadian dollar decline is to be assumed as pound appreciation or pound rise? So 2.5 plus 2% will be the ST in the first case, which is 2.55, everyone in the class. Similarly, second case, 2.5 gains 4%, but Canadian dollar gain 4, so pound lose 4. 2.5 minus 4% is the rate. So now I have three different STs in different scenario. I have the hedging rate, forward rate, I have the spot rate. Examiners say calculate the gain loss. Using the language, you have to find out which two rates to compare for gain loss. Let me explain. Do you agree that examiner says you want to hedge? So one rate has to be forward rate. And examiner says calculate the gain loss. If ST turns out to be this. So do you agree? It is F0. It is F0 and ST, boss, it is F0 and ST are the two rates to be compared. If you think it is S0 and forward, sir, then what is the use of ST? If it is S0 and ST, then what is the point of they saying you enter into a forward? Based on the language, you have to identify which two rates to compare. Sir, if it is S0 here and ST here is what you have to compare. First point of learning, actual forward not given, IRPT calculated fair and assumed actual. Second point of learning, base currency pound increase decrease, Canadian dollar given. Third learning, very important learning, sir, you want to sell Canadian dollar. Rate of pound has been given. Per unit cannot happen. You will have to think totality. Sir, 5 lakh Canadian dollar, when you sell at a forward rate of 5.345, the inflow is 197,207 pound. Right? If ST decline by 2, which means if the rate become 2.55, which means inflow is 196,078. You have to divide, please. Totality you will have to think. So due to forward, basically you have to comment on the gain due to forward. When you do something because of that doing, because of that hedging, how much is my gain loss? Sir, rather than 196, if I don't hedge, if I hedge, I will have 197,207 as my inflow, which is a gain to the UK exporter of the difference amount. Similarly, inflow using this, you will have to calculate and figure out if the forward inflow is better or less better. That is question number 28. Boss, could I explain everything which was to be needed to be explained in question number 28? Come on, tell me. Could I really explain which was needed to be explained? Sir, next is learning arbitrage. Oh my god, sir, arbitrage again. Yes. This time you will have to do arbitrage using interest rate parity theorem. Interest rate parity theorem help me to calculate fair forward rate. Yes, when you see, the arbitrage process you can relate with the arbitrage process in the derivative. I said whenever there is a mispricing, there is arbitrage, and there will be a profit if you follow the process of arbitrage correctly, which is based on the under overpricing. Sir, what is the arbitrage process? Let me explain. Imagine that you have 50 rupees. So arbitrage process primarily involves borrowing in one currency and investing in one currency. You remember arbitrage involves two opposite action into opposite market. If one currency has borrowing, another currency has investing. Is one currency, second currency has borrowing, first currency has investing, right? In the arbitrage process, sometimes the students are confused that, sir, if we have dollar rate, if we have rupee rate, which one to borrow, which one to invest? We will directly learn the thumb rule. What is the thumb rule? Thumb rule is borrow in the undervalued currency. Let me now explain. Sir, according to us, the fair forward rate was 52.38. The actual rate in the market, suppose, is 55. So rupee per dollar. Actual 55, fair 52 something. Please everyone in the class understand this basic logic. You always comment on the actual, correct sir? And even on the actual, which currency do you comment on? Sir, the given rate is of dollar. So I will be able to comment on dollar only now. If I tell you the gold price, what will you comment on, gold price or rupee? Sir, gold is expensive, you are automatically commenting on gold. Similarly, dollar, you comment on dollar, that in the actual market dollar is undervalued, overvalued. Fair is 52 rupee, actual is $55 overvalued, and which is why we say it means rupee is undervalued. You will have to ultimately figure out what is the undervalued currency. If the actual is 50, you say dollar is undervalued, life is sorted. But if the dollar is 55, then you say dollar is overvalued, which means rupee is undervalued, and in the undervalued currency you borrow. Now try to imagine the process and the steps at your own. Your imagination will simplify and solve this question. Sir, you borrow, for example, 50 rupee. When you borrow in one currency, I said you invest in another. But to be able to invest in the another, you will have to first convert it to another currency. So step 1, borrow in first currency and just calculate the amount to be repaid. Indian rate of interest is 10% on the day of expiry. After a year, you will have to pay rupee 55. This is step number 1 done. Step number 2, the amount that you borrowed, you sell it in the spot market, because at 0 point what happens is the spot market at a spot rate, and receive dollar. You sell rupee and receive dollar. Now you have dollar in your hand. Take this dollar and now invest it. Rate of interest in US is 5%. The amount you will redeem after a year is $1.05. So please, on the day of expiry, imagine my situation. Here I have the amount, available with me, and out there is an amount I need to pay. This one is in dollars which is available, this one is in rupee which I need to pay. So I need to sell this amount to convert it into the rupee. In the market, I see, when I go to sell it, I see that the actual rupee per forward rate is 55. $1.05 when I sell, I get 57.75 rupee in hand, out of which 55 I need to pay, rest of 2.75 is my gain in rupee terms. What I want to teach you, borrow in undervalued currency, complete, figure out how much is the repayment. Step 2, sell the borrowed amount and receive another currency. Step 3, invest the received amount and redeem it. Step 4, sell the redeemed amount to receive the another currency which is your home currency. Step 5, calculate the gain loss. That simple is the process, everyone in the class, of arbitrage. My expectation is not only you understood it or not, my expectation will you able to remember this timeline on your brain. Common sense of Forex is really simple. You do anything, it is S0. You do anything at the end of first year, it is ST or F. Not now any concept. 0 point is S0, later is F or ST. Second, If you have rupee rate of interest gets applied to this amount. If you have dollar rate of interest applied to this amount. Yes. If you have something, you sell it. Sell, you receive. So next you invest it. Automatically the next step should be, everyone, clear in your mind. Let's solve one practical question of this type, which is, let's say, question number 31. Right? In fact, we can solve question number 29, not 31. Question number 29. Given the following information, right? Exchange rate Canadian dollar 0.665 per DM, forward rate, which is 3-month rate Canadian dollar 0.67 per DM. DM rate of interest 7% per annum, Canadian dollar rate of interest 6% per annum. Sir, there is no arbitrage cost to determine interest rate parity holds in above equation or not. If the interest rate parity would hold, then using spot rate, if I calculate the forward rate, then the forward rate will be, the fair forward will be actual. So let's everyone in the class super fast figure out, sir, Canadian dollar is the price currency, DM is the base currency. So Canadian dollar rate in the numerator, DM rate in the denominator. Sir, time period is 3 months. So 9 into 3 by 12, 7 into 3 by 12, third category simple interest 1 plus 1 plus 0.665 is the spot rate. So fair rate is 0.668, which is this much Canadian dollar per DM. Sir, actual is 0.67, which means it is the interest rate parity does not hold good, does not hold in the above situation. If yes, then explain what step would you make to the arbitrage transaction, right? You can make use of Canadian dollar 1000 for the same purpose. Sir, Canadian dollar 1000 use and do arbitrage. Sir, first of all, tell me which currency it is. DM, right? DM is the currency on which you comment. Sir, actual forward is 0.67, fair forward is 0.668. Can I say DM is the currency in which I have to comment, and that too on the actual? When DM is overvalued, 0.67 is more than 0.668. Actual DM is overvalued, which means actual Canadian dollar is undervalued, in which currency I will borrow. So step number 1, imagine that line on the top, borrow $1,000 at the rate of 9% for 3 months. How much is the outflow? Borrow $1,000, 9%, 3 month outflow is 1022.5. Just keep that outflow there at the end of third month. Come back to 0 point, sell the borrowed amount. Sir, $1,000 you sell, Canadian dollar you sell at the spot rate and receive DM. Sir, how many DMs will you receive? 1503 DM I receive. Common sense, rate of DM is given, quantity is Canadian dollar, you divide, 1503 DM I received. Step number 3, invest the DM for 3 months at the rate of 7%. Invest DM at the rate of 7% for 3 months. The amount of DM I received is 1530.08. Common sense. Here I have DM available with me. In the numerator, I have Canadian dollar of 1022.5 to be paid. Let me sell this DM, convert it to Canadian dollar, and then check the difference. Sir, DM is 1503 using actual forward rate. In the market that prevails is actual, using actual forward rate. Let me convert, and when I convert, I get the available Canadian dollar as 1025.15, out of which I need to pay 1022.5. The difference is 2.65 as my profit in terms of Canadian dollar. Boss, on this particular thing, question number 29th, I need your validation. Could I explain super fast, yes or no? Question number 29th, please tell me, could I explain super fast, yes or no? So one question of even this type has been done. Now the next concept I am going to explain to you is the concept of money market hedging. What is the simple rule? Borrow in what is undervalued. Imagine this chart, and through the imagination you will be able to always do solve the practical question with its best ease. Next concept people in the class is money market hedging, right? Money market hedging, please remember, has nothing to do with interest rate parity theorem. Interest rate parity is a arbitrage thing. Money market hedging is the hedging concept. That if I'm afraid of a spot market position, if I'm afraid of the spot market position, then how do I get to know? How do I eliminate that risk uncertainty? Through money market hedging. Just like forward was the first method of hedging we have learned, money market is the second. What is the point of difference? Please listen to me carefully. First, are you all people there listening to me? Anuka, you are saying that, sir, something has a lower interest rate, will be at premium. So dollar will be at premium. I did not say you have to borrow something which is at discount. I said you will have to borrow something which is undervalued. Are you understanding? You have to not borrow something which is at premium or discount. No. You have to borrow something which is undervalued. Sir, it is possible that dollar is at premium. It is possible that dollar is at premium. Despite you don't sell, you buy dollar. Despite it buying premium, you buy. Because there is a possibility actual is this where fair is 56. So something is less than how much it fair should be. Then it is undervalued, you buy. Getting it? Meaning to say, you don't have to apply what you're saying. Money market hedge. The process looks similar to interest rate parity theorem, which is why we are discussing this process here. But otherwise has nothing to do with IRPT. Let me give you the point of clarification. IRPT starts here. You borrow and you keep the amount to be paid. You sell this thing and then you invest this thing and you convert it back. That is how IRPT looked like. Correct? The concept that we just did. In case of money market, my starting point is not this. My starting point is this. What is the starting point? Let us learn. Guys, in the middle of the video, I would just want to tell you that every time we come up with this file called as New Question by ICAI file, which has compilation of all new questions by the institute in its RTP, MTP, exam paper, everywhere. And for the same file, we also have, so that file has compilation of all new questions in its RTP, MTP exam paper in the last 5 attempts at least. And for the same compilation, we also come up with a YouTube video, right? Video, although doesn't have the solution of new questions of 5 attempts, it has for 2 attempts or 3 attempts or as the need may be. So you all must refer to that particular file. It came to my mind, which is why I shared. Now bringing you back. Sir, in this case of money market hedging, your starting point will be this. For solving the practical question, this is the start point. Then you come here, then you come here, then you come here. Sir, what is happening? Really simple. Whenever you travel from right to left, it is on the timeline, which means adding interest, deducting interest. Right to left is always timeline. And up down in the entire, for example, I'm saying right to left is timeline traveling. Up down is the currency traveling, moving from one currency to another, selling one currency, buying another currency, and so on. This will help you to understand all the charts in a really easier manner. Sir, as an exporter, think it's really easy. I know that as an exporter, I will receive the foreign currency. Suppose you will receive $1 lakh. We decide to borrow. Present value of $1 lakh. Say you decide to borrow $95,000. Sir, why? With the logic that 95 if you borrow, you will be able to repay $1 lakh after 3 months. So whenever from the other party, as an exporter from the other party, you will receive $1 lakh as it is, you will use that amount to make the repayment of the borrowing, which is why you borrowed today 95,000. I hope I'm clear. You borrow 95 today so that you have to repay 1 lakh. So from the other party, whatever you receive, you repay as it is. So step 1, borrow. Step 1, this is my start point. Borrow the present value of 1 lakh dollar. Now imagine the next step. Automatically in your hand you have dollar. What do? Invest. Sir, why do I invest and borrow in the same currency? Do you have common sense? Yes. So when I borrow in one currency, I will have to sell it at a spot rate to receive another currency, which is rupee. My starting point was foreign currency. I have come to now I have sold the present value, received the rupee, my home currency, and now I invest that home currency at rupee rate and ultimately find out against this investment how much is the amount of redemption. As an exporter, if I don't do money market hedge, I will do forward hedging, right? I will sell the foreign currency, I will receive home currency, right? That is what even I'm doing in money market. I'm ultimately receiving my home currency because I invested home currency to redeem it. What are the steps? Borrow the present value of foreign currency receivable. Whatever is receivable, you borrow. Sir, next is whatever you have borrowed, sell it using spot rate. Third, and when you sell it, you receive home currency. So third, invest the home currency and found the redemption amount. Sir, if you are an importer, you know ultimately you have to pay here. So this time, rather than investing, you do investment. Rather than borrowing, you do investment. Sir, you know you have to pay 1 lakh here. So you invest 95,000 today so that with interest you receive 1 lakh and the same amount can be used to pay the investor. Can you please understand the starting point? As an importer, I need to pay after 3 months, which is why I invest today so that I can pay. As an exporter, I will receive 1 lakh. So which is why I borrow so that I can use that 1 lakh to make the repayment of the borrowing is the point. Can you please connect what is my starting point? For exporter, the starting point is borrowing. So automatically you have to think that everything is available. Meaning to say, when I borrow, dollar is available to me. I have to sell it because it is available. So when I sell dollar, I receive rupee. So now rupee is available. When rupee is available, I invest it and redeem after 3 months. In case of importer, rather than availability, it is a need to me. I need to invest the present value. Now, to be able to invest, I need to buy dollars so that I can pay my home currency rupee. You borrow, you invest the present value of foreign currency 1 lakh, which is $95,000. The same foreign currency I will have to buy at a spot rate and pay rupee. So I need rupee now, which is why I have to borrow rupee so that I can find out ultimately how many rupee I have to repay. So invest the present value of foreign currency to be able to invest by the foreign currency, and to be able to buy, you need to borrow the home currency and find the repayment amount. Step 1, if you understand, the next step automatically you can create. What is the way to understand is really easy. That ultimately if I need the amount after 3 months, what should I do? Invest. Ultimately, if I have a available amount, what do? Borrow so that you can use the available amount to repay the borrowings. Could I please explain the concept of money market hedging? Everyone in the class, please tell me. Based on which, let's do a very comprehensive question, which is comprehensive question number 35 in the class. Super fast. Come on, people in the class will have to be literally super ultra fast for this. Yes, will you all give me a minute, please? Just a minute, please. Come on. Sir, Columbus Surgical, based in US, which my home currency is US, recently imported surgical raw material for UK. Common sense. When I import something, I have to pay the foreign currency, which is pound. I am a US person, dollar is my home currency. I have to buy the pound from the forex market and pay him. From the forex market, when I buy pound, in terms of USD, it is an outflow and has been invoiced pound 4,80,000 payable in 3 months. It has also exported to India and France, right? So one is import, another is export. Indian customer has been invoiced in pound 380, 138 payable in 3 months. Look at the beauty. Although I've exported to India, I am US person. Fortunately, Indian party has not been invoiced in rupee. They have also been invoiced in pound, which means listen to what is happening. Pound in 3 months, I will receive 138 from the Indian customer, and to the UK party from whom I purchased, I have to pay 480. Which means, do you agree? Out of 480, if 138 is available as an importer, then net is only 342 that I will have to buy from the forex market. Only for this net part I need to do hedging. This concept of matching the inflows and outflows is officially called as matching. This was my outflow, this is my inflow. When I match the inflow against the outflow, this concept is officially called as matching, and I need to do hedge only for the next net amount. Which means now I need to buy the net amount of 342 from the market. My question to you is, after 3 months, I need 342 pound. I need, because I am an importer, I have to make the payment. What do I do today? Invest today to get 342, or borrow today to pay 342? Sir, since I need 342 on the day of expiry, I need to invest the present value of 342 today. Are you all able to connect? I need to invest the present value of 342. Correct. So step 1, invest the present value of 342. Now, when I went to the market, I see that the rate of interest in pound, please now understand. Since if you want to invest the present value of 342, the amount is in pound, the rate of pound will apply, which UK rate will apply. You have investment rate and the borrowing rate. Lower rate is at which we invest, higher rate is at which we borrow. So 10% is the rate and 12 is the borrowing rate. So applicable rate is 10%. That is for the period of 3 months. 342 is the amount that I finally need. The present value is 1 plus Rn, divide by 10% into 3 by 12 plus 1, give me 333,659 pound. I need to invest it today so that on expiry I can get this. If I need these many pounds today, I need to buy them and pay from my pocket dollar, for which the spot rate between the dollar and pound in the market is this. Sir, I need to buy pound. Rate is of dollar. So which is why I'll have to say I have to sell dollar. When I sell dollar, the other party buy it, the relevant trade become bid, and I will have to do divide. Right? Divide by 0.9830, give me the dollar I will need to buy those pounds. If I need these dollars, so let me go to US and buy the dollar, US borrow the dollars, sorry. If I need them, let me borrow the dollar, 13% for 3 months. Sir, 13% 3 months, these many dollars, the amount of dollar to be repaid is 354.60. Overall, in conclusion, sir, as a US company, my home currency, which is dollars to be repaid after 3 months, is 354.60 when I hedge using money market. Requesting on this particular thing, people, your responses. As an importer, could you connect the 3 steps of money market hedging? Super ultra fast, kindly respond to me so that I can take you to the next discussion. Everyone waiting. Come on. Come on. People in the class, please. Could you all really do it? Settled, are we all 10 on 10 to this? Sir, if the money market is clear, I hope you realize the starting point is this. In both the case, you have to ultimately come down to the end point, which is marked as circle. Yes, you end to the. So ultimately, one thing should be clear. As an exporter, you should be able to find out finally in my home currency how much is received. As an importer, you should be able to find out finally in my home currency how much is going out. Currency really matters. Home currency inflow outflow matters. The actual question was, what should we do? Money market hedge or forward cover? Sir, if I do using forward hedge, right? So I have forward rate of 0.9520. Using forward rate, if I hedge, the outflow is 359. Here the outflow is $350. We will say money market outflow is lower. It is a better alternative. In the same question, we have an exporter perspective also, which you will have to do at your own. 35th question, importer perspective, which is more available, we have done. One particular thing you always remember, exporter perspective is availability thought process. This is available, what do you do? Sell. This is available, what do you do? Invest. Importer perspective is need perspective. I need this because I need to pay this. So borrow. To be able to borrow, I mean buy, kind of a need perspective. Money market hedging, the situation gets done. The next is purchasing power parity theorem. Directly the conclusion I am sharing. We have learned interest rate parity theorem, really great. Purchasing power parity theorem, two conclusion I want to share. Where interest rate parity theorem is based on interest rate, purchasing power parity theorem is based on inflation rate. Where interest rate parity theorem tells you forward price of zero, forward price of a contract at 0 point expiring at T point, this tell me this spot price that should prevail, that will prevail in the market, right? Purchasing power tell me the EST, expected spot rate, forward rate, for interest rate parity tells me the forward rate. Now purchasing power parity has the same formula and only one formula, no category, discrete, continuous, question sign, and no, only one formula of annual compounding. Spot price into 1 plus r to the power n divided by 1 plus r to the power n. Rather than r, I have to use inflation. Price currency, inflation in the numerator, base currency, inflation in the denominator, exactly same formula that we used for IRPT, just that it gives you the EST. That simple is the thing. Although we have one more calculation called as real appreciation depreciation, but this is the discussion that we do in the class on real appreciation depreciation. Why we gonna not discuss it in the class right now is in this video right now is that we have one particular question of real appreciation depreciation that is ambiguous and kind of incorrect, frankly, if I tell you, right? So even if I teach you the concept, first that concept is of no use anywhere else and not even in use in this question because the question is ambiguous. Except for that ambiguity, right? We want to discuss concept question 37 for your understanding so that you can relate or link the concept to the question. Let's start to read the question super fast. US investor choose to invest in Sensex. Please understand, really important, there is a US investor, for him the home currency is dollar. If the examiner specifically say you are US investor and another currency is rupee, which is Sensex, don't assume yourself to be Indian. US investor whose home currency is dollar, he invests in Sensex, he invests in rupee, fine. To be able to invest, he will have to buy the rupee. You are in US, you want to invest in India, you will have to buy the rupee, correct? Sir, for a period of 1 year. Size of investment, he wants to invest $20 lakh. He has $20 lakhs today. Spot rate 42.5 and 42.6. Spot rate 1 year ago it was. Spot rate at 0 point. Today it is 43.85 and 43.9. So question is basically of the past. 1 year ago the spot rate was this. Now the spot rate is this. Fine. Sensex 1 year ago 3256. Sensex now is 3765. Fine. US inflation, India inflation given. Compute the nominal rate of return to US investor. Sir, to this person who's in US, how's the rate of return? Apply common sense. Sir, I have not taught to you so far the concept of investment. I have never in this revision video, so far taught to you the concept of, one second. Yeah. People, are you all to the latest point? Please confirm me once. Yeah. I have not taught you the investment thing, but still it's a common sense. I want to tell you once. You have dollar right now. You have dollar right now in your pocket. That dollar, if you need to invest in rupee, you obviously common sense sell it to receive rupee. What is the rate at which sell you? What is the spot rate on that day? Sir, you sell the dealer, the bank buys it by a bid rate. So 20 lakh dollar multiplied by the bid rate will give you the amount of rupee to be received is 8 crore 50 lakh. When you invested, Sensex was this, now the Sensex has become this. How much is the amount of rupee you redeem? Ultimately, you redeem 9 crore 82 lakh 87,776. The amount of rupee you redeem is here. But since you are in US, ultimately you would convert your rupee to dollar. At the point of second conversion, the rate becomes this. Now you go to the market to sell rupee. You have rupee in hand, you go to the market to sell it, but the rate is of dollar, so it is like buying the dollar. We buy dollar, the dealer will sell it at ask rate, so 43.90 is the rate at which you will divide, and finally receive dollar 2238,902. 2238, you dollar outflow was 20 lakhs, dollar final inflow is 2238,902. Yes. And ultimately the percentage return over a period of 1 year is 11.95%. I'm saying it's a common sense. Dollar you have. Invest, sell dollar to receive rupee. Invest rupee to redeem rupee. Now rupee if you have, sell rupee to receive back dollar. So outflow home currency from your pocket, inflow home currency to your pocket ultimately gives you the idea of return. Although foreign currency investment we will learn later in a proper topic, but for now this much is sufficient. Right? Done. Sir, next. Real appreciation, depreciation is the topic which has ambiguity, not discussing it. Exchange rate if the purchasing power parity hold good. What is the exchange rate? Sir, if I have the spot rate, using the inflation rate of two countries, can I calculate the spot rate after a year? So if it is 42.5, multiplying India inflation of 9% and dividing US inflation of 5%. So 42.5 into 1.09 divided by 1.05 give me 44.1190 as the expected rate using purchasing power parity. Right? Last is real return to the Indian investor. Sir, Indian investor whose investment is 3256 become 3765. They are not asking about the US investor. If you are Indian, you invest 20, whatever amount you invest 32 at 52, 3256, it becomes 3765. How much is the percentage return? Sir, percentage return is 15.63. Main point is converting a nominal return of 15.63 into the real. What is the relationship? 1 plus real rate into 1 plus inflation is equal to 1 plus nominal rate. So 1 plus 15.63%, that is equal to 1 plus real rate into 1 plus 9% India's inflation. So the real rate is, if you calculate, 6.8%. An extremely easy question if you realize, except for that ambiguity which we have not worked upon. Question number 37 we have discussed. The process of investment was really new because I have not taught it, but through this question we have discussed and I hope you have understood it. People in the class, are we all set? Now I take you through something really interesting, extremely interesting, called as fate of forward contract. Boss, speak up. Fate of forward contract. Shall we please come to this topic? For this particular topic, if you have your imagination on, then let me tell you, you can really understand this topic in an easiest manner with the help of your imagination. Yes? So let's cover this topic. People in the class, let me tell you, when you enter into a forward contract today, there are three things that you can do to a contract. You can either execute the contract, which is a normal case, settle the contract. You can cancel the contract or you can extend the contract. Now listen to me on timeline. At 0 point you have a forward contract, correct? At third month it will expire. On the day of expiry, if you execute it, that's the best case. That should ideally happen on the day of expiry. It should get settled. Sir, suppose you are an importer. You enter into a contract to buy the foreign currency at the end of third month. Yes, sir, that's what an importer does. Suppose now you want to buy before expiry, say at the end of second month. If that is the case, you want to execute, but before expiry, it is covered under the topic of early delivery. As an importer, you entered into a contract to buy after 3 months. Now you don't want to buy it, which means you cancel it on the day of expiry or before expiry. People in the class, you cancel it. Please imagine timeline. This is a start date, this is expiry date. This is any point between expiry, this is expiry. Before expiry, if you cancel it, or on the day of expiry, if you cancel it, it is all covered under cancellation. You entered into a contract to buy after 3 months. You don't want to cancel it. You will buy it, but at the end of 4 months, suppose 4 months, then it is covered under extension. Now you do that extension on due date or before due date, it is all covered under extension. Suppose you don't reach, you enter into a contract with the dealer. At the end of 3rd month, you don't go to the dealer. You have not met him only. Forget execution, cancellation, extension. You have not met him only, you have not gone only. And when the 3rd month gets over, the category is called as default. So basically in this entire topic, you have to cover 4 things: cancellation, extension, early delivery, and default. Yes, starting with cancellation. People in the class, please pay attention. Sir, timeline is really important. After 3rd month, if you cancel or extend or deliver, it doesn't matter. It is always covered under default only, right? One thing before I proceed ahead, you might think that, sir, at the end of 3rd month, when the contract gets over, when the maturity arrives, sir, will the contract be of no use? Will the contract be void? No. There is this authority which has made the rules. The entire topic is actually about the rules. There is this authority which says that till 3 working days, the contract continue to remain. After 3rd day, at the end of 3rd day, if the customer doesn't come, FIDI has made the rules for the dealers, for the bank. To the bank, FIDI says that you entered into contract with the customer didn't come, then please at the end of 3rd day automatically cancel the contract. Before 3 days, let the contract continue to remain. Sir, what does it exactly mean? When we go to default, we will understand. Correct? One more rule here is that whenever you have the exchange rate, when you calculate the exchange rate, you will have to round them off in the multiple of 0.0025. For example, if it is 52.9543, you will have to make it 52.95. What is the nearest number to 43? 25 or 50? 50. So you'll have to make it 9550. Yes. The last 2 digits of these 4 digits after decimal points, you will have to round off simply. Sir, when it comes to cancellation, extension, similar topics. You have to think from the point of view of customer. Early delivery, default, 2 different topics. You'll have to think from the point of view of bank. Sir, what do you mean? Me as a customer enter into a contract with bank. So first is customer's perspective, then is bank's perspective. Sir, first let's learn cancellation, early delivery, cancellation, extension, then a practical question, then early delivery its question, then default its question. That simple is the plan. Cancellation and its question. Sir, cancellation. You are a bank. I am a bank, you are a customer. You are an importer. You have entered into a contract to buy from me the foreign currency. Now you want to cancel it. You have come to me. I will say there's nothing called as cancellation. Means you had first entered into a contract to buy from me. Now you enter into a contract to sell to me. Automatically your position gets cancelled. Your position gets squared off. That simple is the story. For example, as an importer, if you have a long position, right? Now, as an importer, when you had a long position, you entered into a contract to buy. Now you entered into a contract to sell. When you sell, me as the bank, I will buy. Bid rate become relevant. Similarly, short position. You as an exporter, you had entered into a contract to sell. As an exporter, you entered into a contract to sell the foreign currency. Now you want to cancel it. I will say buy now, which means you will buy. As a bank, I will sell and relevant rate become ask. This is common sense. This is something I have not taught to you. Right now, this is all older knowledge you have. Next, sir, before you calculate the gain loss related to square of, first you need to find out precisely the cancellation rate. For example, as an importer, when you have a long position, you have already bought something. To cancel, you will have to sell it, right? So, what rate exactly will be used for the purpose of selling is termed as cancellation rate. So, in the cancellation rate, first learning was bid ask that you have taken. But which rate? Spot, 1 month forward, 2 month forward, what? So, really simple. At 0 point, we entered into a contract to buy, for example. As an importer, we entered into a contract to buy foreign currency. Suppose you want to cancel it at the end of first month. You want to say that, okay, after 2 months, there is a contract to be executed, which you entered before a month, but now 2 months are left. You want to cancel it. So I will say you should match the expiry. 1 month before, you did a buy of 3 month forward contract. Now after 2 months, you sell a 2 month forward contract. You should match the expiry of the original contract you did with this new contract you are entering into. Sir, at the end of 2 months, you want to cancel this older contract of 3 months. You use 1 month rate. Bid ask is a different story that depends on importer exporter. I'm just trying to teach you when do you use 1 month, 2 month, or 3 month forward rate to cancel a contract, right? Sir, if you want to cancel it on the day of expiry itself, fine, take that day's spot rate. That day's spot rate is what you will have to take for the purpose of cancellation. Are you understanding? Sir, till 3 working days the contract is not cancelled. Yeah, which is under the topic of default I'm talking about. Under the topic of default, you will learn that if you need to cancel, then using respective days spot rate, till 3 day the contract doesn't get cancelled. Suppose at the end of second day the contract needs cancellation, then at the end of third month today, whatever is that day's spot rate, that is being used as the cancellation rate. Here you use 3 month rate. If you go to cancel here, you use 2 month rate. If you go to cancel here, you use 1 month rate, and accordingly the cancellation rate gets decided. And bid ask is a different story. That's how your cancellation rate is. Everyone, could I convey to you how do you decide the cancellation rate? Sir, once you have decided the cancellation rate, if you're an importer, your initial contract was to buy it. Now the cancellation rate is to sell it. If you're an exporter, initial contract was to sell the foreign currency. Now the cancellation rate is to buy that foreign currency. Buying and selling obviously have some gain loss calculation. If the customer, you're a customer, you have gain, you receive from me, I will pay to you. As a customer, if you have a loss, you pay to me, I will bear it. Sir, that is how it is. And sir, so will be the practical question. But before teaching you the practical question, let me also teach you extension, because extension is nothing but an extension of cancellation. Sir, you came to me for cancellation, fine. Now you're a customer, I'm a bank. You come to me that I want to extend. I will tell you, extension is nothing. Extension is you cancel the old contract the way you have learnt it here. Fine. And since you want to buy now on a later date, or you want to sell now on a later date, why don't you book a new contract? So whenever you come to me for the purpose of extension, we will cancel the old, and on the same day we will book a new contract, and that is the simply extension of forward contract. Which means if it is the question of extension, the cancellation question automatically gets done, and the new contract also booking we do. If the concept is really clear, let me very immediately take you to the practical questions of this. Right. 38, 39 cancellation question. 40, 41 extension question. Let's do any particular question. Let's do 41 question. 41 question let's do in the class. Question on extension. Okay. So the other question automatically gets practiced. Sir, you should be habitual of doing both the situation. Cancellation and extension question on importer as well as exporter. We in the class right now are doing importers question, right? But the other questions are there which will make you practice exporters question, obviously. Yes, 41 question. Let's start to read. Give me a minute. Let me have water. Yes, people. So let's do the importer question. An importer requests his bank to extend a forward contract of USD 25,000 which is due on maturity in 31st October 2015 for a further period of 6 months. The other details are as under. Sir, let's imagine to this on timeline, or in fact without imagination, broadly it should happen. This is my maturity date, I mean expiry date. Here the contract was entered, right? Contract was originally for 6 months. The importer customer, can you tell me if he's an importer customer, what was his initial contract? The initial contract was to buy the 25k US dollar he wanted to buy. Since he want to extend for further 6 months, now the next 6 months will be the story. When does the customer reach to the bank to the cancellation is missing in the question, sir? In the absence of information, right? Let me teach you what we have assumed. And why is that assumption logical? That also I will teach you. Sir, original contract was to buy. When you go to the bank to extend, the bank says there's nothing called as extension. You cancel the old and book the new, right? Initially, the customer entered into a contract to buy. Now the customer will enter into a contract to sell. Now, sir, original contract expire after 6 months. Now, when do I go to the bank? Will decide whether I have to take the spot rate or forward rate or what. Sir, if I go after 3 months, then 3 months forward I take. If I go to the bank after 4 months, then 2 months forward I take. However, if I go to the bank on the spot date, on the expiry date, then that day's spot rate I will have to take for the purpose of cancellation. Correct, sir? The examiner has given to me the spot rate of 31st December 15, which is my maturity. Now, do you agree the examiner will give me the rate of the day, of that day, which is needed to me? If it has given to me the rate of 31st October, the expiry date, then that only I will have to assume that, okay, on that day, the cancellation got initiated, the new contract booking got initiated, which is why I'll have to assume that the cancellation is taking place on the day of expiry. Could you understand this, people? Examiner give me the rate on the day of expiry. I'll have to compulsorily assume that, okay, on that day the cancellation will happen because that day is the spot rate I'll have to use. Yes, no? Quick, everyone in the class, could you connect to what I said? That has been written over here. Boss. This is why specifically we are doing a question which has a particular ambiguity you can learn about. Yes. So fine, sir. Now we enter into a contract to sell. Initially, the contract was to buy dollar. Now we sell dollar. The rate is also of dollar. When we sell, the other party, the dealer buy everyone at bid rate, which is 62.32. But you know what? 62.32 is the interbank rate because the margin has been given. From bank's perspective, the margin is given. Bank will buy with this exchange margin, sell then this exchange margin. From the bid rate, the exchange margin gets deducted. So 60.32 minus 0.086% is 60.2681. Rounded off to 60.2675. Don't miss the rounding off, everyone. This is the cancellation rate. Now apply common sense. This is the rate at which customers sell inflow. This is the rate at which customer had initially bought outflow. And inflow minus outflow automatically give the gain loss for 25,000 quantity. Sir, per unit calculation is possible. Quantity dollar, rate is dollar. So 62.2675 minus 61 multiplied by this quantity, 14,650, the amount of loss customer will have to pay to the bank. Simplest question of gain loss had become, sir, next new contract rate. Now on the day of expiry, when you go, you are seeking further extension, right? The further extension has 6-month premium. New forward rate you will need. Sir, which rate? Now initial contract is to buy. Again you will re-enter into a contract to buy. When you buy, the bank will sell. The bank will sell at a ask rate. To take the ask rate, add premium rounded off 60.63 plus 0.98%, which is 62.2242, right, is the premium. Now sir, this is again an interbank rate. Forward rate, but interbank. You have to add this time. You will have to add, hello? You will have to add the exchange margin, sir, plus 0.55% is 61.3160, rounded off to 61.3150 is the new forward rate. New forward rate at which contract will be entered. 41st, a really brilliant question could I teach to you? Please tell me. In the meantime, just looking at a doubt. So I can't figure out your name. ISRANAAZ. Yes. So examiner won't do that mistake. Examiner will be clear. Only when it is not clear, it gives you such situation. How to deal with that situation, I have taught to you. Yes. Sir, that was question number 41. Correct? So when you book a new forward contract rate, please understand, one is forward premium, forward margin. Another is exchange margin, and then is rounding off. That's how you get the ultimate new forward rate. 41st question on the cancellation plus extension gets done, which has made us practice both the things. Now I'm trying to teach you early delivery. We won't understand the entire story, but we will learn it as much as is needed immediately to solve the practical question, right? Because story takes to explain, because the concept has the background story. You learn the background story, then concept takes time, and ultimately you have to do the concept. I tell you the story, you do the concept. I don't tell you the story, you do the concept. So anyways, learn the concept primarily. Yes, listen to me. Sir, early delivery, let's learn through diagram and importer's perspective. As I said, when it will be the case of early delivery and default, we'll have to think from the perspective of bank. First thing. Second, early delivery has, there's something called, there are two type of transaction you need to understand, called as buy sell swap and sell buy swap. Buy sell swap means buy in the spot market and sell in the forward market, and sell buy swap means sell in the spot market and buy from the forward market. So basically, when you do two opposite transaction, one is buying, another is selling in two different market, spot forward, then we name it as sell buy sell swap. These terminologies are going to get used specifically under this topic of fate of forward, right? Bringing you to early delivery, please try to recollect the concept we have already, learned in the class really well. You are an importer. You enter into a contract to buy, so bank enter into a contract to sell. Bank's perspective, original contract entered between the parties. This is between the bank and the party merchant market. Me as a bank went to the interbank market to buy so that I can cover this transaction. As a bank, when I sell something, then to cover, what will I do? Go to the interbank market and buy it. Yes sir, fine, this is also fine. We were expecting the customer will come on the expiry, so we thought from the interbank market we will buy the dollar to the merchant market. In the merchant market we will sell it to the customer. As a bank, my life is sorted. Could you understand what was my plan? Buy from interbank, sell it to you as customer in the merchant market. But you as a customer came early. Since you came early, I will have to do two things. First, I will have to buy from the spot market. Me as a bank will go to the interbank market, and from the interbank market I will buy in the spot market. Why? Because FDI rules says when the customer come early, you are an importer, you came to me early to buy something. FDI say don't say no. Deliver to him, sell to him under the original contract one, sell to him. But to be able to sell to you, I should have the dollar. I don't have the dollar in hand. I will get the dollar after 3 months, which is why go to the spot market, buy the dollar so that it can be delivered to you under contract number 1. So buy from the spot market so that it can be sold to you under contract number 1. Buying here will lead to outflow. Buying from the interbank will lead to outflow. And selling to you under contract number 1 will give me inflow. This much we are sorted. Fine, sir. Sir, next is sell forward. Sir, why? I know this contract number 2 was entered in the interbank because the plan was I will buy from here and sell it to you. Now, sir, I will anyways buy at the end of 3rd month. But where would I sell? Because you have already been delivered here. So, today, on the date of early delivery when you came, I enter into one more contract to sell. Why? Sell forward. Why? Whatever is being bought will be sold in the interbank market back again on the day of expiry. So the new sell forward contract that you enter into is for what period? For such a period that can match my original expiry of 3 months or 6 months, whatever be the case. That's how the new sell forward contract will be entered. Overall, when you came early, I didn't say no to you. I bought from the spot market, delivered to you, inflow and outflow clear. I also sold I entered into a new forward contract so that this can be bought and sold here, right? Overall, because of you coming early, I had to enter 2 extra transactions. Buying from the spot market and selling in the forward market, meaning to say I had to enter buy sell swap. Because of this transaction, whatever extra gain loss is there, I will recover from you because these extra transactions I incurred because of you, right? Now next. Sir, this is one gain loss called as swap difference. As an importer, buy sell swap is entered by the bank in the interbank market on the day when customer arrives. This is the clarity of concept I want to deliver. By the bank in the interbank market on the day when customer arrives. Fine, sir. Next. Sir, you were supposed to come at 3rd month. You came at the end of 2nd month. You came 1 month early. On the day when you came, there were 2 cash transactions. Cash transaction specifically, one is there in the swap only. I bought from the spot market. That is the first transaction cash. So there was an outflow. Why did I buy those dollars? So that I can sell to you. I can sell to you the foreign currency, which is why I bought the foreign currency. When I sell it to you under contract number 1, it is an inflow. One is outflow, one is inflow. If I can have the net inflow or net outflow, then interest for this time period is charged on that inflow outflow. Please understand, gain loss was settled here. Now the objective is not gain loss. Now the objective is time value of money. Those inflow outflow that could have happened at 3rd month end now is happening at 2nd month end. They are happening early. So if it is an inflow to me, net inflow to me on that day, it is a good thing that I'm having inflow early. Me as a bank, from the interbank market, I have early net inflow on which I can pass on the interest to you as a customer because of you, I got the inflow early. But in the interbank, if I have an outflow early, that is a loss. I will recover the interest on that net outflow from you because in the interbank market, I incurred the outflow. First part was about the gain loss. Second part was only about the interest on inflow outflow. Overall simplified. You don't have to remember the entire story, just few things. On the day when customer arrives, as an importer, for an importer, the bank will do a buy-sell swap in the interbank market. Buy-sell swap is buying a spot, selling forward, or for an exporter, it is selling a spot, buying forward. Whatever will people in the class lead to gain loss. Bank in the interbank, suppose gains. There I have a gain, I will pass on to you as a customer. To the bank, in the interbank market, if it is a loss, I will recover that loss from you. That simple is the thing. Sir, next, on the day, when you buy spot is fine. Sell forward, which can match your original maturity. Next, sir, interest on inflow outflow. On the day when customer comes, there are two cash transactions. First cash transaction is always in the swap transaction because you buy in the spot market. So buy a spot market, cash outflow. As an exporter, sell a spot market inflow. You identify the reason for the buy spot, you will automatically find second transaction. Sir, this contract number 1 is the reason. I have to sell to you, right, under contract number 1. So I bought from the spot market so that I can sell it to you. Selling to you is inflow, buying from the spot is outflow. Net difference for this time period, I will charge interest. What time period? The time for which customer has come early, time gap of 1 month, right? That is the concept. After making adjustment of these two things, I can execute the contract under of the contract number 1 at the agreed contracted rate, and the early delivery question gets over. You wanted to buy at the agreed rate, buy it. Just make the gain loss adjustment of these two things. Let's go to the practical question. You'll be able to relate to it very immediately. Let's solve question 42 in the class. People in the class, requesting all to read the question, please. Yes, boss. Question 42, let's read. On 19th January, Bank A entered into a forward contract with customer for forward sale of USD 7,000, delivery 20th March. Sir, bank entered into a contract to sale, which means for a customer it was a contract to buy, means importer perspective you will have to apply. Are you already there with me trying to understand this question? I am a bank. I entered into a contract to sell on 19th Jan 7,000 USD. On 20th of March, it's going to get delivered. 46.67 rupee per dollar is the agreed rate. Sir, contract number 1 information is given, contract between bank and the customer. Settled? Fine. You are an importer. On the same day, bank covered its position by buying forward from market on 19th March at the rate 46.655. My question to you all. On the same day, me as a bank, when I sold it to you, I covered myself, which means I went to the interbank market. I bought from the interbank market at a rate of 46.655 with the mindset that on the day of expiry, I will sell you at 46.67. This was my initial plan. 19th March, I will buy from the interbank. 20th March, I will sell it to you. That was the initial plan. Are you finding the story logical based on the timeline that you have understood? Fine, sir. I mean, point is, are you able to imagine? This is contract number 1, which is here. This is contract number 2, which is here. The customer is supposed to come on 20th of March. Let's see what happens. Sir, on 19th February, Just after a month, before 1 month, the customer approach and request early delivery. The customer says on 19th Feb that I want to buy it today. On the timeline, expiry is this. On 19th Feb, customer has arrived. He says, I want to buy. We said buy. Fine, buy under this original contract number 1. We are fine. Buy. Just make two adjustment. Which two adjustment? One is swap difference and another is interest on inflow or outflow. Sir, on the day when you come, I have to do two things. As an importer, buy, sell, swap. I have to buy from the spot market. As a bank, buy from in the spot market and sell in the forward market. Correct? Which forward? Which can match my maturity of 1 month. Are you able to connect? The timeline makes the thing really simple. Let me, as a bank, go to the interbank market, buy in the spot market, although I am a bank. But in the moment I become a customer, when I buy, the other party sell, the other bank sell at a ask rate. So 46.5800 is the rate at which I buy outflow. Then March forward, the forward which can match my expiry, I will have to sell in the interbank market. When I sell, the other party buy, which means bid is the rate and bid is the rate, and when I sell, it is my inflow. Sir, what is inflow minus outflow? The loss of 225 on $7,000, it is 1575 loss. Me as a bank, in the interbank market, have incurred a loss of 1575 because you came early, so I will recover this amount from you and pay to the other bank. That is the first thing. Second, on the day when you came early, there are two cash transactions that I've entered into. One, I bought from the interbank market at a spot rate at this rate. And I bought it. Why? Because I can sell it to you under contract number 1, 46.67, the agreed contract between us. So your rate gives me inflow. Buying from the interbank market gives me outflow. And if the net is gain, if the net is net inflow, it's a benefit to me, I will pass it on to you. But if net is the outflow, I can recover from you. Sir, 46.67 minus 46.58, I have net inflow. On $7,000, I have 630 rupee of inflow. You can try doing it on your calculator. 46.67 as a bank I'm selling to you, minus I buy at 46.58, 0.09 on 7,000 give me 630 rupee inflow that me as a bank have. An early inflow. How many days early? Sir, I have to do month-wise calculation. Despite dates have been given, don't do date-wise calculation. I received the inflow 1 month early. The rate on inflow is 12%, outflow is 16. When you are a customer, when me as a bank pay you interest, I will pay only 12. As a customer, you receive only 12. But as a customer, when you pay interest, me as a bank, when I receive interest, I receive 16, you pay 16. Customer is always at loss, correct? So 12% interest you will receive from me on 630 rupee for a year, for a period of 1 month, right? I will pay you 6.3 rupee of interest. So you want to buy early, buy. $7,000 at this rate, you buy. So you pay me 7,000 into 46.67, which means 326690 you pay me. But along with that, you also pay me 1575. I will pay you 6.3 rupee of interest, and there is a flat 100 rupee some penalty or charges which are there, that also you pay me. So you in total pay me 328 358.7. 328 358.7. People in the class, that's how an early delivery question is being solved. I literally need on this particular thing your validation. Could I really explain the entire story? Come on, tell me. Please. I particularly need your validation. Could I explain the entire story? What do you all say? Question number 47. Could you feel the imagination of this question? Can you fit the question to that story? Can you find it? Are you people finding it sorted? You want to know why 46.58? Let's try this. Anuka, me as a bank in the interbank market will do buy sell swap. Buy sell swap. The bank will go to the interbank market, although I'm a bank, but for that moment I become a customer. I go to the market, to buy dollar. When I buy, the other party, the other bank sell to me, and it will sell to me at a ask rate. Are you understanding? Which is why 46.58 is the rate. The other party buy at a, when for the importer, bank will buy, the other party will sell, but it will be at a ask rate. People in the class, kindly respond to me once. Are you people sorted? Could I explain it clearly? How the question of early delivery gets solved. Now taking you to the next discussion, which is default. Super fast. Come on, come on, come on. Expecting your responses. Can I take you to default? It's about around 5 hours. Yeah. Anuka, as I said, both of these transactions are entered by the bank. In the interbank market for buying and selling and whatever. Nothing it with the customer, nothing is by the importer to anyone. Getting? Only one cash transaction. When I buy from the interbank, why did I buy those dollars? So that I can deliver to you as a customer under contract number 1. That is the inflow I have from you. And for that also, the rate I don't need to calculate. The rate is already agreed upon under contract number 1 is the point. Correct? Now, people in the class, taking you all for default. It's around 5 hours and I'm expecting the lecture can go even for 7 hours. Well, hold on for a second. Fine. Super fast. Let's understand people in the class default. What happens in the default? Sir, you are an importer. You enter into a contract to buy. For me, it become a contract to sell as a bank. Again, bank's perspective, you'll have to think. Guys, now you remember, now you understand why am I saying bank perspective. Because it is the bank who will do cover. It is the bank who will enter into interbank transaction. It is the bank who will have this inflow and outflow. It is the bank whose perspective is needed. Similarly, for default, we need bank's perspective. You enter into a contract to buy. For me, it was a sell. I covered myself in the interbank market. I bought currency in the interbank market. So I thought from the interbank market, I will sell, give it to you. On the timeline, I thought I will sell here. In the timeline, I thought I will buy here and sell it to you here. That was the plan. But you didn't come at the end of third month. What did I have to do? Listen to this story. See, I will tell you the story, but after the story, the main point is this. The story I tell you so that you don't find it hard to remember these things, but ultimately these are the things you will have to do. Correct? So the story you have to listen, not to remember the entire story, but broadly. At the end of third month, I thought I will buy from here and sell it to you, but you didn't come. You know what happened? I bought from here. Under contract number 2, which was entered here, was supposed to get executed here at the end of third month. Sir, I bought. Now, whom do I sell? Since there was no one, you didn't come. I went to the spot market and sell in the spot market. I sold in the spot market. Interbank only. I bought from the interbank under contract number 2 and I sold it in the spot market, in the interbank spot market. Yes, fine. Now I knew that you as an importer were supposed to come here. You may come at any point in future, which is why I will buy a new forward contract, because the old forward contract which I bought here got expired. So I buy a new forward contract. So that now whenever you come, I can deliver to you when I buy under the new contract and deliver to you. Sir, this forward contract when you buy, what should be the expiry of it? Sir, whatever is the nearest available maturity? The FEDI rule says whatever is the nearest available maturity, for that maturity you buy the forward contract. Yes. So now if you observe, under contract number 2, which got executed on 3rd month, I had to go to the spot market fresh in the interbank spot market to sell the currency which purchased under contract number 2. And in that interbank forward market, I had to buy the same amount forward market for the nearest available maturity. Which means, do you agree, as an importer, the type of swap transaction that you do as an importer is sell by swap, sell spot, buy forward. As an importer out here it was buy sell swap, but now for default it is sell by swap by the bank in the interbank market. So whatever gain loss is there, you as a customer, at the end of 3rd month I have entered into a swap. On the date of expiry, even if you have not come, in fact because you have not come, I have entered into the swap transaction. Now whenever you come, I will recover the gain or loss on this transaction from you because it was entered because of your delay. Are you all aligned, agreeing to me? Sir, fine. Sir, now suppose you come after 2 days, then whatever, irrespective of you want to execute the contract or cancel the contract or extend the contract, I will say wait. I will not listen to what you actually want to do. I will tell you my things first. Sir, after 2 days when you come, I will say that at the end of 3rd month, which means before 2 days, I did a swap transaction. I'm telling you, me as a bank in the interbank market, I did a swap transaction. On that swap, if I have a gain, if I have a loss, I will adjust with you. Second, on that day, I had some inflow outflow. One inflow outflow I can identify from the swap transaction. Sir, importer did sell by swap, which means in case of importer, the bank did sell by swap. Me as a bank, in the interbank market, spot market, I sold. In the interbank spot market, I sold, gave me inflow. Can you think why did I sold? What did I sold in the interbank market? Sir, under contract number 2, at this contracted rate, I purchased some dollar because the interbank contract to executed here, and the same amount I sold. Which means, do you agree that what I purchased under contract number 2 was an outflow? I purchased a dollar, was outflow. I sold a dollar, became my inflow. So sir, these are the 2 cash transactions happened. This cash transaction that happened, if you would have come at the end of 3rd month, we could have adjusted the amount that day only. Now you are coming to me after 2 days. So on the net inflow outflow, on this net inflow outflow, whatever is the interest of 2 days, we will adjust. This is the second thing we will have to understand: interest on inflow or outflow of funds. Me as a bank did the transactions in the interbank market, transaction of swap difference and interest on outlay of fund. On these 2 transactions, we will first do the adjustment among us, between us. Sir, next, irrespective of wherever you have come to me, irrespective of why you are coming to me, correct? You people, please realize you will have to cancel the older contract, which means you will have to apply the logic of cancellation that you have learnt here, which means for the purpose of cancellation, you have to apply this logic, this logic, this logic. Think from customer's perspective, not from bank's perspective. It is your perspective which is to be thought for cancellation. So irrespective of why you have come to me after 2 days, I have told you, let's adjust the swap difference. I have told you, let's adjust the inflow or outflow for this time period. Let's do the cancellation charges adjustment, also called as exchange difference. Cancellation charges is also called as exchange difference. And now you tell me, why have you come? If you want to execute, I will say the old contract doesn't exist, it's cancelled. Buy at a spot rate if you want to buy today. You want to execute, you want to buy it now at the spot rate. You want to cancel, it's already cancelled, you may go home. If you want to extend, extension is cancellation per new booking. Cancellation has happened, new booking you can do today when you have come to me. That's how it works, people in the class. That's how, people in the class, it works in case of default. So in conclusion, as an importer, think from bank's perspective anyways, and we are lucky that early delivery you have to cover both perspective, importer and exporter perspective. But because both the kinds of question has been asked by the institute in the exam, but for default we see that in the past exporter question has never been asked. If you want to be really comprehensive, you may cover export, but primarily you should be able to cover importer's perspective. Sir, importer perspective is sell by swap. On which day? On the day of expiry of the contract, which will lead to selling in the spot and buying from the interbank market under forward. Selling a spot interbank, buying forward interbank, correct? The swap difference, gain loss, is adjusted with the customer. The inflow outflow for this time period adjusted with the customer. The cancellation charges are adjusted with the customer. Sir, when you do a swap difference, you sell spot, you buy forward of nearest maturity, whatever is available. On which day? On the day of default. Inflow outflow on which date? On the day of default. Sir, why are you telling this? Examiner will give you rate of this day, this day, this day. Which rate will you take? Sir, on the day of default rate you will take. This is irrelevant. Sir, next. Sir, if we talk about inflow outflow, when we sell in this spot market, there's an inflow. Think, why did you sell? This contract number 2 which got executed here is why we had to sell in the spot market. So under contract number 2, we bought from the interbank market at this agreed rate 2, which gave me outflow. The same thing I sold back in the interbank spot market, which gave me inflow. Inflow minus outflow, the net difference inflow outflow for 2 days, and last is cancellation. Last 2 important things. In all this situation, whether it's a swap difference, cancellation charge, interest on outflow of fund, please remember, swap, interest on outflow of fund by the bank and the interbank. Exchange difference between me and the customer, it is about the merchant rate, it is about the me and the customer. Yes, me and the customer, first thing. Second, sir, if the situation is that the bank will have to pay to you, the customer, we won't pay. We want to penalize you for defaulting. However, if the situation is customer will have to pay to the bank, then we recover from you. That's how it is one-sided in case of default. Boss, last thing. Suppose customer rather than 2 days come after 10 days. Then first thing at the date end of 3rd day, the contract gets automatically cancelled. Cancellation at the end of 3rd day will automatically cancel even if the customer come after 10 days, first thing. Sir, how will the cancellation happen? The cancellation, people in the class, will happen using this situation, that after expiry, using respective days spot rate, till the end of 3rd month, 3rd day, the cancellation happens. Next boss, suppose customer come after 10 days. The interest will be charged for how many days? For 10 days? No, the interest of only 3 days will be charged. Even if you come after 3 days, interest for a maximum period of 3 days can be charged. If you are clear with this thing, let us try to apply the concepts that you have learned to the practical question, and let's solve question number 44 for this. Right? Start to read the question right now. Everyone in the class, come on, super fast, please. Just give me a minute. Read the question, come on. Come on. So super ultra fast, everyone in the class. Question number 44 we gonna do in the class right now. Come on. Z has to remit USD 1 lakh for his daughter's education. Please understand, you have to buy the foreign currency to remit. So it is like importer's scenario. Importer also buys, right? So Z buy $1 lakh daughter education. 4th April the contract entered. On 4th April has to remit. So has to buy. So on 4th April she is planning to buy. Accordingly, she booked a forward contract with his bank on 4th Jan. So on 4th Jan only a contract is entered with the bank. So you are Z, I am the bank. You entered into a contract with me on 4th Jan. At a price of 73.8775 per dollar, you will buy from me 1 lakh USD. The bank covered its position in the interbank. I am a bank. I went to the interbank market. People in the class, you will have to ultimately, after we are done with this question, help me to understand, could I make you people imagine the entire question through that concept or not? Align this question to that concept in the OutNotes or not? So let's start. You are Z, I am bank. We entered into a contract. You will buy from me $1 lakh at this rate. Me as a bank, I have sold it to you. So to cover, I will go to the interbank market, right? So I will buy from the interbank market. Examiner not specified whether I buy or not. It's your understanding, my understanding, that me as a bank, I will go to the interbank, buy at 73.7575. What my initial plan? That I buy from the interbank at this rate, I sell it to you at this rate. Simple. How much quantity? $1 lakh. Fine. The exchange rate on interbank on 4th, 7th and 14th April. 4th April, the expiry date. 7th April, 3 working day automatic cancellation date. Sir, 14th April, we don't know. The spot market of $1 on respective day, bid ask were this. Fine. March, April, May, June, respective month end forward rate are this. First ambiguity, if the date is 4th, 7th and 14th April, can we have in the market a contract which expired in March? A contract which has expired in March on 4th or 7th or 14th of April, will it have any rate? Will it trade? Will it exist? No. This is what the ambiguity is. This line ideally should not be there. Fine. Exchange margin 10%, interest on outlay of fund 12%. The remitter, which means Z, due to rescheduling of the semester, has requested on 14th April for extension with due date 14th of June. The contract expired on 4th April. She could have come max by 7th April, but she came on 14th. She came on 14th. And after coming to 14th, what is she asking? Extension of the contract. She's saying that now the due date is 14th June. She says, you are saying to me that I want to buy, which means you want to buy. On which date? On 14th of June you want to buy. People, is the question clear? You were supposed to come to me on 4th April. You didn't come till 7th, contract got automatically cancelled, you came on 14th. Now when you came on 14th, you are seeking extension. When you didn't come to me on 4th, I did in the interbank market two things: swap difference and inflow outflow. Me as a bank went to the interbank market, I did sell by swap. I sold in the interbank spot market and bought the nearest available maturity forward contract. Sir, first on the 4th I do it. The other dates are irrelevant to me for swap difference. 4th April. Me as a bank, I went to interbank, which means will I do any exchange margin adjustment? No. Transaction by the bank to another bank, interbank market, no exchange margin adjustment. When I buy to sell in the spot market, for that moment I become a customer. When I sell, the other bank buy from me, the dealer buy from me, and they buy at bit rate. Fine, sir. I sell in the spot interbank inflow to me as a bank. I buy the nearest available maturity forward. Sir, the nearest available maturity forward is this. Sir, although the March is over, but unfortunately question has done this and we will also have to do this for marks. Nearest available maturity as per the data of question is March. When I buy in the interbank forward market, the other bank sell to me at ask rate. When I buy, it is an outflow. For swap difference, inflow minus outflow, so 73.2775, third part, look at the swap loss. 73.2775 outflow, right, inflow, and 73.4275 outflow. The difference, people in the class, is 0.15 overall loss which bank had to incur in the interbank market because you didn't come on 4th. 15,000 I'm going to recover from you. First thing gets done. Second, interest on outflow of funds, inflow of funds. Please tell me, could I explain the first thing? Is your imagination set with the first thing? I need your validation. On this particular point, people in the class, I need your validation that on the day of expiry, the sell spot and buy forward of nearest maturity by a bank to another bank in the interbank market. Are you people please set with the first one? Please tell me swap loss. Waiting for your responses. Date is also clear to you, is it? Let me complete the explanation, then I'll answer whatever doubts you have. But for now, if you're settled or not, please tell me. Come on. The next thing. Next, sir, bank had inflow and outflow on this day. So when I sell in the spot market, sir, this was the rate at which I sold it, it is my inflow. I sold it in the spot market, it is my inflow. Sir, if you identify the inflow, that why this inflow happened, it is all great. Sir, you remember it is contract number 2. It is contract number 2 which got executed here. So I bought from here so that I can sell it in the spot market. So this become my outflow. Sir, this is my contract number 2. Please understand, this is inflow, this is outflow. The net is inflow or outflow, and what matters to me is not that inflow outflow but the interest component. Sir, 73.2775 minus 73.7575 is 0.48. $1 lakh give me 48,000 of outflow. 48,000 doesn't matter. The interest at the rate of 12%, only for 3 days. The customer is late. The customer is 14 something days late. What matters to me is a maximum of 3-day interest. If you observe, please realize 4th, then 7th is the last day of charging interest. She is 10 days late in total, right? So 48,000. At the rate of 12%, 3-day interest is 47. So me as a bank in the interbank market had a net outflow. I will recover 47 from you. Third I have to do is cancellation. Sir, automatic cancellation will happen after 3 months, 3 days. Look at this. Now which rate is relevant to me? 1 second. Which rate is relevant to me? Sir, you come to me on 7th April is relevant to me. Why? Because the automatic cancellation, the cancellation automatically happened on 7th. Cancellation, you have to think from customer's perspective. You entered into a contract to buy at 73. If you want to cancel, you enter into contract to sell now. When you sell, me as a bank will buy. Do you agree? Respective days, a spot rate is being used. Now you sell, I will buy at a bid rate 73.1575. But this is the interbank rate, boss. Transaction is between customer and us, which means the exchange margin has to be adjusted. Yes, sir. And then, more importantly, not just exchange margin, the rounding off should also happen, because it may not, see, observe, all these rates are already rounded off the way we needed. But the rate that we may calculate may not be rounded off. For example, cancellation 73.1575. Yes, minus the exchange margin of 0.1%, rounded off to 73.0850 is the cancellation rate. Next is amount payable on $1 lakh. It means the cancellation amount. Catch the rhythm of the question. First cancellation rate, then the amount, which means cancellation amount. You as a customer bought at 73.85 means your outflow. Now for cancellation you have to sell at this rate. This is inflow. So inflow minus outflow give you the loss of 79,250 that customer has. So your loss you will have to pay to me. You have to pay me 79,250 cancellation. You have to pay me 15,000 swap difference. You have to pay me 47 rupee interest on swap. Matlab overall, all three things which were supposed to be adjusted have been adjusted. Are you people 100% clear? Three things. The total cost is the total of the three. Simple. Sir, last is what is the new contract rate for the purpose of extension. Now you come to me on 14th, the other two dates become irrelevant. On this day of June, you want to book a forward contract, book this rate. Because transaction is between bank and the customer, adjust exchange margin, round it off, and that will become the new contract rate. The question 44th, people in the class, I have tried my best to explain it. Please tell me if you are settled or not. Please, please, please. 44th. Are you people really in the class 10 on 10 settled on question 44th? If you have any doubt now, you may please ask, else we consider it as done. People, 44th, it is all done. To be able to next question, solve the next question, we will have to first understand the next concept. People in the class, please super quick, come to the next concept. Boss. What's happening? Are we all set? Yes? Quick. So let's do one thing. The plan for the day is we cover at least this entire topic today, which means till future and option we cover everything, which means in OutNotes we cover till futures and option. Then in the chapter of Forex, we will be left with two things which belongs to Forex, but it seems difficult we'll be able to cover it today. First, the foreign exchange currency account, nostro account, that simple thing, or if possible that thing also we do today only. So only one topic which relates to Forex, which is foreign currency investment and borrowing decision. Except for this particular topic, we will be done with everything today. So maybe when we do international financial management, this is when we do. Because other topics like international cash management, international capital budgeting, adjusted present value, IDR, GDR, all these anyways belong to the international financial management, right? So let's make sure that at least till forward futures and options we are done. Now I'm taking you to the next topic. Let's take a quick 2-minute break before we start. Settle down and then we take it ahead. Yes. Mandy says, just completed your power batch. I had never understood this kind of understanding. Thank you so much, Mandy. I'm happy to see that the lectures helped you out. Yes, people. Let us take a 2 minute break, post which we come, complete, understand this topic and complete it. All right, people. See you all after 2 minutes. Bye. Chaliye boss. Are we all there? People in the class, please. Shall we? Hello? Boss, so what's happening? Let me tell you. We are in the next section called as foreign currency exposure. Meaning to say, when we enter into a foreign currency transaction, when I import in foreign currency, export in foreign currency, I'm exposed to the risk. We learned it in the forward hedging, right? That after 3 months, what will be the rate? We don't know. So as an importer, well, I will buy after 3 months. At what rate? We don't know. As an exporter, when I export something, I'll receive the foreign currency. At what rate I'll be able to sell that foreign currency? I don't know. So that is an exposure. How do you hedge, right? So along with the transaction exposure, you have also something called as operating exposure. It is mainly a theoretical thing. But unfortunately, we have one question of typical nature, question number 46, right? Again, being transparent, we are not discussing it in the class. It is question of study material. I would suggest if you can cover it at your own, it'll be great. We are not discussing in this video. Being typical in nature has got nothing to do with any other concept, has a probability, but a rare probability of being asked. In the last 16 years, it has not been asked. Now, in the attempt of Jan 26, May 26, or any of the attempts, if it may gets asked, then that's a chance you will have to take. If you have a comfort, you must cover question 46 at your own. Done? Now, coming back to the transaction exposure. When I want to hedge the transaction exposure, there are two ways, internal and external. What do I mean by internal? In fact, what do I mean by external? External is using some kind of derivative instrument. Forward. Money market is not derivative, but is using some kind of external tool. So we have learned how do you do forward hedging. We have learned money market, futures and options. The one that we have learned in derivatives, we will do it again now. Before external, we need to cover internal hedging techniques. Internal hedging techniques, meaning to say, sir, internal hedging techniques involve some kind of change internally in the process so that the risk gets eliminated. For example, invoicing in home currency. For example, I am an Indian company. I imported, that was billed in USD. It was a foreign currency transaction, so I have to pay dollar, I have to buy. Imagine it is billed in rupee. Now I have to pay rupee. That what I imported, if it is billed in rupee, I have to pay rupee. It become a home currency transaction. To me, there is no risk. Agreed? Such as invoicing in home currency. There is one particular question, question 47 on home currency invoicing. That's really easy. Let's super quickly look at that question. XP Pharma acquired export order of rupee 10 million to a European company. I have to export it to a European company. Although this question doesn't specifically relate to home currency invoicing, but its broad thought process is choosing an invoicing currency. The company has planned to import bulk drug of rupee 5 million from a UK company. From UK, I will buy of this much rupee. To Europe, I will sell of this much rupee. The proceed will be realized in 3 months. Payment of import will have to be done in 6 months. Inflow after 3 months, outflow after 6 months. Invoicing can be done in 3 currency, dollar, euro, pound. We have to choose the currency of invoicing. Sir, please understand what is happening. 10 million I have exported to Europe. To Europe, which I have exported, I don't have to compulsory invoices euro or rupee. I have a choice. To the European export, for that European export, I can invoice it at dollar or euro or pound. Which one will you invoice it in? Sir, logic is using spot rate, I will invoice it. So my invoice based on the present spot rate will be in terms of dollar or in terms of euro or in terms of pound. I will receive respective foreign currency after 3 months and I will sell that foreign currency at the available forward rate. When I sell that foreign currency, I will have an inflow in rupee, my home currency terms. Whichever currency invoicing gives me the maximum amount of inflow, that is the best currency in which invoicing should be done. For example, sir, 10 million is the amount at which the invoicing is to be done. Sir, now choosing between bid and ask is really an interesting thing. I have to, how should I explain? Wait. Do you agree? Whenever I receive dollar, suppose I invoice in dollar, whenever I will receive dollar, I will have to sell it. Whenever I receive dollar, I'll have to sell it. When I go to the market to sell it, the bank will buy it at a bid rate, which means against the exports, which rate is generally being used? Bid rate is used. So, sir, 10 million on your calci, 10 million divided by 67.1 give me the amount of invoice as 1493, 1493 one something. Similarly, 63.15 when you divide, 88.65 when you divide, you get respective currencies invoice amount, right? The invoiced amount when you receive after 3 months, you will sell at forward rate. Now, what is the forward rate? Sir, 7% is the rate of premium, annualized premium. If the dollars rate is given, we will assume dollars at premium. So please apply common sense and find the forward rate. Sir, one thing I want to tell you. When examiner asks us to calculate premium discount, listen to me carefully. When examiner asks us to calculate premium discount, we calculate annualized. When examiner give us the amount of premium discount, it is always considered periodic. Meaning to say, here they mentioned annualized is fine. However, if they only say premium, we will consider it to be just 3-month premium, meaning to say, in this case, it's not possible. If I'll make you observe other question, let's observe this question. Do you remember this question where they gave you the amount of premium? Wait for a second. 6-month premium they mentioned. We never understood the premium amount to be annualized. There is similar question in interest rate parity theorem where premium is not assumed annualized. It is considered periodic only. In this case, they have specifically mentioned the annualized premium. So if the annualized premium is this, you can apply common sense. Premium of 3 months will be 0.07 into 3 divided by 12. 0.07 into 3 divided by 12. 0.0175 plus 1 multiplied by 67.1, 68.27425, 2743 in fact, 2743, right? We'll do it till 4 digits. If we are not confident, 4 digits is the best. Forward rate I have. So these dollar receipts, I will go to the market and sell at this forward rate, giving me a total inflow of how much? Sir, 68.2748 multiplied by 149,031.297 is 101,75081. 101,75081, something of this sort, you may please consider it. But did you understand what you have to exactly do? Similarly, if I invoice in euro, this is the invoice amount. When I receive this amount, this is the rate at which it will be sold. The final inflow, the final inflow. The highest of the three is to be chosen for the purpose of invoicing currency, and similarly, the lowest of the three for the sake of outflow is to be chosen for the invoicing currency. Boss, 47th, could I explain? Could we all? IFM will be covered in the next live class, most probably tomorrow only. Most probably tomorrow only. So there is a possibility that tomorrow we have 1 or 2 any live session. If it is 1 session, then it will be IRRM. If there are 2 sessions, then 1 for IRRM and 1 for IFM. Yes, boss. Come on, are we all sorted? So 47th question, I gave you a sense of what is to be done. Similarly for import, You have a choice in which currency you can invoice, right? Currency choice, you can see. For the purpose of invoicing currency, use a spot rate. That this is the rate at which invoice will be made. But to that, convert that invoiced currency into the amount of outflow for import, use the forward rate. Yes, sir. 47th question gets done. Next concept is leading lagging. The concept is really simple and interesting. Let me tell you what it is. Just give me a second. Dhananjay, all the lectures of revision will be on YouTube. These are revision lectures, will be available on YouTube. Sir, what is leading lagging? Let me explain, people in the class, really a great concept. Sir, at 0 point, suppose you import something. So you know you have to make the payment of it after 3 months. One option is to use external hedging, use the forward contract and make the payment at the end of 3rd month. Another is leading lagging. The word leading is paying early, the word lagging is paying late. Such a simple thing you have to do. Boss, at the end of 3rd month, you have to make the payment. I am a party, we are the party. Let's collectively become a party. We are a party. We have to make the payment to the another party after 3 months. We call him that boss. What if we pay today? Why would you pay today to him? Because after 3rd month, what is the rate? ST, we don't know. But today, if we pay, we know the rate. But sir, what is the motivation? The discount. We call him that if we pay today, what is the amount of discount we will get? Because if you get some discount, for example, you have to actually pay him $1 lakh. But today, if you pay, you might have to pay only $98,000, for example. If you pay 98 today, then using rupee per spot rate, you can buy $98,000. And since you don't have rupee now, you can borrow that amount, add the interest, and ultimately find out at the time of repayment of that rupee how much is home currency outflow from your pocket. You may think it is a process similar to money market. Agreed, it starts here, it ends here, but there is a difference. Here it is the discount amount which is relevant. Based on the amount of discount, you get to know how much is the amount to be paid to the party today. This is the amount of foreign currency to be bought. When you buy using a spot rate, you have to pay home currency. You borrow that amount and ultimately repay the borrowing. So you have a choice, basically. You have a choice, basically. At the end of 3rd month, you have a choice. At the end of 3rd month, you can cover either through forward, make the payment at the end of 3rd monthly through forward, or do the leading and ultimately borrow that amount and repay to the bank. In both the case, if it is home currency outflow, ultimately it should be your home currency inflow, the final one, based on which you will take decision. If it is outflow, lower is better. If it is inflow, higher is better. That is how it happens. Understanding? Are you all? Please do it. So leading, lagging, that is a simple thing. Let's do a practical question on this. So let's do question number 48 only. Let's do question number 48, the question from study material. People in the class right now, come on, start to read the question. Gribrillator Limited has imported 5,000 bottle of shampoo at a cost of USD 20 each. So 5,000 into 20 is $1 lakh. You have imported, you have to make the payment. The company has a choice of paying the goods immediately or 3 months time. You pay now or after 3 months. It has a clean overdraft where 14% is the rate of interest. Fine. Calculate which of the following alternative is cheaper. Pay in 3 month time with interest at the rate 10% and cover the risk with forward. Sir, this is the amount to be paid today. The timeline will solve your thing. Today is 1 lakh. When you pay after 3 months, it is 10% interest for 3 months. You will get the amount of dollar you need to pay. The same dollar you need to buy at a forward rate, you will get the amount of outflow. Option 2, you pay today. Option 2, you pay the amount today using spot rate. But you don't have that much of rupee available. That is the amount you borrow, and borrowed amount when you repay, you will get the amount of rupee that finally goes out of your pocket. Correct? So let's start. Sir, 1 lakh rupee. If you pay after 3 months at the rate of 10%, what is the interest? Sir, 1 lakh rupee into 10% into 3 divided by 12 is 2500 plus 1 lakh. 1 lakh 2,500. These many dollars I will buy after 3 months. What is the forward rate? Sir, I buy dollar. Rate is of dollar. The other party sell, ask rate, that to forward. Please don't miss that it is high low, which means it is the discount scenario. So 60.55 minus 0.25 give me 60.30 become the relevant rate. 60.30 become the relevant rate. So 1,02,500. Where is that? One second. The presentation is actually a bit incorrect. The presentation in the OutScanner is bit incorrect. Answer may be correct, but the presentation is misleading. First, I should add interest to find out the dollar payable. The same dollar I should buy at a rate of 60.3, right? So 102,500 into 60.3 gives me 6180750, the amount of outflow if I pay after 3 months. If I pay today, then $1 lakh I buy at a spot rate of 60.55. 1 lakh multiplied by 60.55 give me 60,55,000. But that amount I don't have. So let's borrow under OD at the rate of 14%. So into 14% into 3 divided by 12 is 21195. So 62,66,925 is the final outflow. At the end of third month only, using forward, this is the outflow. Using leading, this is the outflow. Forward outflow is better. That is a better deal, cheaper to go with option 1. That simple is question number 48. People, 48th, could you understand what do you all say? 49, similar nature easy question, must to do at your own. 50 question is really comprehensive, is not a study material question, but is really comprehensive, right? In the handmade notes, you will find that question 50 has been represented really well. A very comprehensive timeline for question number 50 we have. Such a huge question through this presentation become really simple that you can refer. Take the screenshot. These are regular batch notes. The PDF is not available for everyone in general openly. Please take this screenshot. Yes, boss? It will help you to understand and do that question really well. When you do that question, you will realize the starting point is this. You lag, you lead. Paying early is lead, paying late is lag. And then you make respective calculation. What a brilliant question that is. Yes? So 50th question I talked about. Next question of this type. So we have actually solved one question of even, leading and lagging. Although has some other question as well, but in the revision video, we can afford to solve only one question of each type, right? Sir, leading, lagging is done. Netting has one practical question. Matching I have explained. Matching the inflows with the outflows is matching. Netting I'm just explaining. I'm giving you sense of it so that one particular question that is there, you can do at your own. Netting is really simple. Sir, you are a subsidiary company. I am a parent company. I am Indian being a parent. You are subsidiary being US company. I have to pay you dollar. You have to pay me rupee. So one option is that whatever dollar I have to pay to you, I go to the market, buy those dollars, pay to you. You have to pay me rupee. So you go to market, buy the rupee and pay to me. Another option is we do net. I mean your payable, or maybe my payable of dollar to you, I convert in rupee. My payable of dollar to you, I'll figure out in rupee terms how much is that amount. So that way I'll get to know that I have to pay you some rupee, you have to pay me some rupee. Only the net adjustment we will do in terms of rupee, that is simply netting. Netting the closing balances with each other is netting. Boss, one practical question number 52nd, which is extremely easy and which has kind of very rare in nature, frankly. Although we have an MCQ in the MCQ section of OutScanner related to netting, which is there. Yes, people. So that's there. Sir, now, so mainly in this entire section, we had to do leading lagging. One question of netting is there, one question of invoicing is there, which is all fine. Now, mainly external hedging techniques is what we'll talk about. And in that, we will talk about futures and options. Yes. Now talk about futures and options. Correct. So taking you all to the next category, futures, extremely interesting and extremely easy if you are able to imagine things. Let me summarize the concept for you and then you realize the practical question solution become really easy. So let us proceed. Sir, hedging through futures. At 0 point you import, so you know you will have to buy the foreign currency to make the payment, but what is the rate we don't know. The golden rule says do in derivatives today the same thing. Sir, at 0 point recollect a derivative concept. At 0 point, when I'm afraid, I start the hedging, which means I take the position in derivatives. What is the intent? Intent to avoid the loss that can happen in the spot market. In the spot market, we don't know what will be the rate. There is an uncertainty. If we want to avoid that uncertainty, we take a position today in the futures market. Right? And boss, on the day when hedging gets over, we settle the positions. Sir, what all position will we have? Please listen to me. At 0.2, I know that I'll have to buy from the spot market. That position is there. At 0 point to hedge, I will also take a position in derivative, take a position in future. That future position also I will have to settle on expiry. So on expiry, I have two things: the actual buying selling of the spot market and the settlement of futures position. Sir, what kind of settlement do you do? Net settlement, the gain loss settlement. Do you remember the convergence chart of derivative below which I have taught to you the gain loss, simply inflow minus outflow? That is what you will have to do. I'll revise here also, so don't worry. Sir, today, before proceeding ahead with this specific thing, let me try to teach you a particular thing. Sir, when I say TCS future is trading at rupee 4,000, it is not confusing because you know the underlying asset is the share of TCS and it is priced as rupee 4,000. But when I say rupee per dollar future is 85, it's confusing. What is the underlying currency? We don't know. Here I know the underlying asset what TCS. Here I don't know if the underlying asset is rupee or dollar. 85 is the rate, fine. Sir, rupee per dollar, the base currency of the future rate is dollar, which means the underlying currency is on dollar. Meaning to say, futures is a contract to buy or sell an asset on a future date, on a later date, right? Sir, contract is on dollar means it's a contract to buy or sell dollar on a future date at a price of 85. Do you remember futures are standardized? So you cannot buy a single dollar. Maybe if the contract size is $12,000 means you can buy 12,000, or in multiples of $12,000 you can buy. Yes, boss. So what we say? That underlying currency you identify in two ways. What is the base currency of the future rate and what is the contract size? Once you identify the underlying currency, it is of help. How? That I will teach you later. Now let's calculate let's learn how do you calculate the gain loss. Sir, position entered today, suppose is long. In futures, you enter into position. It is a rupee per dollar future. Position is entered at 61.5 for 3 contract of size 50,000. Meaning to say, today when you enter into a long position means you buy something, right? At a price of 61.5 in rupee per dollar future. So first thing, futures underlying currency is dollar. Why? Base currency is dollar, contract size is dollar. meaning to say it is a contract to buy dollar, contract to sell dollar of this quantity under every contract at a rate of 61.5. If I take a long position, I have entered into contract to buy dollar at this rate, means it's my outflow. When you buy something, this much rupees your outflow. Fine. Sir, on a later date, on the day of settlement, suppose the price becomes 62.75. Now, do you agree that when I buy something, to square it off, I will have to sell? And selling at a price of 62.75 will give me inflow. So inflow 62.75, outflow 61.5, and difference of inflow minus outflow is the gain. That much rupee of gain, rupee inflow minus rupee outflow give me rupee gain of this much on every dollar. One contract has 50,000 such dollar and I have entered 3 such contracts giving me my total gain or loss in rupee terms. This is one example we have done. Similarly, you can have short position. When you take a short position, you sell at this rate, you have an inflow. To square off, you will buy, you will have an outflow. Inflow minus outflow will turn, otherwise same amount will be loss. You have learned that how do you do the net settlement of futures? One, by calculating gain loss. Second, you have learned the futures is on dollar, that you get to know by way of two things. Third, you have learned when you have underlying currency as dollar, and when you do the settlement of those futures, the gain loss obviously is in another currency, which is rupee. Is the conclusion clear to all the students, everyone? Is the conclusion clear? So now, first thing is we will identify the underlying currency. If it is dollar rupee, then we identify, as per golden rule, we have to long or short, and then we identify the number of contracts in the futures we have to take. Once this is done, the settlement is really easy. Let me take you. The initial understanding may look stretched, but the exam solution will be really easy, that I can assure you. On the calci, we're gonna do a question which you'll find easy. So there is this left side situation and right side situation. Left side situation you won't see in the exam, rarest chance. Right side situation very much probable as compared to the left side situation. Sir, what are the situations? Let's observe. ITC has $110,000 payable in 3 months. I am an Indian company. I have to pay dollar, which means I have to buy dollar in 3 months. I went to the market. In both the case, left hand side rate is rupee per dollar, right hand side rate is dollar per rupee. Sir, please observe the difference first of all, so that we can continue in the right hand side. Come on. Please, 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 everyone. Come on. Come on. Did you observe the difference? Yes, sir. Dollar quantity to be hedged, dollar exposure to be bought and sold after 3 months, but to hedge, the rate of dollar is given here, the rate of rupee is given here. This situation is really easy. Examiner asks a rare question. This is a bit slightly difficult. Examiner asks you the question. Sir, let's learn this one. Today when I went to the market, in the spot market, dollar per rupee was this. 3-month futures today was 0.021. On the day of expiry, after 3 months, when I went to the spot market, rate was this, 3-month futures was this. Sir, based on the logic of convergence, the two rates should be same on the day of expiry. After 3 months, a third month future is equal to spot. Ideally, yes. But if it is not, accept what the examiner is giving to you. Fine, sir. Margin, ignore. Contract size 2 lakh rupee, interest rate 12%. Sir, first of all, this is only for you, not to the examiner. You will have to ever tell. Just for your understanding, tell me, underlying currency is, the future is on which currency? What is the underlying currency, sir? Rupee. Why? Contract is about buying and selling rupee. The contract is not for buying and selling $10,000 in one shot. It is about 10,000 rupee. Second, overall overall rate of rupee has been given, underlying currency rupee. So now decide the position. I want to take a position today in futures. The golden rule said do in derivatives what you will do in spot. So today when you start the hedging, take the position as per golden rule. Sir, if you are an importer, you have to make the payment of dollar in the spot market after 3 months. So in the spot market you will buy dollar after 3 months. Golden rule says buy the dollar today only in the derivative. You went to the derivative market, you realize it is the rupee future given. Contract you can enter but in rupee. So buying dollar is equivalent to selling rupee. So you will take a short position in rupee futures if you are an importer. Sell rupee future at the rate of dollar per rupee 0.021. Today when I go to the market at this price, I enter into a contract to sell rupee at this rate. Are you finding it logical? However, if you are an importer, exporter, after 3 months you have to sell dollar. As per golden rule, you sell dollar today only in the derivative. Sir, you went to the market but the rate is of rupee, shop is of rupee, so you buy rupee, which means as an exporter you long, rupee futures. In our case this is the case of importer, so we will sell rupee at this rate. Next, sir, you decide the position. How many? Sir, actually I have to buy dollar, but the contract is on rupee, so I agreed to sell rupee off at this rate. Can you tell me how many rupee I will have to sell to get or to buy these many dollars? Sir, simply how many rupee will I have to pay? How many rupee will I have to sell to get or to buy $1,10,000 at this rate? So 110 divided by 0.021. 110 divided by 0.021 tells me the total rupee to be paid, total rupee to be sold. Can you sell 1 rupee at your wish? No. Every contract requires selling 10,000 rupee. So whatever is the amount divided by, where is my contract size? By mistake I was referring to margin as the contract size. My mistake. Contract size is 2 lakh people in the class. So under every contract I will have to sell 2 lakh rupee. So overall how many contract based on rupee I will have to sell to buy those many dollars? To a 26.19, rounding it off to 26 contract of rupee short. To the examiner you don't have to tell this. To the examiner you don't have to tell this. For examiner you will have to start like this. Today number of contract is this divided by this divided by this. 26 contract of rupee short at the rate 0.021 dollar per rupee. That simple is going to be the presentation to the examiner. Could I explain to you the logic? Ultimately I had to buy dollar, so I converted it to finding out selling equal to how many rupee, then selling these many rupee for this contract size is how many contracts. Sir, now really simple. Whatever contract has been entered, right, 26 contract you have short. So now you have two things. You have taken a future contract which you need to do net settle first. Second, as an importer you have to also buy the foreign currency. As an exporter you have to also sell the foreign currency, one of the two things, right? Sir, first go to the futures market. I sold at a price of 0.021. Selling is inflow. On the day expiry rate become this. Squaring of the position means now I have to buy it, means outflow. So 0.021 minus 0.024 is inflow minus outflow, right? On one contract has 2 lakh rupee and 26 such contract we have done gives me the answer of 15,600. Loss. Most importantly, currency dollar. Most importantly, boss, what? Most importantly, currency is dollar. You know what? People in the class. Sir, when you buy rupee, when you sell rupee, inflows and outflows were in dollar. My overall gain loss, people in the class, is going to be in dollar, and since I am ITC, all my inflows and outflows should be in rupee. So this dollar will have to be converted to rupee. Pay attention to what I say. After 3 months when I settle, there is a loss of some dollars I have incurred. So I'll have to go to the spot market, buy those dollars at the spot rate which prevails in the market on the day of expiry at a rate of dollar per rupee 0.023, I will convert that loss to rupee loss to find out overall the rupee amount of outflow. When you take rupee future, gain losses in dollar, which is ultimately needed to be converted to rupee. So when you solve any question of futures hedging, right, of currency, write down the currency, write down the inflow outflow so that you don't end up making mistake. Could I explain this? Yes, sir. Future got settled, life sorted. Sir, now let's go to the spot market. So basically rhythm, if you remember the rhythm of derivative, you go to the future market, settle it. You go to the derivative market, spot market, settle it. And then you see what is the net of both the markets. Sir, now future is settled, but I still need to buy $1,10,000 at this rate. Go to the spot market, buy $1,10,000 at this rate, outflow is this rupee. Sir, margin. Do you remember in derivative, you take a long position in derivative or you take the short position, you will have to always pay margin. One contract require 10,000 margin, so 26 contract require this margin at the rate of 12% for a period of 3 by 12 months. How much interest have I lost? Margin is not the cost that you get back. Problem is the amount blocked loses interest opportunity cost is my concern. 10,000 multiplied by 26 people in the class for 12% 3 months give you this much outflow. So interest is always an outflow. You are an importer or exporter, you always pay margin, you always lose interest. So outflow as an importer, spot market outflow. Futures loss because of that outflow. Sir, interest is always an outflow. Total rupee terms, this is the outflow, and that's how you have to present to the examiner. You have to just settle 3 things. Before that, just show the number of contract and the position at what rate you have taken. This explains the concept. Everyone, now I will tell you what exactly the question look like. 55th question, that's my promise. We can make it really easy. Please look at this, people in the class. EFD Limited is an export business house. There is this company called as EFD Limited. It exports. Wow, sir. If they don't mention anything, I'm Indian. If I export, I will receive the foreign currency, I will sell it. Illustration in the OutNotes we have done for importer. This is the exporter thing we are doing. Both the practice will be done. The company prepare invoice in customer's currency, obviously. Debtor is USD 10 million. So after, on 1st April, I will receive 10 million USD which I have to sell. Market information on 1st Jan. Exchange rate dollar per rupee in the spot market and the forward rate. These are the rates. Currency future again dollar per rupee. Contract sizes in rupee. 1 month, 3 month futures rate are this. Initial margin and interest rates are this. So on 1st Jan, when the position will have to be taken, this is the detail. On 1st April, on the day of expiry, when the position is needed to be settled, spot rate is this, futures rate is this. What is to be chosen? Forward currency future, no hedging. Sir, 10 million USD. When I receive, I go to the spot, I go to the forward market to sell it. Sir, this was the contract being entered. Amount is of dollar, rate is of rupee. Let's solve it. Quantity divided by rate give me finally 62 crore 00 lakh 1240 of rupee inflow. Because I'm exporter, I will sell USD in the forex market. Basic, easy, nothing great. Sir, next. Sir, futures. In the futures, you have to first of all identify futures. So in the future, so first of all identify which column of the OutNotes you are, left or right. Sir, left was the situation where quantity is dollar, rate is also dollar. We are in the right situation where quantity is dollar and rate is rupee. So dollar quantity, rupee rate, everyone, we are the right situation. Sir, we know forward futures is on rupee. Next we decide the position to be taken. Let's decide long short. As per golden rule, as an exporter, I will sell dollar. Golden rule says, do in derivatives today what you will do in the spot on a later date. on a later date you will sell dollar. Why don't you sell it today in this derivative market? I went to the market to sell dollar, but the shop is off rupee, which means I have to buy rupee. So the position to be taken is long. This is only we are understanding. To the examiner, we will now present. In my mind, I have clear that I have to take a long position. Now to the examiner. I wanted to sell dollar at this rate, 3-month futures, but the rate is of rupee, means I will have to buy rupee at this rate. Can you tell me, to sell 10 lakh dollar, how many rupee I will have to buy at this rate? Because every rupee has this quantity fixed. Sir, 10 million divided by 0.0161118 whole divided by 24816,975 being the contract size tells me 25 contract. I wanted to sell dollar, but rupee I will have to buy 25 contract long at the rate dollar per rupee 16118, this particular rate, that too on 1st of Jan. That is what you present to the examiner. That's for your clarity, that's for examiner's clarity. And sir, on 1st April, let's settle everything. First talk about futures. Entered into a contract to buy rupee at this rate. So this much dollar outflow. On the day of expiry, rate become this. So I will have to sell it this much dollar inflow. Inflow minus outflow when you do is your gain, but that is in dollar terms. Go to the spot market at this rate, sell that gain 16136. So this gain 0.016136 when I sell rupee, this much is my inflow. Futures, rupee future gain in dollar ultimately converted to rupee. This much rupee is my inflow. Sir, next, I go to the spot market. I know these many USD I want to sell. Go to the spot market on 1st April, sell it at 16136. So 10 million divided by 0.16136, this much rupee inflow, right? Margin is always an outflow. When I take 25 contract, where per contract margin is this, rate of interest is 7% for 3 by 12 months, right? Total interest on margin is 9843, which is outflow. So rupee inflow, rupee outflow net is 6203. That goes out of, that comes to my pocket rupee, where forward was 6200. Are you getting, please? How did you so easily, with your imagination, people in the class, solved this particular question where everything was crystal clear, which day, what transaction? People, could I convey? Question number 55th, please tell me. We had to solve one question of this concept with great confidence. Could I succeed? Come on. Could I, people in the class, succeed? Tell me. Yes. So the last, almost the last concept for the day is hedging through options, boss. Hedging through options. Similar thought. Cool? So let's do hedging through options now. Give me a second. Come on. Sir, same story. 0 point we import, we have to make the payment, which is why we'll buy the foreign currency. We are afraid what will happen. This time we hedge. We start the hedging, take the position in options. Difference is, you identify options currency. This time you don't decide long or short. It is always long. You have to only decide call ya put, and then you decide number of contract. That is all fine. Sorted. When it comes to settlement, you don't do the net settlement, you do delivery settlement. Sir, what is delivery settlement? Recollected from the derivative, delivery settlement is doing what you agreed upon. Option is the contract you enter today, which gives you an option to buy dollar or sell dollar at a given rate, right? If you think it is beneficial, you exercise the option and actually buy under the contract, that is delivery settlement. Sir, how the settlement will happen, that we'll talk about. Let's understand this part first. Sir, identifying what is the underlying currency, exercise rate based currency, contract size give you the idea of what is the underlying currency. One more trick, the option is on dollar, the premium for that will be in rupee. So premium is in rupee in itself a hint that option is on dollar, right? Next, sir, whether to exercise or not, we will learn it in the concept itself. Here left hand side is important, right hand side is also important. Examiner asks question from both the sides. Let's take it one by one. ITC has 1,05,000 payable in 3 months. So after 3 months, you have to pay to ITC 1,05,000. So common sense, you will buy from the forex market 1,05,000 and pay it. You went to the market, you saw rupee per dollar rate. Wow, wow, wow. Quantity rupee, rate rupee, we are lucky. So we saw that today spot rate is 64 and 3-month forward price is 68. After 3 months, spot rate becomes 67, 3-month forward price not given. Fine. Exercise price rupee 65. It is in terms of rupee, then obviously it is per dollar, base currency dollar. Contract size dollar, premium for call and put is in rupee. Sir, first thing, what is the base currency or what is the underlying currency? Dollar, dollar and dollar. First thing sorted? Yes. Deciding call put. You have to always take a long position. Only decide call put, apply golden rule. Do in derivatives today what you will do in the spot market on a later date. After 3 months, we gonna buy $1,05,000 in the spot market. Golden rule says buy it today only. In the derivatives today only, buy it today. Sir, I want to buy dollar. Rate is of dollar. I want to buy dollar, rate is of dollar. Please think. I have to take long. Buying a call means I have to buy the contract. Buying a call will help me buy the dollar, or buying a put will help me buy the dollar. Sir, call is an option to buy, put is an option to sell. If I buy put, I will end up selling the underlying asset dollar. If I buy call, I will end up buying the underlying asset dollar. Meaning to say, sir, as an importer, I will have to take a call option, and as an exporter, I will have to take a put option. In this case, I will buy a call option on dollar at an exercise price of rupee per $65 by paying a premium of 0.8 rupee. Boss, did you understand that when I buy an option, I have to pay the premium? This is the entire story of today. To the examiner, you don't write this, To the examiner, we directly write down the number of contract. How simple? I have to buy $1,05,000. The rate is also of dollar, simple life. Every contract is $20,000. How many such contract? 105 divided by 20 give me 5.25 contracts. On a rounded off basis, 5 contracts of dollar option, 5 call contract of dollar long at the rate of rupee per $65 by paying a premium of 0.8. With this clarity, when you write, half of the question gets done. Today, whatever was supposed to be done is done. On the day of expiry, let's do delivery settlement. Now, do you agree? Entire 1,05,000 I won't be able to buy with the under the contract, option contract, because option is not on $105, it is on 5 contract. So can I identify how many dollars will I able to buy under the contract? So 5 contract into 20,000 give me total $1 lakh I'll be able to buy. People, total of $1 lakh I'll be able to buy. So 20,000 into 5 give me $1 lakh I'll be able to buy under the contract. That particular portion I could hedge through option. So rest of 5,000 everyone in the class remain unhedged, and that is unhedged part that is to be treated separately. So this entire 1,05,000 is bifurcated into hedged and unhedged. What's covered under the option contract is hedged, and what is the balance is unhedged. Why are you breaking it down? Because we have to separately, individually settle them by delivery. Only 1 lakh could be bought under the option, and 5,000 will have to be otherwise figured out, right? So let us proceed. Sir, now settling each exposure on the day of expiry, let's think about that 1 lakh thing. Call I have taken on dollar means option to buy dollar at a price of 65. Rate in the market is 67. I have an option to buy dollar at 65. Rate in the market is 67. Will I buy? Will I exercise? Yes. Which means 1 lakh dollar I'll be able to buy at 65 because the option gets exercised, and 65 lakh rupee is my outflow to buy 1 lakh dollar. Hedged exposure gets settled. What about the unhedged exposure? Sir, $5,000 I will buy. Sir, at what rate? In the market rate is 67. So at a spot rate ST, I will buy those 5,000, that much rupee outflow. Sir, last is premium. For every dollar, premium is 0.8. How many contracts did you do? We did 5 contract. Every contract has 20,000 contract size, and every dollar has a premium. Every call dollar has a premium of 0.8. So total 80,000 rupee of outflow I'll have to pay from my pocket. So whenever you take a long position, premium is always your outflow. So this rupee outflow, this rupee outflow, and this rupee outflow in total gives you the total outflow you will have to make at the end of 3rd month, even if you hedge using options. Yes, just give me a minute. This is the outflow, correct? You know what? We can have two possibilities in the exam, two variety of question. In one kind of question, examiner can give me the spot price after 3 months. There is also a possibility when examiner does not give me this spot price after 3 months, which means, sir, if the spot price on the day of expiry, which is called as ST, if that is not given, what do I compare my exercise price with? Generally, exercise is being compared with ST to figure out whether I should exercise it or not, boss. If the ST is not given, how would I exercise? Sir, exercise is, the situation is understood as compulsory exercise. The option is assumed to be compulsory exercised, meaning to say, we say 1 lakh rupee compulsorily bought at an exercise price of 65, this outflow, right? Sir, if the ST is not given, then what will be the outflow of that unhedged part of 5,000? That is assumed to be bought at forward rate, right? At 0 point, there was a forward rate. Yes, 68. That is assumed to be bought at forward rate. The option premium continue to remain the same. Can I? Could I explain to you this entire part of currency options? Are you people able to understand it on timeline? Now you read. First, break down what is hedged, unhedged. Settle the hedged part. Delivery settlement you will have to do, obviously. settle the unhedged part, and premium whatever is there you have to pay. That's how you settle all the open position, and that's how the hedging through option happens. Do I have the permission to go ahead to a practical question, which I guess will be question number 58? Come on. 58th. Come on. Sir, let's proceed. XYZ US firm will need, oh my god, sir, imported situation, need pound 3 lakh. I am a US firm, which means my home currency is US dollar. When I buy pound, I will have to pay dollar. When I buy pound, I will have to pay dollar. So dollar home currency outflow question in 180 days following information given. Spot rate 1 pound to 180 day forward rate 1 pound is equal to $1.96. UK US borrowing investment rate are given. A call option. Listen to me carefully. A call option on pound. They have themselves mentioned that it is a pound call option. A pound call option that expire in 180 day. Exercise price of $1.97. If the exercise price is in dollar, then obviously it will be per pound at a premium of $0.04. So if the premium is in dollar, then also the option is on pound, that also validate is. Yes, fine. Forecasted spot rate is futures in the future. The spot rate can be this or this with this probability. Which of the following strategy is preferable forward contract? Forward is easy. I want to buy 3 lakh pound. The rate is also of pound. Life is easy. Buy pound at the rate of 1.96, multiplying the two give me 5,88,000, my home currency dollar outflow. Simple, cool. Next is money market hedge. Money market hedge, people, we have already done in the class. Just one point of ambiguity you should know. What is that ambiguity? That in this question, as I told you, the rates are always per annum. In general, I've told you the rates are per annum, which means when it says 180-day deposit rate, 4.5 is considered per annum. Then what is this 180 day? Sir, compounded every 6 months or compounded every 180 days, the interpretation. In this question, unfortunately, Institute has assumed the rate to be periodic only. They have assumed the rate to be 180-day rate only. 4.5 is not the per annum rate, what is 180-day rate. Sir, what do we do? Unfortunately, in the exam, you will have to do the same thing. But how would we remember that in this particular question it is? Sir, in this entire question or concept of option, there is only one question which has this probability kind of concept. No other question of option has this probability concept. You'll be able to that way recollect it. Don't worry very intensely about such things. If you're not able to recollect it, ignore it. Fine. There is a possibility Institute may itself rectify because it also knows that there is a mistake. And it does the rectification a lot of times. Yes, please. So come on. When we do the revision of IRRM, I'll show you a question where Institute rectified the solution without letting students know. A student went on to do the incorrect solution, Institute rectified the solution. Those who intentionally did the incorrect solution lost the marks. Those who did the correct solution unknowingly got the marks. Yes. So this is the risk, this is the part of the business we are in. This is the nature of the business. So now listen to me. Sir, money market hedging, we have done it. We are not discussing it. Fine, cool. Next is options contract. What is the first thing you do? We identify in our book where we are, left hand side or right hand side. Sir, pound is the quantity. The contract is also pound. We are in the left hand side. Next, we decide. So first we decide option is on pound. Second, we decide whether to long put or whether to long call. Sir, put is not there only, but is it a long call as per golden rule? Do in derivatives today what you will do in the spot market on a later date. Sir, you need after 180 day, you need to buy the pound. The option is also on pound. Please tell me, buying a call will help you to buy the pound or buying a put will help you to buy the pound? Pound is the underlying asset. Buying call is option to buy the underlying asset, option to buy the pound. So I will have to buy a call at the exercise price of this, where I have to pay a premium of this. Sir, what is the contract size? No contract size. Meaning to say, every single pound, people in the class, you can buy. There is no restriction. You can buy, do a contract to buy 3 lakh pound as it is. Fine. So today, what is the situation today? Look at this. Today, to hedge pound payable, we will buy call on 3 lakh pound at exercise price this by paying a premium of 0.04 something something dollar, shayad, whatever was the number. Cool. On the day of expiry. Do you agree? Since there is no contract size, everything is hedged only. There is nothing unhedged to be treated separately. Entire amount of 3 lakh pound is hedged only. Yes. Entire amount of pound 3 lakhs is hedged only. Now, sir, what do I do? Sir, everything is hedged. You just have to decide whether I should exercise or not. The only difference is, in the illustration that I took in the OutNotes, we have just one rate. Here you have multiple rates with the probability, so no problem. Let's take the decision individually. Exercise price is 1.97 per pound. Option to buy pound at a price of $1.97. Price in the market is 1.91. Will you exercise and buy under the contract? No. I will buy at a price of 1.91 only. So effectively, I will buy at 1.91. Price in the market is 1.95. Will you buy at a price of 1.97? No, 1.95 only. Price in the market is $2.05 per pound, but you have an option to buy that pound at a price of $1.97. Will you buy exercise? Yes. So effectively, these may be the rates with the probability of them happening as this. So I am expected to buy pound at a price of dollar with the effective rate into probability as 1.943 per pound. So those 3 lakh pound I can buy at this rate, and dollar outflow will be 582,900. Every step am I able to clarify to you? Entire portion was hedged. There is nothing hedged I could buy. I'm expected to buy 3 lakh pound at this price of $582,900. Done. Now premium. Every pound has $0.04 premium. So 0.04 into 3 lakh give me $12,000 premium. Totaling up will give you the amount of dollar outflow using option hedging. We have done both questions. One question of a type where we have a contract size in the OutNotes. Another question, no contract size, everything hedged but with the effect of probability. In this category, you have one more question, 59. I mean, we're not solving it, just letting you know. Another category, people, the category towards the right hand side we are discussing now, right? Come on, come on, come on, come on. All the live people, the category towards the right hand side we are discussing now. Please, let's get started. Yes, boss. What about the energies? Are we all still having the same energies to watch up, to learn up the things? The right hand side, everyone, really easy. Let's proceed. Not more than 15 minutes, I guess it'll take for you to do the entire thing. Come on. Sir, home currency options. Meaning to say, I want to buy $1,05,000. Home currency is rupee, payable in 3 months, right? Dollar per rupee, when I went to the spot market, I saw that the rate is of dollar per rupee. So today, dollar per rupee spot price is this, 3-month forward price is this. After 3 months, price is not given. Exercise price, $0.019 per rupee, contract size, rupee 1 lakh, premium is in dollar. First question, sir, which currency the option is on? What is the underlying currency? Sir, it is rupee, and it is rupee. First, what position will you take? Let's apply golden rule. Do in derivatives what you will do in the spot market on a later date. Sir, I'm an importer. I will buy dollar after 3 months. But, so golden rule says buy it today only, but the rate option is on rupee. So buying dollar is equivalent to selling rupee. Now you think rupee option is there, rupee call is there, rupee put is there. If I buy call, I'll be able to sell rupee, or if I buy put, I'll be able to sell rupee. Sir, buying call will buy rupee, selling buying put will sell rupee. So as an importer, I will have to buy put so that I can get an option to sell rupee, which will be equivalent to buying dollar, which I ultimately want to do. Logical? Golden rule will simplify the position that you want to take, everyone, for hedging. Always, always. Yes, boss? Sir, as an exporter, similarly, when you think buying the call option will give you an option to sell rupee, right? Sorry, option to buy rupee. Buying rupee is selling dollar, which an exporter wants, right? So today you will buy rupee put option at the rate dollar per rupee 0.09 by paying a premium of 0.03 dollar. Sir, now the quantity being bought sold. Listen to me, quantity being bought sold. I want to buy $1,05,000, but the contract is to sell rupee at this rate. Can you tell me, buying $1,05,000 at this rate is equivalent to selling or paying how many rupee? Sir, that is 1 lakh divided by 0.019 is 5263 something. These many rupee I will have to pay and sell. Which means the contract should be for these many rupees to be sold. Under every contract you can sell 1 lakh rupee. So divided by 1 lakh should give you 1 lakh 5,000 divided by 0.019 is 55,26,315 something, divided by 1 lakh give me 55.26. contract means 55 contracts. I want to sell 55 lakh 26 rupees something, but every contract given option to sell 1 lakh rupee. So I will have to take 55 contracts so that I can sell 55 lakh rupee. Correct? Fine. Do you remember I needed to do the settlement in the delivery? So I need to break down into hedged and unhedged. Listen to this part clearly. I have 55 contracts. Under every contract I sell 1 lakh rupee. And every rupee is sold at this exercise price. So when I sell 55 lakh rupee, sir, or when I sell 55 contract of 1 lakh rupee at this price, how many dollars will I be able to get? Will I be able to get entire $1,05,000? No, sir, because there was rounding off involved, sir. So I'll be able to do 55 multiplied by 55 multiplied by 1 lakh into 0.019 as $1,04,500. When I sell 55 contracts, when I have the 55 contract of put, where under every contract I sell 1 lakh rupee, I'll be able to, whatever rupee I sell, I'll be able to buy $1,04,500. Yes. What about rest of the $500? That I will figure out in the spot market. Sir, this part is not applicable, not seen yet in the exam. This part let's discuss where examiner does not give ST. Where examiner does not give ST. Sir, on the day of expiry price, on the day of expiry, compulsory exercises assumed. Meaning to say, those $1,04,500 are assumed to be bought under the contract. This is hedged part, right? They are assumed to be compulsorily bought at an exercise price. So when you buy 1,04,500, you have to pay 55 lakh rupee. That we remember. That's why the contract size, the number of contracts were 55. You have to pay 55 lakh rupee, sell 55 lakh rupee. Those 500 you do at a forward rate, that is also clear, will lead to rupee outflow. Now about the premium. Please pay attention. You have bought 55 contract of 1 lakh each, where every put has a premium of $0.03. Give me the overall premium in dollar terms. Premium, please pay attention, of rupee contract is in dollar. My final currency, home currency inflow outflow matters to me, so this dollar premium converted to rupee. Please remember, derivative premium is paid at 0 point. This is where you effectively pay the premium, although you are showing the inflow outflow here, but the premium is paid at 0 point only. So in the spot market, I will go today at 0 point to convert that dollar premium to rupee premium. So divide by 0.016, give me the dollar premium to rupee premium, and that's everyone my outflow. Getting it? Hedged portion outflow, unhedged portion outflow, premium outflow. As I said, in the futures, it is the gain loss which was in dollar to be converted to rupee, but using the spot of expiry, because futures are settled on expiry. In case of options, the premium, everyone in the class, is in dollar to be converted to rupee, but using the spot rate of 0 point, because premium is paid at 0 point. Yes. So let's solve one practical question of even this category to make our learning as comprehensive as possible. Question number 60, people in the class right now, let's see what it is. Hopefully the last question for the day. Let us, people in the class, proceed. Come on. Sir, A Limited of UK imported some chemical worth USD from US supplier. Sir, I'm UK, my home currency pound, I am imported USD, which means I need to pay USD, which means from the forex market I need to buy USD. Fine, in 6 month time, relevant spot rate, forward rate given. UK US rates are given, currency option are available, in which one option contract is for pound 12,500. Contract size in pound, premium is USD 1.7 per GBP. Sorry, strike price is this, premium is this. Fine. 3 choice, forward money market option. Forward and money market, there is no point of seeing option, which is a more complicated thing we are here for. Correct? Let's think about it. Option. First of all, identify right hand side in your book or left hand side in your book or right hand side in your book. Quantity dollar, option is on pound, right hand side in our OutNotes. First clarity, option is on pound. Second clarity, deciding call put. I'm giving you 30 seconds to think, decide call put. Please. Sir, decide it. I want to buy dollar. Golden rules say buy dollar today only. When I went to the market, it was pound. So buying dollar is equivalent to selling pound. I want to sell pound. For that, I will have to buy a put option. Sir, what quantity? I want to buy dollar or I want to sell pound at this rate. Can you please tell me, buying these many dollars at this rate is equivalent to selling how many pounds? So sir, 364,897 divided by 1.7 give me these many 364,897 divided by 1.7 give me selling 214,645 pound. Total these many pounds I will want to sell. Under every one contract, how many pounds you can sell? 12,500. So divide by 12,500 gives me 17.17, which means 17 contract of put I want to long today at an exercise price of $1.7 per pound by paying a premium of 0.096. That much you write. Fine, sir. Let's now figure out how much of it is hedged. When I sell 17 contract of 12,500 pounds, when I buy 17 contract of 12,000 pound, meaning to say under every contract when I sell 12,500 pound, in total how many pounds will I sell? This into this. At what rate? This. right? So how many dollar will I receive against it? How many USD I'll be able to buy against it? 17,500, sorry, 12,500 into 1.7 into 17 gives me 361,250. 361,250. So rest of 3647 I will have to arrange from the forward market. So let's now assume compulsory exercise. Hedged unhedged part is done. Now after 6 months, what has happened? Hedged part. Sir, I have hedged exposure of 361 $250 that I'll be able to buy under the option at this rate. So divide by 1.7, give me the total pound outflow. The total pound outflow is 212,500. Correct? This many hedged part at this rate 212,500. Sir, unhedged outflow. What about the unhedged outflow? This part you buy at a forward rate. Please pay attention. Please pay attention. I want to buy dollar. Rate is of pound. If the rate is in dollar, then it is in pound. So buying dollar is equal to selling pound. When we sell it, the other party buy, and it will buy at a bid rate 1.5455 is the relevant rate. Please, in all the technicalities, don't miss to realize what are the basic bid ask you should always apply. These many pounds will be the outflow. Premium. Sir, every contract, every pound, 0.096 is the premium. You have bought 12,000 into 17 gives me 20,400 bought at a spot rate. Divide by 1.5617 give me 13,063 pound as the amount of premium paid. Yes. The total outflow is this, and this adding up will give me 227,923 is the outflow you will make when you hedge through pound in question 60. Forward is easy, money market you can practice at your own. That's how we have solved one question of even. Another category, which is this particular category. I want to show you one particular question, just show you. Listen to me. There is this question, question 62. In this question, it is a question of hedging where you don't have to think whether I should long something, I should short something, whether it is call or put. No. Examiner himself will specify. If you buy call, what happens? If you sell put, what happens? It will give you the option, it will give you the position. You just have to do simply the settlement. Apply basic logic of derivative. Option to buy at this rate. If rate in the market is more, you exercise and buy. If rate in the market is already low, you don't exercise and buy from market only. That simple thing you will have to do in this particular question. I want you all to do this question at your own, because when you see, if in case by chance directly in the exam, you should not feel it as a new question. It should be like a seen and easy question for you, right? So this completes our entire discussion on hedging through futures and options. Let me tell you, in Forex we are left with just two things. One particular question of foreign currency account and another borrowing and investment decision. But right now the lecture really seems stretched. These two things, which should not take, I think, max of an hour, we will do whenever we do the lecture of IFM. Yes. So that is, wow, everyone in the class, entire Forex at this stretch, right from explaining the basics with real depth and genuine speed, right, not to hurry. I feel good because those basics, when you learn really well, you are able to apply it in the advanced concepts as we have come here, right? Anything that you want to ask, you may ask. If no, boss, if you have really liked this video, if you think I deserve a comment to be put on this video, please share your genuine feedbacks, your genuine comments in this video. That was all from my side. If there's anything, you all may ask. If no, we call it a day. Shall we, people in the class, call it a day? So that was all, everyone, from my side. Let's meet back again in the next lecture. I'll see you all. Bye bye. Take care. Stay tuned for more such revision, live revision sessions, in fact. See you people. Bye. Take care.